that's it for this video. If you have not subscribed, please subscribe to my channel so you will be notified when I release new video. And if you like this video, then reward me with a like. I would really appreciate that. And see you in my next video.
This is eToro, the leading social trading platform with over 13 million users worldwide. We make smart crypto trading easy, offering users the ability to buy and sell the world's top cryptocurrencies, including Bitcoin, Ethereum.
Everyone and their grandma's been talking about AMC. You can absolutely not go anywhere without hearing anyone ask about AMC this past week. So we're going to go over some technical, fundamental analysis, also give you some predictions on what's going to happen for this week before you risk any of your money taking a trade or investing in this stock this week. Let's go. All right, guys, welcome back. My name is Cruz. I'm the founder. And
Christopher Gale with the light. What's up, bro?
Make sure you hit the like button and subscribe if you get any type of value.
What's good? What's good? I'm hyped, bro. It's Monday. You know what I'm saying? Everybody's been waiting for this week. Let's see what we got.
There's just so much information and so much misinformation that's out there. I want to
We got our AMC.
put some facts out there for you guys to go ahead and consider. Well, if you should put your money into it. So I know everyone works very hard for their money, and you want to make sure that you're making a good investment. So I'm going to give you some facts and leave you at that. I'm not.
We're bullish. Let's go.
Just going to give you the straight facts of what's going on and what I see for AMC this week. All right. So we're going to go ahead and flip right on over. All right, guys, so we're going to go ahead and take a look. This is AMC and the way that it was going here this week. So we
This
got,
is not made of meat. It's made of vegetables, and even the cheese is not made of dairy. It's made of cheese.
I need some meat in my life. You know what I'm saying?
me, and then
I'm
there
just
was,
playing. Thank you.
players that came over to
I only made you one because I wasn't sure if you like it. I mean, I liked it. It's
So
good.
we got this huge move.
That's
We
fine.
have this move here
You
from
want this?
How come you didn't touch the
What?
tortilla?
25 in pre-market here
okay.
on
Supposed to
Wednesday.
toast it too.
And then most of you know,
You want another one?
The texture gotta be the same, you know
Oh,
what I'm
you want that? You want another one? I'll toast it.
saying? No, I'm
Just
good.
one?
That's it. Thank you.
going into this week, I want you to look at a couple different things going into AMC.
Okay.
The first one is whenever this traded and it went into this 16 level, it got rejected very, very hard. So if I come into like this 15-minute time frame here on the chart, you can see right here where it got up to 16, it got slammed down. Right here in pre-market, slammed down. Right here on Friday, slammed down as well, and also as well on Friday as well. So in about midday. So if you're wanting this to go up, if you're wanting this to continue going on forward, and I see people calling for like $50, $100, things like that, that is your level that you have to break. So you have to break that $16 with some volume in order for this to continue going further up. Now, if you're short in this and you're taking the hedge fund side and what have you, this is this bottom level right here around this $11 is where it needs to get below in order for it to stay below and for it to go back where it came from, back towards this $4, $2, range that it was before. So those are your areas of interest. If you want it to go up, it has to break this $16. If you want it to go down, it has to break this $11. Anything in between is a coin flip on which way it's going to go. All right, so that's the first part. Those are your areas of interest that you have to take notice of when you're trading it this week, okay? Now, the second part is that with the options, I want to show you this implied volatility open interest on the options. So this is the option chain for this week, right? So I think everyone is familiar with the term gamma squeeze now and how the gamma squeeze works. Well, here's the thing. So right now, as far as the open contracts that are on AMC, right now there is a lot of open interest right here at the $20, and then there's also a lot of interest of $40. So you can see $20 right here, and then $40 right here. There's 32,000 contracts open at 20, and then there's also 46,000 there at 40. So for the short squeeze to go ahead and continue, the stock price would have to get over $20. So I know I just said where on the chart it has to get over 16, right? That's the breakout point. But in order for you to continue the squeeze, for it to go any higher, it needs to get above 20 around in these areas where those open interest of those contracts.
Oh, we're just gonna just to keep up with what's happening with AMC and Dogecoin.
Sellers of those contracts,
But once the stock market opens, we'll stream more of it.
They're going to have to buy those shares of the actual equity in order to make up the loss.
Fletcher with the new follow, thank you.
So there's also a little bit of
Grab the coffee.
interest as well. If you take a look at like
All right, while we wait, I'm gonna show you guys though. But I like to play games. Stock market won't open right now.
So in order for you to have the momentum to continue going forward and continue with the squeeze and continue with the gamma squeeze, you would need to get above around $25, and if not, also $20 for those for them to start having to buy those contracts back. This is really important. This would have to happen on Monday or Tuesday for the price to get over those levels for it to continue going further up. Now, I don't know how many of you are aware of this, but whenever you buy a share of equity on the market, it takes it's called T+2 in order for it to settle. So basically what happens then is it takes 2 days in order for the transaction in the background to go ahead and clear. So you will buy the share and then you may close out the share at the same time, but it takes 2 days in order for your broker to go ahead and send the money to the clearinghouse and get the actual stock back, and then it shows as a realized gain, right? So if that doesn't happen, then what's going to happen on Wednesday or Thursday is that they will start restricting the shares again because the broker is not going to take the unnecessary risk and is going to owe too much money because there's too many people that are taking one side of the trade. Too many people taking the long side of the trade. The broker's not going to take the unnecessary risk like they did this last week. They're going to start restricting it again. If the price cannot get over the $25 and $20, then they're going to start restricting the price again. So the squeeze portion has to happen on Monday or Tuesday, or else they're going to start restricting shares and restricting trading again. And then you're kind of out of luck. You can't buy any further. You can't push the stock up any longer because they're going to restrict the buying to it. Another thing I want to point out is this short interest here. So this is I don't know how to say his name. I think it's Eor Dusinsinski over on Twitter. So if you guys want to go follow me, he owns a company called I think it's S3 Analytics, and they're giving real-time short interest updates on these on GME and AMC and things like that. So right now, AMC short interest, this was from Friday, so 384 million, and then 44 million shares that are shorted, 50% of the float, and then the short interest of the float is 11.32% of the fee. So on this here, so the shorts are down right now. So the shorts are down, and the thing is that the original shorts that were in this, they've covered a lot of those original shorts are covered, but now there's a new set of short sellers that are in this trying to make money on AMC, going back to a mean reversion and making money from that side. So this is not as big as short interest because of the 15%. Like on GME, it's not that big of a problem. They're managing it a little bit better on AMC, but it still could happen. You could still gamma squeeze. You could still put these option sellers in a very big bind, forcing the price to go higher. And the last part I want to go over is, and I can't put this, and I can't really show you while the market's off, the sheer volume of AC trading here, guys, is absolutely just nuts. So like within the whole week, this is, I think it was 3 billion, 300 million shares. On a daily basis, it's well over, one day it was over 1 billion. If you go to the daily chart, you can see this was the billion day right here. You can see in this volume when I go ahead and it's 1,200,000. Each day is 500 million. So what happening now is that you have a lot of hedge funds, and not only just hedge funds, but prop firms and everyone around the world is watching this now, where if some of them have algorithms that are trading for them, so high frequency traded algorithms, liquidity that it's presenting, and it's making it absolutely hard to trade it. A retail trader, right? So if you're someone or even like me, I'm a little bit more professional. I have, more professional tools, but it makes sheer volume, and you can't necessarily tell on which way the price. So it's basically like a standoff between all these algorithms that are actually fighting within themselves, and it makes it really, really hard in order for you to get a good result. So what I'm saying is you have your areas of interest, right? You need to be looking at $16 to the upside, $11 to the downside in order for one of those two to break to give you a trend direction on which way to go. And then once we break those, that'll give you a pretty good understanding of which way the ticker is going to go. And you also need to keep track of the price in relation to this open interest right here of these contracts that are open for this week. At the price starts getting over those levels, yes, we may start squeezing where those option sellers will have to buy the equity to go ahead and hedge against the contracts that they sold. Then you want to take a look at the short interest and the algorithms that are involved and make an informed decision on which way you're going to go. The very most important thing, guys, please take this with as much as possible, with as much importance and everything. Please only invest money that you're able to use. Please don't go put your rent money. Please don't go take a loan or your life savings or anything and try to put your money into a ticker like this. I have seen it before on the marijuana bubble. I've seen it on the crypto bubble where something pops off and then you just lose. I had a best friend that bought like 7 cents away from the top on BPTH ticker a few years ago, and he lost a shit ton of money. So like, please only play money that you're able to lose and just consider it gone once you put it into the market, okay? Make sure you guys are staying safe. I wanted to go over this, make sure I give you some points to keep in mind. I want this to go to the moon just as much as you guys. I love seeing you guys. I love seeing all the Redditors. I love seeing all the memes and things like that. I love being sticking it to the man. This is why I named my company New Age Wall Street. Kind of the same thing as Wall Street Bets. I wanted to be able to stick it to the suit, to the man. And we are the New Age of Wall Street. We are the new age of traders that is coming out now. We have the tools and the know-how in order to be able to trade effectively in the market. So please trade safe. Make sure, I hope this helped you out, guys. Make sure you leave me a like and subscribe, and we'll see you guys in the next video.
Cap City.
I'm gonna explain to you why you shouldn't listen.
Attention. Delivery package.
I got you. It's your robot friend. Incoming care package.
High unique success.
That was the last of that squad.
High unique you says.
It's go time.
Me. High unique you says. WTF.
I'm standing still. You're lucky I like you.
Are 99 cents. Bruh. Koala 99 cents. We could have both been up. Crooked Pinkies says. Yeah, then one shot.
To a single thing Warren Buffett says. See, here's the thing. Warren Buffett is worth 80 billion.
Hey guys, welcome back to my channel. Hope you're having a fantastic day. Today we're going to talk about everything going on with the massive short squeeze with stocks like GameStop, AMC, Naked Brands, BlackBerry, Nokia, and many more companies. I'm going to talk about which ones I think have the most potential to skyrocket in the next couple of days based on their massive short positions. Some of them have bigger short positions than others. I'm also going to talk about some good news that has come out of this for these companies long term. For companies like AMC and Naked Brands, there's actually a lot of good news that can help these companies actually succeed long term. And at the end of the video, I'm going to go over Wall Street Bets, some important information from their founder, and something that you need to keep in mind if you're planning on investing in any of these companies, or if you're currently holding any positions in these companies over the next couple of days. This is going to be extremely helpful for any of you guys. I think you're really going to enjoy this. So if you enjoy this sort of content and you like the video, then it would really help me out if you could like the video down below, subscribe to my channel, turn on the bell notifications so you can be notified every time a new video comes out, and comment down below which one of these stocks you're holding right now, or if you decided to stay out of this madness completely. For those of you who are new here, my name is Michael. I'm an investor and entrepreneur. Last year, our public investing account on Patreon, which is currently sitting around $620,000, was up over 105% for 2020. This year, our goal is to get that account to $1 million. I'd like to see investing in real time. Buy a stock, sell a stock, and if you want exclusive content. content that I don't post on YouTube. And if you want access to our Discord and other portfolios, well, then make sure to join our group using the link down below. We have a limited number of spots, and I'm not going to be adding any more spots for at least this next 2 months. So make sure to check that out. So anyways, let's just jump right in. Let's talk about first a couple of the companies that have been experiencing this massive short squeeze. I'm going to go over some price updates on them before the market opens, and so you guys can know where they stand right now. And then after that, we're going to dive deeper into the psychology behind everything and what you need to keep in mind if you are investing in it, and some positive outcomes long term that have resulted from this massive short squeeze. So right now, GameStop, before the market opens, is currently sitting around $312, and this is really the main stock that has been driving this massive short squeeze. A couple weeks ago, GameStop had about 150% short position, which is really shouldn't even be allowed. And because of this, that's why the stock price has skyrocketed significantly, because with this massive short position, companies have had to cover their positions, and they've been losing billions of dollars. After that, we started to see companies like AMC, which is currently sitting around $13.45. They skyrocketed at one point up to about $22, $23 just the other day. We're also seeing it with BlackBerry, which is currently at $14.04. Naked Brands, which is currently at $1.62. And Nokia, which is currently sitting at $4.56. So all of these companies are experiencing a massive short squeeze. Some companies more so than others. GameStop really has been the largest gainer over the last couple of weeks because it's the company that really started this entire movement. It's really become a movement. Right now, Wall Street Bets currently has about 7.6 million followers. When all this started just a couple of weeks ago, less than a week ago, they had about 1.9 million followers. So their growth has been tremendous. It's really becoming a movement. We've seen everything from Robinhood shutting down some stocks, not letting people trade these stocks, which caused people to put even more money into these companies because they didn't like what institutions were doing, especially what Robinhood and large banks were doing, like restricting people, not letting them invest in these companies, because really there's nothing wrong with anyone investing in any company, even if they're terrible companies or they'll go bankrupt. It doesn't make a difference. People should be allowed to invest in whatever companies they want, and really that's been a lot of what's behind this movement right now, that large corporations have been making billions of dollars manipulating the market, and now when the small retail investors are doing something similar by all of them buying a company really that has no long-term future, then it causes the stock price to go up. It's making all of these institutional investors really upset. So right now, if I were to invest in one of these companies, I'm not invested in any of them. I did have a position in Naked Brands for a brief moment. I bought it at $1.20. I sold it at $2.95. So I more than doubled my money, but I'm not currently invested in any of them. But if I were to look at any of these companies right now, the one that I would particularly be interested in investing in would be Naked Brands. I might invest in it tomorrow, put a little bit of money, and I'll let you guys know in our private group on Patreon if I decide to buy a position in it, so make sure to check that out. But right now, the reason for that is because their volume has been so much higher than any other company's volume over the last couple of days with how many shares have been traded. One day this past week, they had over 2 billion shares traded, and I've never seen a stock over 2 billion shares traded in a single day. The last couple of days, they've been over 1 billion, 2 billion, and just on Friday, their market volume was 473 million shares with a short volume of 130 million shares. So right now, the short volume ratio is the highest out of all of these companies right now that have been in the news, and their short volume is at 28%. Looking at GameStop on the 29th, on January 29th, the short volume ratio for that day was 17%. So GameStop still has a very high ratio of people who are shorting shares. That was just from January 29th. But GameStop still has a very high ratio. People don't think it's a good company long term. But right now, Naked Brands, in my opinion, if I had to pick any of these, it would probably be Naked Brands that I would invest in, because it's been fluctuating between that $1 and $3.50 range. Right now, it's at closer to the dollar mark. Right now, it's at $1.62. So you have to keep an eye on it. These are really, really risky investments, and any money you would put in, you would have to be comfortable losing it all, because really most of these companies have no long-term hope. Most of them were going to go bankrupt before all of this happened. And this was good news for some of the businesses because AMC and Naked Brands actually are taking advantage of this massive short squeeze because Naked Brands, they announced a $50 million direct offering priced at $1.70 per share. So now they're going to have $50 million to be able to actually grow the business and make it survive and hopefully thrive long term. Because prior to this, Naked Brands was losing tens of millions of dollars, and it was really on the verge of bankruptcy. The stock price was less than $1 per share. They were at risk of getting delisted from the NASDAQ. They were losing money. They sold off their flagship brand called Naked brand. They sold it off to another company, and really, they were struggling. They still are struggling. The good news with everything going on with the short squeeze is that they're going to get a lot of attention because of everything. A lot of people probably hadn't heard of Naked Brands until this happened, and now millions of people are going to their website, millions of people are checking out what they actually do, and a lot more people just know about the company. So between more people knowing about it, searching it on Google, and now them raising $50 million, they're going to have more money to grow the business, and they have more people who already know about the company. Before this, most people probably had no clue what Naked Brands was. Now, at least people are more familiar with it. And for those of you who don't know, they own a bunch of different brands that sell like underwear or lingerie or things like that. In addition to that, another company that took advantage of everything going on was with AMC. They were able to raise hundreds of millions of dollars. AMC said last week that it had raised $917 million since mid-December of 2020 through equity and debt. And this means they're no longer at risk of going bankrupt, at least anytime in the short term. But one thing to keep in mind is that with AMC, movie theaters have been struggling, especially with the pandemic. If we don't get vaccines starting to get rolled out, well then this company can struggle long term, but that's really not what's important. A lot of what's going on with all of these stocks right now has nothing to do with long term, nothing to do with how the companies actually will perform, and just has everything to do with retail investors wanting to get back at large institutions and Wall Street bets pouring millions of dollars in. But it's important to just know what's going on with these companies. In addition to this, on last week, AMC raised an additional $304 million by selling shares, and this was something that they wouldn't have been able to do before, but now with the massive short squeeze, they're able to raise more money, and that's just going to help their business long term. So, again, like I said, everything going on right now has nothing to do with how these companies actually function, their actual fundamentals, because all of these companies were on the verge of bankruptcy. That's why so many large institutions had massive short positions in the company. Naked Brands was losing tens of millions of dollars, and it's a fairly small company. AMC was really struggling as well. AMC is probably the best company out of the bunch that we're seeing right now because AMC had just raised close to $1 billion that they could use to grow the business and help them sustain themselves until the economy opens back up and people could go back to movie theaters. But other than AMC, GameStop was on the verge of bankruptcy, BlackBerry was, Nokia. These are all names that people knew were struggling, and people really knew these brands were failing. So investing in any of these companies right now is nothing about long term, but most people will probably already know that. So looking at these companies right now, one thing to keep in mind is that even the founder of Wall Street Bets, he had said the other day that this wouldn't have never happened on his watch. He had said if he was still a moderator of Wall Street Bets, then he would have prevented this type of thing from happening. He said he had done it frequently in the past, and he's no longer the moderator, so he couldn't prevent this at all. But he said previously as a moderator, he would have prevented this. So what does that mean? Well, looking at the stocks right now, all of these crazy runs we've had with GameStop, AMC, BlackBerry, Naked Brands, Nokia, and many more companies, really, even the person who you would think is like the face behind this whole movement, the person who founded Wall Street Bets, he's even saying this would have never happened on his watch. So what that shows me, at least, is that, and it's pretty obvious to most people, is that these stocks are going to be on the verge of crashing down. And a lot of people aren't talking about this because right now everything's going very well. And I made a lot of money from a couple of these stocks with Naked Brands. But really what's going on is everyone who's making a bunch of money, there's going to be millions of retail investors who are going to lose a lot of money as well, because long term, these companies have no future. A lot of them, like GameStop, it's really struggling. BlackBerry, really struggling. Like, they have a very small chance of ever really succeeding and thriving in the future. So these companies eventually are going to crash. And it's just going to be a matter of time is how long are people going to hold these stocks? Are you going to continue to hold on to these stocks? How long are you going to hold on for? And once people start selling, it's going to come crashing down and people are going to lose a lot of money. So if you're not already invested in these companies, I would really just be hesitant. Really just be aware that they are going to come crashing down at some point. We don't know when. We don't know how much they're going to drop. But all we know is that eventually they're going to have to come down. Like, we don't know if it's going to be this month, this week, or if it's going to be 6 months from now or a year from now. But eventually, people are going to lose confidence in investing in GameStop or BlackBerry. And they're going to say, well, I'd rather invest in, let's say, established brand, even just like an Amazon. People might have made a lot of money with GameStop, and they'll say, okay, I'm going to take some profits. I'm going to move that over to a different stock, one that isn't going to be as volatile. Because no matter who you are, if you start making a lot of money and then you see it go down, you're going to want to secure at least some profits. You might keep some money in there, but so just be aware of this, because people aren't talking about how much money everyday people are going to lose if they get in now. Or, they could make a lot of money, but there's going to be tens of millions of people who are losing so much money, and people just aren't talking about that right now. People are just talking about the banks and institutions losing money, and they're not focused on what else could happen in the future. No one knows how this is going to affect the stock market, because right now, no one's doing anything wrong. People are just buying a stock. People could buy any stocks they want. Doesn't matter if it's a good company or a bad company. You would think that people would actually buy stocks that are good companies that have a good future in front of them, but now people are just buying, they're making it more like a game. So as a result of this, we saw actually Citron Research. They came out and said that they're no longer going to be putting any reports out of shorting a stock. They said that
This is eToro, the leading social trading platform with over 13 million users worldwide. We make smart crypto trading easy, offering users the ability to buy and sell.
Citron Research discontinues short selling research. After 20 years of publishing, Citron will no longer publish short reports. We will focus on giving long side, multi-bagger opportunities for individual investors. They had probably lost a lot of money with GameStop, and really the other reason behind them doing this is that right now, companies, if they say they're going to short a stock, then everyone is rushing to actually buy the stock. It used to be like a self-fulfilling prophecy. If a major investment bank came out and said, we're shorting this company, well, then a lot of people would think, this is a bad stock. I don't want to be in it. I'm going to sell my position, and that would cause the stock price to go down, and those banks would make even more money. They said the stock was bad. Everyone thought this company's bad. I don't want to be in it. But now the opposite's happening. Big investment banks are saying, we're going to short this stock. We don't think the company is going to do well long term. Now all the retail investors, people just like you and me, are saying, oh, we're going to buy this, because if we buy this stock, well, then the stock price can skyrocket because of a massive short squeeze. Banks are going to lose a lot of money, and the price, they're going to have to cover their short positions, and they're going to lose a lot of money. So right now, banks are just going to stop putting out that they're shorting a stock, because if they say that, retail investors are just going to do the opposite. So I see that as being one of the main things that is going to result from what's going on right now. We're probably not going to see any companies at all saying if they short a stock, because if they do, we're just going to see a massive inflow of capital into that stock, a massive inflow of investors saying, we want to buy this, we want to screw over the investment banks. So I don't think that's going to happen anymore. So we'll have to wait and see with that. But right now, just be aware of everything going on with GameStop, AMC, Naked Brands. Keep a really close eye on it. And if you do decide to invest, you just have to be careful, because we don't know when everything's going to come down. But in my opinion, I think it has to come down eventually, because people at some point are going to either want to move their money over to a company that they think could actually succeed long term, or people are going to have made enough money with GameStop or Naked Brands or Nokia or any of these stocks. They're going to have made enough money. They're going to say, I don't want to risk it. The people who made $40-50 million with this, at some point, they're not going to want to see their money go back down to $100,000. They're going to take their profits. They're going to say, this is life-changing. I'm going to move my money somewhere else. I don't want to risk it. And I think we're going to start seeing that a little bit this week. But I think we're going to continue to see these stocks probably go up. There's just really no way of telling. So just keep a close eye on it. But let me know your thoughts on everything going on. What do you think about GameStop, AMC, Naked Brands? Do you think they're going to continue to go up this week? Or do you think they're going to start leveling back down a bit? Me, I might get into Naked Brands, if anything, or early Monday morning, early Tuesday morning, early in the week. But as of right now, I'm just holding out of it. Not going to put a lot of money in because you just have to be careful. And I want to make sure all you guys know that this is going to be very risky. If you do decide to invest, you could have massive rewards. You could double, triple your money in the matter of a couple hours. But you could also lose that entire investment in a couple of hours. So just let me know your thoughts on all of this. I'd like to hear what you guys have to say. If you want me to go live tomorrow, talk more about GameStop, AMC during the day, as news comes out from Robinhood, from AMC, from all these brokerages and stocks and everything going on in the market, let me know. I could always go live. But I hope you guys enjoyed today's video. Don't forget to get your 4 free stocks, each valued up to $1,600, when you download the Webull investing app using the link down below. I hope you enjoyed, and I'll see you guys in the next episode.
Free, free, free.
That's right. TurboTax Free Edition is free. Free, 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 free.
Grammarly does more than catch errors. With Grammarly, you can find really good, no, perfect words that make your writing sharp, or explicit, or excellent, or distinctive. As a matter of fact, for what it's worth, Grammarly can, yeah, that's long. We can get rid of that, and this, good, and this, or how about this? Grammarly helps you be concise. If your tone might make someone feel like this, Grammarly can remind you. It would help if you soften your tone. And if you need the support, Grammarly encourages you to write confidently. Because the better we all communicate, the better we connect. Grammarly, helping you connect. Go to Grammarly.com and download today.
Gareth Soloway, Chief Market Strategist at In the Money Stocks, is back to break down Wall Street Bets Trading Madness. Gareth, welcome back.
Hey, thank you so much for having me.
AMC to the moon, baby! Today, we're going to be talking about what's going to happen with AMC tomorrow because that's what everybody wants to know, and myself included. So, if you haven't been following, last week wasn't so great for AMC, even though we imagine huge things to be happening. However, this week is more promising. One of the major downfalls in AMC last week was Thursday, Robinhood cut us out, and it disabled a lot of people to be able to buy AMC. We thought Friday we're going to recover, and guess what? Friday didn't really be the day we expected. How it did go up, It did go up. However, it was not the day we expected. But tomorrow, guys, the market is ready. The people are ready, and we are ready. We have crazy news with the whole Wall Street bets going on. And you know what? We'll start it off by Wall Street bets post, and we'll pop it up here on the screen right now. We got an AMC Monday warning. On Monday, the stock price will go up in the opening, and people will start selling once they see they have made some profits. If we all sell, the big investors will take advantage of this, and the war will be over. They will win. If we keep strong and hold positions, they will attack and not be able to put the stock down, like on Friday. If we make this happen during the week, AMC will skyrocket to the moon and we will leave with our pockets full. That's intense, y'all. That's what, if that don't get you pumped up, what will? So here's the thing. Even on my Discord, I had a couple of guys reach out to me saying that, hey, Umar, if it goes up tomorrow, should we close? And listen, guys, if you're trying to make a quick profit, I guess so, but you're destroying the whole movement, because you gotta understand, it's bigger than just money. It's bigger than just profiting, guys. The whole idea, the whole the movement of this is to, you know, stick it up to the man, stick it up to the guys that are sitting at Wall Street. And if people sell when markets open hot tomorrow, what that will do is it will cause dips in the market. But if we buy and hold, it throws the whole game off, guys. So now for price predictions for tomorrow, so we saw the market close at $13.26. After hours was $13.46. What can we see for tomorrow? And honestly, guys, I don't want to be held to this. Okay, so first of all, it's my personal opinion. Okay, personal opinion means what Umar believes. So again, don't get upset. Okay, don't get upset, 'cause some of y'all are getting freaking upset. At bare bone minimum, guys, tomorrow, at bare bone minimum, if you don't know what bare bone minimum means, is at the lowest value, I see tomorrow AMC shooting up to $20, which is $7 on the share, right? And that's a bare bone. If we buy strong in opening markets and we don't close out and we hold AMC to the moon, like we all say in the comment section, and if you haven't, go drop it down in the comments below, AMC to the moon, baby. If we hold, it's just going to continue to go up. People have been asking me personally, Umar, is AMC actually possibly going to hit $100? Again, if we hold, a lot of people are gonna buy, see some profits, and close. Some of my friends already closed and they made a couple $100. Sure, awesome, right? And again, this is not investment advice. I'm not telling you to buy AMC, and I'm not telling you to hold it either. But if you're part of Wall Street Bets, you're part of the community, you want to see the growth in AMC, you want to see AMC to the moon, what the Wall Street Bets is saying, and not Umar, is buy and hold. Buy and hold. As for price predictions, I easily see this going to $20 tomorrow. Easily. Because like we saw on Wednesday, because that's when the pump started, we saw it hit 20. We saw it go from $5 to 20. Okay, and I caught them pretty late. I think I caught it when it was at 12, or was it at 9? It was either 12 or 9. But like I said, guys, I said this in all of the series of the WSB series. Okay, the top 5 WSB series. I've said this from the start, where I'm only putting money I'm willing to lose. I will not close out no matter what until I see this hit skyrocket. When this hits a price where it's unbelievable, like if AMC hits $100 tomorrow, I'm closing out my positions, which is bad because that's not holding it to the moon. But that's me being honest and real with you. And if you think otherwise, drop it down in the comments below. If you're gonna exit before, drop it down in the comments below. But honestly, if you guys are here for my price prediction,
right this moment, there is a mad rush in America. Apple, Amazon, Facebook, dozens more.
Earnings, you can use this to compare other businesses to this business. You can use EV to sales multiple like we did in the open door video, dollars to get a EV to sales multiple of 4.25. Or you can use a dividend discount model. Now, all of these models have their pros and cons, but the one common thread throughout all of these is you need good, reliable financial information in order to execute on them. The problem with Lucid is that as of today, January 31st, the company has yet to announce a merger with CCIV, which means they're still privately held and they don't need to report any financial information, which makes it really hard to use any of these more sophisticated valuation models to try and get an idea of just how much this company is worth. But the good news is that we have a ton of information online about other SPAC deals in the EV space that have actually gone through in the past year that we can use as a comparative analysis. And that's exactly what I've done over the past weekend. I've taken a lot of time to really pull all this information together on other companies and try to make a prediction of what might happen to Lucid stock if the company does decide to announce a merger. Before we dig into the good stuff, I just want to reiterate that I am not a financial advisor together. So nothing, I mean nothing, in this video should be considered financial advice. So do not make any decisions on this video. Any decisions you decide to make are your own and your own only. With that being said, let's dig into the fun stuff. Before we get started, I just want to mention it will be helpful if you get yourself a hot cup of joe, coffee or tea, because I'm going to go through a lot of math or a lot of numbers in general, so it may help. With that being said, in the upper left-hand corner, these are the items that I first want to cover. Non-EV manufacturer is a blue items. These items here are non-EV manufacturers. The reason why I make them blue is because Lucid is an EV manufacturer, and I don't want to get confused with companies that are powertrain manufacturers and trying to compare that to Lucid, who really isn't a powertrain manufacturer and isn't really connected to this company at all. The second piece of data is that all of this is as of the 30th of January, yesterday, and all of this will change starting Monday morning when the markets open. So that's something to keep in mind. And the last thing is that this is based on a CCIB current stock price of $22.88, all of this analysis. So what I did was I pulled together 11 EV manufacturers, each of them from kind of varying backgrounds. Some of them are EV van producers, some of them are EV cars crossover, some of them are EV buses, powertrain manufacturers, or EV trucks. And the reason why I do this is another data point for comparison purposes, right? We want to, in order to value Lucid Motors, we need to get a good comparable. And part of that is understanding the products that some of these other EV SPACs make. Next piece is where they're based, their ticker symbol, and then the merger announcement date. Now, this is not the date that the companies merge together. This is the date that the holding company and the target company have said, okay, we've agreed that we're going to merge at some point in the future. And then that point in the future would be the merger agreement date, or the date that the companies actually merge. This is the first announcement that a merger will take place at some point in the future. And then the last piece is the market cap in billions. So this is 400 million, 500 million, so on and so forth, right down the line. I filtered this by market cap so you can understand kind of the smaller players and then the larger players in this EV SPAC space. Some of these companies have just announced that they're going to merge. Some of these companies have already merged, so that's something else to keep in mind. And then I went and looked at the price after week 1 month, 3 months, and the peak price after this merger announcement date. And the reason why I've chosen the merger announcement date and not the merger date itself is because if we look at Hyliion, the price action in Hyliion, we go back here. We're going to have to reload this site here. But I do want to mention, if we look at the price action in Hyliion, right?
Everyone manages their money differently. So why are you investing in a one-size-fits-all portfolio? With M1 Finance, you can combine any stock, fund, or expert portfolio to create something that's totally, well, you. You can even automate your investing and retirement savings so you're always building wealth in the background. Oh, and did we mention it's free? That's right, no commissions or platform fees, ever. You work hard for your money.
So we can see this a little better. Let me just do this. So if we look at the price action in Hyliion, the reason why I'm looking at the merger announcement date and not the merger date itself is because the merger announcement was June 19th, okay? So we see this big ramp up in the stock price from June 19th, but the merger date itself was actually September 28th. So that's right around this area. So we see this big decline. And this area here is, as investors, what we want to capture. We want to try and understand how much money we can make in this period of time. And if we're a long-term investor, we don't really care about this period of time. But for the purpose of this analysis, I think it's most important we look at just this area. So that's why I'm looking at the merger announcement date. So each of these, what this is saying here is, for Lordstown Motors, for example, what I'm saying here is that after the merger was announced on August 3rd, 2020, the stock price went up 10% 1 week after that date, 57% after 1 month, and 26% from this date, it went up in 3 months. And then the maximum it went up, this is the peak, the total amount that the stock price went up in a given period of time is 159% from this merger announcement date, okay? So that's the first piece of information that we have here, this top table. The second piece is that I said, okay, we know some of these other SPACs, but what about the legacy auto manufacturers who are now making EVs and some of the other EV manufacturers who've become public through IPO or by other means? So I want to take a look at those as well. And we have a list of those down here. We have Tesla, NIO, Xpeng, Mercedes, BMW, and VW. And we have some of the same information here: product, where it's based, the ticker symbol, the merger announcement date. Doesn't matter because these companies weren't merging with anyone. And then the market cap that the market has actually given this company, or each of these companies rather. And this is important because these companies have been around a little bit longer in most cases than these other companies. So they're a little bit more established. So this is an idea when we think about Lucid becoming this publicly traded company and producing 30,000 or 50,000 or 100,000 cars on an annual basis. This is the type of valuations that we could start to see in the future. So this is a kind of a long-term thinking when we look at these. Now, if we go down here for comparison purposes, and what I wanted to talk about in today's video is that what we want to do is compare some of these other EV SPACs to CCIV. And I think when we look at this list here, I want to look at kind of which of these companies are most like Lucid Motors. I think probably the best argument would be Faraday Future because they do make EV cars and crossovers just like Lucid does. But the problem with Faraday Future is it just was announced. The merger was just announced. So we have this really small market cap and a very short period of time of measurement. So if we go down the list and we look at some of these others, EV bus, EV van, powertrain, or EV bus, EV van, powertrain manufacturer. But then we have these ones down here, Fisker and Lordstown Motors. So I think these guys are probably going to be the most comparable to Lucid Motors. I know it's not perfect, but Fisker has similar products, a little bit lower price range. These are not luxury products. And then Lordstown Motors right now makes pickup trucks. So it's not one-to-one, but it's similar. And we actually get a very similar market cap for both of these companies. So in order to compare these to CCIV and Lucid Motors, if Lucid Motors becomes CCIV in a merger, we have to be able to compare it. So down here, I pulled out CCIV's information. Churchill Capital, EV sedan crossover, if they do merge, that's what they're going to be producing, just on the luxury side. The country, the current ticker, of course, that will change if a merger goes through, the merger TBD. And then the current market cap that the market has assigned to this company is $6 billion, which is really interesting to me, right? Because if you go up here and look at some of these more established brands, like Fisker and Lordstown, who've been around a little bit, well, not very long, but a little bit longer as far as publicly traded, they're trading at right around $4 billion. So this is saying that the market has already priced in $2 billion more than some of these other companies. So in order to compare them, I want to look at, okay, if CCIV, the merger happens, or the merger is announced rather with Lucid Motors, what can we expect 1 week, 1 month, and 3 months, and what can we expect the peak price to possibly be if this merger happens? So what I'm going to do is I'm going to do a quick calculation. I'm going to use the current stock price, okay, and then we're going to multiply it by 1 plus this adjustment here. So this is saying 1 week, if we're using the Fisker valuation, we can expect a decline of about 3% in the stock price. And this is what that looks like in terms of CCIV. And if we pull this across and pull this down, this is what's going to get us kind of the valuation across both Fisker and Lordstown, and look at kind of each of these time periods. After 1 month, if we use the Lordstown valuation, we could expect to see maybe a $35 stock price. And then at peak, right, we could expect a $59 stock price, right? That's about a 100% run up from the current stock price. That's a 1x on your money. Pretty huge, right? But there's a problem with this calculation, and the problem is that where Churchill Capital is already at a $6 billion valuation, a market cap rather, whereas these companies are only at 4.2. So we really need to right size this for a better starting point in order to better understand where the stock price can go over that period of time. So what I'm going to do is I'm going to delete that out, And I'm going to take these two market caps here and bring them down here. And then what I'm going to do is look at just how much higher the CCIV market cap is than these other companies. So what we need to do is we need to take this, and we need to do that. So that's saying that CCIV market cap is actually about 30% higher than these two other companies. So in order to right size our formula, what we needed to do is we need to first take this 70% to reduce the current the current stock price of CCIV down to these kind of normal levels to be on par with Fisker and Lordstown. So we're multiplying this, kind of doing the same calculation that we did before, plus this adjustment, and just making sure that calculation is accurate, and then we're good. Okay, so now we can pull this across and pull it down and get a little bit more accurate estimate of what we could possibly see, what movement we could possibly see in this stock price given the Fisker and Lordstown price movement in the first week, first month, and then first 3 months. So if we look at this here, we're obviously pricing in a 30% reduction right off the bat. So these numbers are going to be a lot lower. But even with a 30% reduction and a 10% increase in the first week using the Lordstown valuation, we're still getting quite a decent pullback by about $5 of the stock. If we go across here, at peak, with the 30% decline in the market cap, at peak using the Lordstown valuation, we could see a 41% stock price. This is very speculative, of course. We don't have a ton of information to go off, but based on this information, we could see a 41% or $41 stock price. This is about 100% increase on the current stock price. Pretty crazy, right? The next thing I want to look at is some of these more established brands. So if we think about Lucid in a long-term mindset, what might happen with the company's valuation over the long term? And I think the best way to do that is to look at some of these other companies as comparable. So I've already kind of pulled these in. I'm just going to change this to black so you guys can see them. So this is CCIV versus the more established brands. And as we look down this list, I think the most comparable companies here are Mercedes, BMW, and NIO. The reason why I don't put Tesla on this list is because Tesla, you've heard people say it over and over and over again, that Tesla is not an auto manufacturer, they're blah, 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 blah. Well, it's true. And I'll show you why it's true, why it's not a good comparable for Lucid. Tesla makes vehicles, yes. But if we go down here to their financials, you can see this red is the energy sector. And Tesla, as of right now, is really the reason why Tesla is going to be so massive over the long term is not only for their auto manufacturing capabilities, but also their software as a service, and more importantly, their energy sector. And this red area is the energy sector. And as you can see, it's slowly getting a little bit bigger every quarter. But the reason why I expect this to rocket up and really be different from Lucid Motors is if we go down here to the bottom of this, we can see energy storage deployed. So these are the power packs and power walls that Tesla has deployed. This is a lagging indicator, right? So this is a lagging indicator for the revenue to come on the energy sector. So this is massive. This is exponential growth, exponential increase in this sector. So I don't think that since Lucid is really working in just the automotive space, I don't think we can use Tesla as a good comparable. So hopping back in here. So if we're purely looking at market caps here, and again, this is very speculative, right? Because we don't have a ton of financial information to go off. We need to look at what the current market cap of CCIV is versus some of these more established brands. If we're saying in the long term, Lucid has the potential of being a Mercedes, a Mercedes of the EV segment, because this is a luxury EV maker, or a BMW, or a NIO of the EV segment. NIO cars are priced similar to Lucid, maybe a little bit cheaper, but this is a good comparison, I think. So what we need to do is we need to take the current market cap of Mercedes and divide that by the current market cap of, what is happening here? I hate Google Sheets. Okay, so we're taking Mercedes and we are dividing that market cap by CCIV's market cap. And that's going to give us a multiple of 12.5. So that's saying that Mercedes valuation as of today is 12.5 times larger than CCIV or quasi Lucid Motors. And we're going to go right down the list here, do the exact same thing for these other guys. And this is going to give us a 12.5x, a 9x, and a 15x valuation. And then if we apply that to the current share price of CCIV, this is the most speculative, the most kind of high level, what we can see at the max, the maximum what the market is willing to pay for a company that can produce these vehicles at scale, 100,000, 200,000, a million vehicles per year. This is what the market is currently pricing this at. So if you take this and we multiply this times the current share price, right, of CCIV, we can get, we pull this down here, look at this. This is 300, look at the NIO valuation, $335 per share. If we valued CCIV and Lucid Motors at the same valuation as what NIO is at right now, we get a $335 per share for CCIV. This is a massive growth potential, right? This is a 14x on your money, which means if you put in $1,000 and this goes up to that point, that's a $14,000 return. Again, this is completely speculative and this may never happen in a million years. The merger may fall through and never happen, but this is possible. This is what companies are being valued at right now in the EV marketplace. So with all that being said, you guys, I hope you enjoyed this valuation. I mean, there's so many holes that you can poke in this, but without any financial information from Lucid Motors, I can't do any more sophisticated. There's other ways that you can do some valuations, but very limited in what we can do. So once we do have that financial information, I can do something like a discounted cash flow approach or some other more sophisticated, more accurate valuation of this company. But I just wanted to show you guys how exciting this is, right? Because there is a potential for a massive run up in the stock price if number one, the company is able to execute. Peter Rawlinson is a great leader and able to kind of drive this company toward its goals. And long term, if customers continue to purchase their products, of course they don't only have a product rolling off the assembly line yet, but if customers like their product once it does come off the assembly line and there's no issues and customers continue to purchase the product, this is what we could see in the long term as a valuation for this company. That's it for today's video, you guys. I hope you got some value from it. If you did, I would really appreciate a thumbs up down below and even more a subscribe if you don't want to miss out on any future content like this. Also, tell me what you guys think about the valuation. Do you think it's too low or too high? Down in the comment section below, I answer all of the comments on my videos, so I'm interested in hearing what you guys have to say. That's it for this week. Peace.
Let me go back to my other screen. Sorry, I thought I was on this screen. I mean, I could do this, but this kind of, yeah, you know what? That probably works. Yeah, let me show that. And mainly, I just didn't like the fact that they are limiting our shares, so I wanted to keep this up so people do know this. We have 5,000 people in here, so I want everybody to know that they are trying to still limit our shares on Robinhood, and I haven't seen anything on any of the other brokerages, but it looks like Robinhood is the one that is limiting shares, and it seems like they came out with an excuse talking about, oh, it's not because of Citadel, it's not because of Melvin Capital, like that's not the reason. But I don't believe them. I don't believe them. I'm pretty sure you don't either.
Doggy Kong to the moon, baby. Let's go. Let's go. Let's go. Let's go. Let's go.
See, I have TD Ameritrade. I also have Ally, which I wanted to show here, but it's not something I can't find how to update the pre-market on Ally. When I traded on Ally, it was more towards long-term investing, so I didn't really care about what happened in the pre and post market. I only cared about the news and stuff, which I don't care about anymore. But yeah, I mean, I like Ally's platform. I just can't figure out how to get the extension.
maybe I'll go into an air trade. I'll have to do that. I'll have to check on that another day and see if I can get the Active Trader Pro in here. That would be amazing. We have 4,800 people in here. AMC is at 1584, 86. It's pushing down. And GME is at $317. So it's lower than when it opened or when it closed. That's obviously not a good thing. You want it to either push above or way below so that we can either have a buy-in or a sell-off, or we can predict what's going to happen. Because right now it's middle of the road, which means that it can go either way. Cash App is unlimited. That's good. American Airlines, I have no opinion on American Airlines. I did hold them, and I actually still do hold them in another account. So I have no opinion there. Nokia all the way. Nokia definitely seems like it has some moves to it, but it's just, like I said, I don't really think it has the volume for that. Like, I don't think people are going to be pushing that volume, even though Robinhood has given them the ability to trade 2,000 shares. I don't know. Owen says delete Robinhood. I still have it, but I don't trade on it. Let me know if you changed over, if you successfully moved your money from Robinhood to another platform. Has anybody done that? I don't know Nokia's entry or exit target because I haven't been paying much attention to them, and especially since I don't know the details of all the situations. If I look at the chart, it's definitely pushing where you want it to be, but I don't think it has the volume to continue that. So AMC and GME is something I want to focus on. F Robinhood, yes, I understand. I know what you're getting at. Delete Robinhood, downloaded Voyager. I never heard of that. I'm definitely getting off Robinhood. Have you opened another account? I would definitely take the time to already be in the process of opening an account, because it takes a while to get things moved, and if you're looking to invest in this series, I don't think it's not over. It's going to continue this week, next week after that. So just get Fidelity up and running, or get whatever other platform you think is going to allow you to trade. 15.95. Right now it's above 16 for AMC, and GME is above 320. I'm moving all my assets over to Fidelity. It's pending for the 8th of February. That's good. That's good. Do you have anything that you can actively trade in? With dividends in crypto. Robinhood is good for dividends in crypto. Yeah, I definitely like the dividend tracking. It's just there's a bunch of things with Robinhood that I have trouble with. Mainly, like, their platform is amazing. The user base is very simple to use, and it updates in a timely manner, right? But the problem is their customer service. They have security issues, and they're definitely sketchy. In these situations where people can gain so much money, they're sketchy. I think the other times where the stock market and things were moving at an alarming rate, Robinhood didn't allow you to invest in, like, things were
With
down.
Fundrise, the same kind of real estate investments that have powered the world's strongest portfolios for decades are now available.
Hey guys, it's Sim, and in this video, I'm going to provide
literally
commentary
limited
on left some updates in regards to the whole
I can understand if you came out and said, okay,
We're joined now by Peter Rawlinson. He is the Lucid Motors CEO. He is joining us from California, where the company is based. Thank you for being here, Peter. Of course, Tesla just came out with its numbers late yesterday and reiterated its target to produce 500,000 vehicles. Now, you were the chief engineer on the Model F, who worked at Tesla. Any lessons from that experience and from the Tesla experience in terms of production specifically? Because as we know, starting a car maker is not exactly an easy proposition.
Absolutely, and there's a huge gap in the endeavor from getting from a prototype stage to a car in production. We're very cognizant of that. We're hitting production in spring 21 with Dream Edition of Lucid Air, and the whole team is very focused upon that. but we're putting a lot of processes in place to ensure that we can undertake that in a successful and cohesive manner. We're starting our pre-production build at our purpose-built factory late this year, so we can dial in the processes and get all the quality right before we start actually producing cars for customers.
Hey, Peter, Pross here. So we're talking about, you mentioned the factory in Casa Grande. You want to put out about 34,000 vehicles in the first year and potentially 400,000 at the end of the decade. That being said, does that mean that you guys are going to come out with a cheaper model to really compete with Tesla on a mass scale, or do you still want to target that upper, Mercedes S-Class customer?
I think it's really important that we start at a high-end position as a true luxury brand. I'm a great believer that the first product defines the brand. In a way, Tesla Model S defined Tesla as a brand. And I believe that Lucid Air Dream Edition will define us as a new brand, as a West Coast brand. And the brand is all about the sort of the heritage and the inspiration of the state of California fused with Silicon Valley technology. But it's absolutely my mission and ambition to make sustainable mobility more widespreadly adopted. And we can only do that by progressively making cars at more attainable price points. And that's why I'm so pleased that we're going to bring in the sort of foundation for the whole Lucid Air range, the Air, at a more attainable price point starting early in 22. It can't come soon enough.
Peter, I'm curious, and keep in mind I've got a Studebaker poster over here, so this is a 19th century company that is one of my favorites. Have you built, because the images of the vehicle are stunning, but how many prototypes have you built and tested? What are you learning from these vehicles?
Right. Well, we've got a very extensive fleet. We're in the stages of completing a fleet of 80 beta prototypes. These are not concept cars. These are not show cars. These are real engineering prototypes. We built our alpha fleet a few years ago, and this beta fleet, they're broadly 95% production representative. And we're actually building them on a pilot line so we can learn from the process of construction as well as the attributes from the prototypes. So the first prototypes, they are for developing the fundamentals of the car, the structure, the suspension, the ride and handling, the durability. But as we go through the prototype process, we layer on testing of different attributes for noise and vibration, fit and finish, and the interior. We're doing a lot of work at the moment with the HVAC, the air conditioning system with the interior, as we get more into representative interiors into our prototypes. And this is a very phased, progressive process which leads inexorably to the build of our pre-production cars in the plant in Casa Grande in December of this year.
Hey, Peter, Ines here. We've seen traditional manufacturing companies going into the EV space, even the luxury ones, BMW, Mercedes-Benz, announcing a lineup. And GM also announced some manufacturing changes to make an EV Cadillac. How do you see these traditional manufacturers going into the EV space? Are they positioned to make this a reality for them?
I'm really disappointed. I mean, Tesla's got a preeminent lead over the others now by many years because Tesla recognizes this is a technology race. We recognize that. I'm disappointed that the traditional automakers are not moving fast enough. And that's really why Lucid's come onto the scene, to accelerate this process. Tesla can't do this alone. We need to accelerate this technology race for a widespread adoption of sustainable mobility. That is our mission. And if you apply one key metric to the ability of any EV company to demonstrate its technology, that is efficiency. How far can I travel in miles per kilowatt hour? And we're not seeing high levels of efficiency from these other automakers. Tesla's right up there. Lucid's surpassing Tesla. We're getting over 4.5 miles per kilowatt hour. I'm not seeing anything close to that from these traditional automakers. Porsche Taycan is more like 2.6. And now even Volkswagen, they just launched the ID.4. And I applaud that. Great from Volkswagen to see them rising to the challenge. But they're just not there with the efficiency. It's just over 3 miles per kilowatt hour for a relatively small car. Whereas Lucid Air is a full-size luxury sedan and it's over 4 miles per kilowatt hour. That is the measure. The traditional automakers are just not rising to the plate, stepping up to the plate fast enough. It's as simple as that.
I've been quested to bring this one back to its kind. This is no place for a child. Wherever I go, he goes.
The Mandalorian, new season now streaming only on Disney+. Get the Disney Bundle for just $12.99 a month.
Good grammar and spelling are important. But if you want to write essays that inspire, messages that forge brighter connections, and emails that get the job done, you need to think about more than just grammar and spelling. This sentence is grammatically correct, but it's wordy and hard to read. It undermines the writer's message, and the word choice is bland. Grammarly's cutting-edge technology helps you craft compelling, understandable writing that makes an impact on your reader. Much better. Grammarly works where you work, on your computer or your phone. Imagine what you could do with the secrets of the world's best writers at your fingertips, anytime you need them. Are you ready to give it a try? Installation is simple and free. Visit Grammarly.com today.
Hey, Peter, Pross again. So, you mentioned Tesla, and you talked about they have that lead in efficiency, and how Lucid is almost up there, or surpassed them. You used to work there. Elon Musk last night in the earnings call talked about how what separates Tesla from the others is that they're so vertically integrated. They can actually want a part, we can actually make a machine to make that part. Is that how you compete with Tesla? Is that how you compete with their efficiency and then their technology and their software stack?
Well, first of all, I would say our main competitor is a car company. I'd highlight Mercedes-Benz in terms of the attributes of Lucid Air. We're going after S-Class Mercedes, but it is a natural comparison, and I accept that comparison with Tesla. Now, you could go super vertically integrated. There's a historical precedent with Ford with the River Rouge plant. You could go into iron ore smelting. You could go into nickel mining. The question is there a proportionate value add and value proposition for the company? I see this as a very nuanced solution. I think that it's absolutely crucial for us to be super vertically integrated in the key areas that offer maximum value. So we're going super vertically integrated in the design and development and integration of our electric powertrain technology and the manufacturing of that. We're not going to buy in our motors. We're not going to buy in our battery packs. We're going to actually buy cells in from LG Chem, but we're going to develop our own cells longer term. So yes, we're going to be super vertically integrated in the key selected areas that offer maximum value. Are we going to be super vertically integrated in making our own tires? No, Pirelli do a great job at that.
You're not going to be doing smelting anytime soon. Peter Rawlins.
Not doing smelting anytime soon, no.
Hopefully you can join us again soon. Lucid Motors CEO Peter Rawlinson, appreciate it.
Thank you.
I'm Eric Schatzker, and welcome to Bloomberg's Front Row. Today I'm talking to Kathy Wood, the CEO of ARK Investment Management and active ETF superstar. You might know Kathy for predicting back in 2018 that Tesla would hit $4,000 a share. She hung on amid a torrent of scorn on social media. Now that, and many of her other bets on disruptive innovation, are paying off massively. Kathy's biggest ETF has returned well in excess of 100%, and ARK's assets have swelled to $50 billion.
We still think there's a lot of room or runway ahead because what we think is not well understood is exponential growth.
Kathy has confidence. We talked about the genome stocks she thinks can outperform Tesla, how ARK uses social media to such great effect, an ownership dispute that threatened her firm, the one thing every woman in finance should want. Here's my conversation with Kathy Wood. You're having one of the best years in the history of professional money management. What's it like?
Oh, it's been unbelievable. The coronavirus created tremendous number of problems, and our portfolios are all about solving problems. And our investors have been rewarded for helping to solve some of the world's most profound problems.
What about on a personal level? Are you enjoying the celebrity?
Am I enjoying the celebrity? It's fun. I love what I'm doing. That's the first thing. I love the team I'm working with. I love our research. I love bringing to life new ways of looking at the world, helping people understand, how the world's going to change, and not only in their investment portfolios, but also in their own lives, their children's lives, their grandchildren's lives, helping them understand how to move everyone to the right side of change and really benefit from the exponential growth trajectories that are just taking off now.
It's okay to enjoy being a rock star, even if it's just for a moment, right? You're enjoying potentially life-changing success.
Most certainly, but I have been around the block a few times, the track a few times, and whenever things have gone this well for me, usually there's a correction around the bend, and I want to gird for it and protect it, and also prepare our investors for the possibility and say, just keep some powder dry, because what we're looking at here are long-term, again, exponential growth trajectories that they're not going to be stopped. You can't stop progress. And today, when the government tries to stop progress, it usually fails. And so even if we go through a correction, and I expect one, we must almost always expect corrections. I just have to keep my eye on the prize. But I do want to warn investors that, in the investment world, it's not just straight up and to the right. We will have those corrections. So again, we just keep our eye on the prize. We have a 5-year time horizon. We are fully invested at all times, which is what we are supposed to be. But that doesn't mean that investors shouldn't, sometimes take a bit of money off the table and keep some powder dry.
I know you're aware, Kathy, that the market doesn't give second chances to superstar managers who stumble. Ken Hebner is one who comes to mind, right? He was never able to rebuild the asset base that he had before the financial crisis. Neither was Bill Miller, for that example. Is that something that concerns you, the consequences of having a bad year?
Well, one bad year would not worry us at all. Our investment time horizon is 5 years, and we have projections which we develop from the top down, trying to understand how technologies are going to scale, and from the bottom up, how companies are going to embrace these new technologies and ride their coattails. And just looking at the portfolios today, this is after the triple-digit gain, as you have said. For the next 5 years, we believe that our returns will compound at an annual rate of something in the low 20% range. And this is in a market where traditional equity returns have been in the 7 to 8% range over time. So we still think there's a lot of room or runway ahead because what we think is not well understood is exponential growth. I think if we step back and look at Amazon in the early 2000s, I remember buying that stock, and many people derided that decision because the thought process back then is in the tech and telecom bust, which is, the internet is a figment of Wall Street's imagination. What makes you think Amazon's ever going to make any money? And if you did at that time assume that Amazon's revenue growth would compound at a 20 to 30% rate for the next 20 years, you would have bought that stock all day long, even if you were using a dividend discount model, right? I feel like our portfolios are filled with Amazons because the seeds for what we are doing now, they were planted in the tech and telecom bubble. And they have been gestating all this time, and now they're breaking out to those growth trends, just like Amazon did.
So the portfolio may not be able to replicate the 500+% gain it's had in the past 5 years, but it should be, based on what you just told me, well over 100%. It should double plus in the next 5 years.
Yes, we expect more than a doubling in our portfolios over the next 5 years.
If I look backward, as you well know, Tesla accounts for almost a fifth of the return that you have generated in that 5-year time span. Which of your current holdings, Kathy, do you think will supply the biggest lift in the next 5 years?
Tesla's still in the running, but I would have to say the biggest upside surprises are going to come from the genomic space. And that's because the convergence of DNA sequencing, artificial intelligence, and gene therapies, importantly CRISPR gene editing, are going to cure disease. That convergence is going to cure disease. Now we have real science and technology surfacing the mutations in our genomic profile. And as they surface those mutations, what do we see? We see the earliest manifestations of disease. And now, with the combination of artificial intelligence and gene editing, we're able to both anticipate diseases and cure them potentially. Beta thalassemia, we're seeing it, sickle cell disease. We even think it will work in diabetes, which is where most, if you look at the largest category of spending year to year in healthcare, it's diabetes.
Kathy, another surprise for me in your portfolio attribution is that almost none of your performance, just 20 points out of 600 points, is from Apple, Microsoft, Amazon, and Facebook, the 4 biggest contributors to the S&P 500 over the same period. What about them doesn't make the grade for Kathy Wood and for ARK?
Well, we're not saying they'll be bad stocks at all. In fact, they've been very good stocks. And they were a part of our portfolios in the early days. But as they were scaling into the trillion-dollar category, we believed that our research would be focused better on the next set of fangs. And I don't mean fangs meaning in the internet age. We actually think the next fangs are in the genomic age. And if you'll notice, our flagship portfolio, the largest exposure is healthcare for that reason.
What would make you reconsider investing in those stocks?
What would encourage us to move back into that ilk of stock is a continuation of what we're seeing now, so that some of our valuations become stretched beyond our minimum hurdle rate of return. So our minimum hurdle rate of return for any stock entering our portfolio is 15% at a compound annual rate over the next 5 years. So that's the doubling over 5 years. We're not there yet, but if we're in the low 20s, which is much more than a doubling over 5 years. But if we started seeing more and more of our stocks lose that return expectation and drop below 15%, we would move back towards some of the FANGs and Microsoft because we would be treating them essentially as cash-like instruments for our strategy. So what we do is As a bull market extends, we do move into more cash-like equities. They would be the less volatile stocks, and certainly the FANGs and Microsoft fit that. We would do that increasingly.
Bitcoin historically was a huge contributor to your returns, and I know you're still bullish on it because ARK recently published 2 very favorable white papers on Bitcoin. But so far as I can tell, there has been no Bitcoin in the ARK Innovation ETF for more than a year and a half. How come?
Yes, well, we put it in at a 1% position in 2015 when Bitcoin was $250. And we scaled with it. We didn't sell it at all. So it hit 10% of the portfolio, at which point we were forced to sell. And at the same time, there was some forking taking place. So we were getting distributions. And what we learned is that Bitcoin threw off what's called unqualified income, which is not illegal, but from an IRS point of view, if our portfolios generate more than 10% of gross profits in unqualified income, which is usually commodity-like income, the IRS allows that 10% and then will confiscate the rest of it. So if we moved into a black swan event where the equity markets imploded and Bitcoin took off, our clients would be able to keep only 10% of that gain. And we just thought this was too much of a risk from a fiduciary point of view to subject our investors to. So what we did is we moved out of it in early 18, better lucky than smart, because of course we went from $20,000 down to, at the end of 17, down to below 4,000 earlier this year. In our fully discretionary portfolios, where we are not subjected to the 40 Act rules of the SEC, our Bitcoin position is about 7% right now. So that is how optimistic we are on it.
And it's once again flirting with $20,000. Can you put a price on your level of bullishness?
We are extremely bullish. Our confidence in it has gone up since 2017, because what we saw as it dropped from 20,000 to below 4,000, it actually got well into the threes, I think in 2019, was that Bitcoin's share of the crypto asset ecosystem moved from the low 30% range in terms of value, network values, into the low 70% range. And what did that tell us? That confirmed in our mind that Bitcoin is the reserve currency of the crypto asset ecosystem. So it is the reserve cryptocurrency, which is a very important role. It's the flight to safety currency. It is Bitcoin's technology, or Bitcoin's blockchain, is the most secure of any other blockchain. And so it makes sense that Bitcoin would be the reserve currency of the crypto asset ecosystem.
Kathy, in August of 2018, you tweeted a letter to Elon Musk in which you effectively put a price target on Tesla of $4,000. And that call arguably made you famous, but it also exposed you to a world of hate on Twitter. Any regrets?
Oh, no, not at all. I didn't read the Twitter world of hate notes to me. Our marketing department used to send me anything that I needed to respond to. But no, we were standing up for what we thought was right. And we also were astonished that at the backlash. And I think part of it was Elon's personality and the way and the things he was saying on Twitter. He's a provocative soul, and he's brilliant. He's our Renaissance man, and all we did, which is what we should have done in terms of our research, is keep our eye on the prize, and the prize had to do with the autonomous taxi network that we believe Tesla will be in the pole position to dominate, mostly because of its advantages in artificial intelligence and the amount of data it has collected and the AI expertise that it has. And we couldn't believe that no one wanted to listen to this, that they really just made fun of it. And it made me feel even more strongly about Tesla, because what we saw happen over time as the naysayers were growing was their barriers to entry, or Tesla's barriers to entry, were increasing. Their battery technology was already 3 years. Now it's maybe 4 years ahead of the competition, especially now that they're going to build the battery into the structure of the car. They had the first AI chip. No other auto manufacturer has an artificial intelligence chip for autonomous. They now have 15 billion miles of real world driving collected. Google, the next closest, has about 25 million, 15 billion. The winner in autonomous is going to have the most data and the highest quality data. That company right now is Tesla. So way back then, our confidence was high that they were heading in the right direction. And as the naysayers grew, it was after 2018, through into 2019, as the stock was cratering, as many out there were saying Tesla was going to run out of money. We thought that was a ridiculous concept. The only time a company like Tesla will run out of money is if the market shut down. There were companies that ran out of money in 08, 09 because the markets were closed. The markets were open. We were going to support Tesla if they did an offering. So were many others. So, I mean, they were creating stories that were just ridiculous on the face of them. So, no regrets whatsoever.
Tesla is a great example of how you and your colleagues have harnessed social media as a tool for marketing, a tool to disseminate your ideas. Where do you figure ARC would be today without social media?
I don't think we would be as far as we are. I know we've been very gratified to see how beautifully we're scaling and getting our message out, which has helped our distributors, because we have a distributor here in the United States, one in Japan, who distributes for us through Asia Pac. We are known throughout the world. We are punching so far above our weight because of social media. And what's been fascinating about it is it has given us a competitive advantage because the compliance departments in other organizations will not let their portfolio managers or analysts talk about their research. We can't really talk about our stocks too much, but we can talk about our research. And that is giving us a competitive advantage in two ways. The reach that I just described, but also we're becoming a part of the communities we're researching. Our analysts, as they put out their research, not when it is finished, but as it is evolving, they are engaging with the communities who are actually making these innovations happen. And it's a beautiful dynamic, because what we're doing is we are educating those innovators about how big their markets are going to be, how quickly they will scale, where the barriers to entry are likely to be, what the competition looks like. And they are battle testing our assumptions. They're telling us if we've made an incorrect assumption, or they're telling us if we've got the technology right. So it's an incredible give and take. And I always thought that open source research, much like open source software, would be a very powerful dynamic in the marketplace, and it has been.
So hazard a guess for me. You've got 30 plus billion in AUM today. Where would it be without this community that you've created and the velocity that being on Twitter has provided?
Well, to be honest, we're up to 50 billion now.
Oh, if you add all the separately managed accounts and the institutional money.
Accounts, all the different strategies. I think we'd be a lot smaller than we are now. And I think that, what comes around, or what goes around comes around. We have really with outreach as one of our ARC's missions and values, we have wanted to educate people, the average investor, about how their lives were going to change and how they might capitalize on these changes in their portfolios. And so I think there's a virtuous cycle at work here. And there's also a bit of a viral network effect taking place, which I think many in the financial world did not think could be a part of the financial world just because of our regulatory regime and so forth. But I do think it's happening, and I'm thrilled to be a part of it.
You believe there are 5 technology platforms that are changing the world: artificial intelligence, robotics, energy storage, DNA sequencing, and the blockchain. But of course, technology isn't static. If there's a 6th, what would it be?
Well, we're looking closely at quantum computing because I've been in the business a long time, more than 40 years, but for the last 20 years of those, we've been examining quantum computing. I'd be at the World Economic Forum technology conference in China, and, professors from around the world focused on, the next big thing, quantum computing. It was always 10 years out, always 10 years out. And it probably still is from a commercialization point of view, 10 years out. But now we have the first little baby rudimentary quantum computers. There's actually something physical out there working.
Active ETFs were pretty common back in 2014, but mostly in fixed income. There were very few in equities. Why did you choose the actively managed ETF as the wrapper for your strategy and not something else?
Yeah, it's interesting. We were looking after 0809 at AllianceBernstein, the research on strategic change team. So the thematic team was saying, okay, we have had a major disruption, and now technology will come in and take care of some of the problems caused by that disruption. And so what we saw happening in the financial services industry was a share shift towards ETFs. And just from a research point of view, we were asking ourselves, why is that happening? We didn't know anything about ETFs. And so we looked at what an ETF is and understood that there were 4 reasons that ETFs were starting to take share. They were more transparent, and after 0809, investors wanted more transparency. Investors wanted more liquidity. Unlike mutual funds, they trade all day long. They're lower cost than mutual funds because they didn't have any hidden fees. The fees, what you see is what you get. And they were more tax effective. And so for those 4 reasons, I just asked the question, why aren't we doing why don't we put our fund into an ETF? This sounds like a good deal for the end investor. And that's what got me questioning, hey, AllianceBernstein, what are you doing about ETFs? Are you thinking about active and so forth? And that's how we fell into that conversation. But it was from a research point of view.
I've wondered to myself why you didn't start a hedge fund, because from a purely self-interested standpoint, you'd be a lot richer at 2 and 20 than you are at 75 basis points.
I felt that the right thing to do was go where no one was. And I've had good success over the years doing that. If you see everyone moving in one direction, and sure, hedge funds have been so lucrative for asset managers. But if you see everyone moving into hedge funds and private, and you look at a new wrapper that's actually a good deal for the end investor, and you go with low cost and public, using the private market valuations as an umbrella, maybe, just maybe, you'll be onto something big. And so I think that's what happened here.
ETFs are by definition public market vehicles. I've wondered this as well. Why not extend your investment thesis to private markets and raise money to invest in venture capital and in growth equity? Because so many of the things that you're interested in get their start there.
Absolutely. Well, one of the reasons was the low-hanging fruit in the public equity markets. Innovation had been neglected in the public markets. It had become overvalued in the private markets. My stomping ground was the public market, so it made sense for me to start there. Now that the valuation discrepancies are narrowing to some extent, not completely, and because we must know private companies. And in fact, part of our research ecosystem with the social networks getting involved with companies as they're innovating. A lot of them are private, and we're talking to them regularly in social media, on social media platforms. So yes, we are evolving some strategies. We hope that next year we'll be able to launch something. What I would love, and it would be true to our stripes, our current stripes, I would love, because I know the SEC is opening up up to this, I would love to be able to offer a public-private option that would be available for all retail investors. Right now, we have to, the private world has to deal with accredited investors. So there's a screen. I believe that screen is going to start coming down over time. And I'd love us to move into a world where we could offer what we do across both public and private companies.
In the form of an ETF?
I don't think it can be done
No,
in the form of
probably
an
not.
ETF, just because of the way market makers and authorized
Sure, the creation redemption mechanism.
It would be very difficult, but I'm sure that we could find some other wrapper, maybe a separately managed account wrapper, in which to make this happen.
Right now, Kathy, your ETFs alone are generating an annualized run rate of $220 million in revenue, and that doesn't include the other assets under management. How profitable is the business?
Well, it has, our business is very profitable now, but believe me, the blood, sweat, and tears that we left in the early days, it's a scalable model. So we had to pay for the infrastructure in the early days, and we were quite the loss-making company. And I felt it acutely since I funded most of it for the first 3 years. But in those early days, we were investing aggressively, which is what we tell our companies to do, because we thought we would be able to scale. And when we were able to scale, we'd have the right talent in place to scale. And so we've done that. And I'm very happy to say that we are able to reward those who are making us happen, the team that's making this happen, and rightfully so. So in a way, the hedge fund model, you have maybe fewer people and less in the way of assets, and the same kind of profits. So we've done it a different way, and now we've shown it's possible, and we think it's a really healthy way to go as well.
Kathy, in the midst of the incredible year ARK is having, you're in a legal battle for control of your firm. How on earth did that happen?
Well, I will say that has quieted down, and we are in negotiations. I think all we wanted were negotiations, and we wanted to be fair and square with our partner. And I think things will work out. I think we're well on our way.
From your perspective, does working things out leave control of the firm either in your hands or the hands of you and your partners, your colleagues at ARK?
Yes, it does.
And if things were to go pear-shaped, and for your sake, I hope they don't, do you have a nuclear option? Could you just take the team, pack up, walk out, start a new firm, and create new ETFs?
I could not. I could not.
You have a non-compete.
And a contractual obligation.
Okay.
Yeah.
So both sides then have an interest in coming to the table.
Yes.
Kathy, ARK manages 5 active ETFs, all of which have more than $1 billion in assets. Are there any others that you have wanted to create, thought of creating, or in the process of creating?
Yes, and one of our partners, a distribution partner in Asia Pac, Nikko Asset Management, the Japanese market is a very interesting market. The clients, the investors, basically tell the distributors what they would like to see. And we've learned from them. So our fintech portfolio came out of Japan. It started in Japan in 2016 and in the US in 2019. They have a space exploration fund. We're looking at that one at some point in the next year or so, hopefully. And also an SDG fund we are likely to launch there, and SDG Sustainable Development Goals, the UN 17 goals. Our technologies, our 17 technologies map, or I should say 5 platforms and 14 technologies, so that'd be 19, map beautifully against those 17 goals. So it's a natural.
If you had to build ARC all over again, what would you do differently?
Oh, probably, well, we had to pivot because we sat in year 2.5. As I told you, I funded it for the first almost 4 years. 2.5, we're there at $40 million. We built it. They did not come. And I would not have built captive distribution at the time, but I would have been more aggressive about finding a distribution partner sooner. I felt that we would be able to, I had a big network out there, and yet what I didn't know was the ETF world and the active world were a universe apart, that my network had no relevance to the world I had entered, which was a bit of a shock to me. So I might have been a little more humble about that, number one, and done a little bit more homework, and maybe gotten a distribution partner a bit sooner. But we did try. We were trying. It's just we didn't think anyone really understood active management in the ETF world, and it did take 2.5 years to find that partner.
Any advice to women in asset management or in finance more generally?
Well, I think asset management and finance generally is a great place for women, especially if a woman or anyone, it's a man or a woman, can develop a track record. No one can take my track record from me, for better or worse. You know, some years have not been so great, but no one can take it away from me. And if you build one over a long enough period of time, and are successful, it's usually a ticket to more success. So I always say, try and figure out a way to measure your success in a way that no one can take it away from you. And that does not mean not being a team player. Being a part of a team that develops a great track record is really important. So many people say, wow, your industry seems to be quite lacking when it comes to women in portfolio management positions. And that is true. And I do think it's an unfortunate case of last in, first out in 2 periods, tech and telecom bust, 08, 09. And so that's unfortunate. But I have the highest regard for the industry. It is a heck of a lot of fun. It's extremely challenging. The world is our oyster, as long as you're not playing the old game, which is benchmark sensitivity, as long as you really are investing in the future. I think allocating capital to its highest and best use in terms of what we described earlier, increasing access, solving the world's problems. There can't be anything more satisfying from
Kathy,
a career point of view.
Thank you so very much. It's been great talking to you.
Who is USAA made for? It's made for him, a veteran who honorably served. And it's made for her. She's serving now. We also made USAA for military spouses and their kids. Become a member. Get an insurance quote today.
I want to bring in our guest host this morning. Chamath Palihapitiya is the founder of Social Capital, which manages more than $2.5 billion in assets. He also launched a blank check public company, which began trading on the New York Stock Exchange in September. Maybe you can give us some hints about what that SPAC wants to buy. Chamath is also the part owner of the Golden State Warriors, and we're thrilled to have him here. Travels with an entourage. I know we have a whole team of people here this morning. Hi over there.
It takes a village.
Takes a village.
He's got a wardrobe consultant.
He's got
obviously. Because is that from the Sorkin collection? This is from the Sweater of the Month Club, as you correctly
there
pointed
you go.
out.
Look at that.
Andrew,
Bingo.
what about backing from Chamath for a Sorkin sweater?
I thought about. What do you think?
A sweater
like
of the month?
like a trunk club situation.
I think it's a great accessory, underused.
No, but look, we have the graphics ready to go. So we're thinking of selling a sweater every month.
I love it.
We'll just send it out in a box.
I would buy it.
What would you pay?
Anywhere between $50 and $500.
50 and 500.
I mean, it depends on the build quality.
We only accept Bitcoin. Okay, so we got a lot to talk about and unpack, as people like to say in the news business. Talking about this, I want to talk Bitcoin, and then we should probably first start with this, though, because you made a lot of headlines, or at least I know you made this comment just a couple of weeks ago, but it seems to have gone viral now.
Yeah.
Your thoughts?
I've heard it. It's viral.
No, but it just appeared in some of the blogs and other things in the past couple of days. You made some truly critical comments about Facebook, really upending children and our society, and it was.
Let me set the context. So the context was I was at Stanford, and the dean asked me to speak to the MBA students, and in it, what I was talking about was. The question was, what do you think the long-term effects of social media in general are? And unfortunately, what happened was, I think it's easy to characterize what I said just as a Facebook-specific thing because I worked there and I was a key part of growing it. The reality of what I was...
Explain what you said at the time.
So what I said was, I think the tools that have been created today are starting to erode the social fabric of how society works. And what I meant by that is the following thing. Today, we live in a world now where it is easy to confuse truth and popularity. And you can use money to amplify whatever you believe and get people to believe that what is popular is now truthful and what is not popular may not be truthful. Joe and I, for example, we've been on the other side of climate for a long time, right? And the reality is now I can take money and I can use that through all of these social media systems that exist to hundreds of millions of people, and I can convince all of Joe's friends and everybody like him of my opinion in very subtle and small ways. And he can do the same to me. We can do that about vaccines. We can do that about gay rights. We can do that about bathroom laws. We can do that about Roy Moore. And so I think the question we have to ask ourselves is, how do we live in a world where this is now possible? And
so it was about that, but just so I understand, was it because I read and watched parts of what you were talking about. Part of it seemed to me about the ability to pay to manipulate people's thoughts. The other seemed to me to be this sort of ADD society with which the sort of liking and everything else has created this sort of feedback loop that you compared to drugs.
We know for a fact that what all of these systems do, every single one, is it exploits our own natural tendencies in human beings to get and want feedback. And that feedback, chemically speaking, is the release of dopamine in your brain. And so what these feedback loops do, and they exist everywhere, in Call of Duty, in other video games, in social networking sites, they get you to react. And I think that if you get too desensitized and you need it over and over and over again, then you become actually detached from the world in which you live.
You become callous, you become crude.
And you live in front of your screen.
But Chamath, let me ask you this, because the thing that I've been so concerned about is Facebook just announcing that you're going to be having some app that you can use when you're 7 to 13. I mean, it's one thing for us to be doing this, but to be hooking your kids on something that you're describing as a dopamine fix at that age, that's crazy.
So look, I think in the case of Facebook specifically, I think they have probably done more than any other company, quite honestly, to try to fix it because of all of the companies, and I've seen them all up close. They're the most, frankly, to be very blunt and honest, the best run and the most technically sophisticated.
But they're also emailing me if I haven't logged onto Facebook for a while saying, hey, did you see the post from so-and-so? Did you see the post from so-and-so? Trying to lure you back in. And again, we can make those decisions as adults, but as children, that is a different...
Well, I think the product, and I don't know it quite honestly in as much detail as I should, but I think the way that product works, because of privacy laws in the United States, you actually have to get parental permission. The point, though, is, and what you're bringing up is, I think, is the most important thing. we all have never taken a step back and actually asked ourselves, how should we be interacting with these things now, 7 years into it? And what should we be expecting of the internet at large? Look, the reality may be the entire business model of the internet may be fundamentally somewhat broken, right? Because we allow ourselves to get interacted with in ways where we don't necessarily control the medium or the messenger.
And we are not putting up any barriers to ever give yourself any downtime from that either.
Exactly. And so it may mean that we all collectively need to figure out, not just individuals, but also the companies, also governments, quite honestly, how different business models need to exist so that we can actually divorce ourselves from how this stuff is
what goes on in the Polyhopatia household?
There's no screen time whatsoever.
None.
None.
So forget about. Let's not even talk. Your Facebook is not just off limits. You're talking no iPads.
None.
None. How old?
Now that's it. I have 3, 8, 9, 7, and 5.
And do they ask?
Oh, all the time, because their kids, their friends have it all the time.
Movies?
A little bit if we have to.
But no computers at all.
You know, here's the life that I live with my children, which may not be for everyone. I said I don't like this codependency of they need to rely on me, and when they can't, I feed them a device because that becomes a babysitter. You go figure it out. Go outside, skin your knee, fall on the ground, play a sport, lose at something, and then come back to me and we can talk about it. And we'll talk about it as rational human beings, and I'll try to tell you why that's a good thing that just happened to you. Versus, here you are, I'm in a baby because I have something else to do. And so we've made these conscious choices. I've made these conscious choices, but they're conscious. And what I was trying to get across, and I could have done it more articulately, is it needs to be more of a conscious choice. I'll give you a different example. Adam Bain, who you know and love, he and I go to the Knick game. And you would think that it's amazing. We're sitting courtside, it's fantastic. I took a picture, he took a picture. We sweated the filter for 15 minutes trying to figure out which photo. And I thought, if Adam Bain and I are stuck trying to figure out what photo filter we're going to use because we're so craving the reaction, what must everybody else be going through? And aren't other people feeling this void that I'm feeling in this moment? So I'm just, I try to articulate a sensation.
In the meantime, you're not watching the game. You're not paying attention to what's going on.
It's just a really weird place. So I was just trying to articulate
What kind of reaction? Does Mark Zuckerberg call you? Who calls you in the Valley after you make a comment like this?
Let's just say a lot of people called and texted. Here's what I would say. I owe those guys everything. They made me. I mean, I'm sitting in this seat because, frankly, I was able to be a part of a company that did something really wonderful, and they're gonna do more to fix this stuff than anybody else. So I feel bad that guys there may feel like I didn't do right by them in what I said, but it was not directed at Facebook. I was really just trying to talk about something societally, and I agree with you, Joe. I'm not gonna backtrack on what I said because at some core basic level, we have to start talking about this stuff. How should our kids, why is anxiety and depression amongst our teenagers higher than they've ever been?
Yes, it's a
in a
huge,
world
huge
that is
issue.
safer, in a world that's more constructive, in a world where you should have access to everything, what is going on? And we just have to figure this out and talk about it.
When will you let your 9-year-old actually have a screen?
He can get a job. I worked at Burger King when I was 14. When he gets a job and earns enough money to buy his phone, he can do whatever he wants with it. Up until then, I'm going to feed him, clothe him, and house him, and send him to school, and that's all I'm going to do.
I mean, I feel you yourself don't feel the urge to always check your a screen, or you do?
I check my screen a lot at the office.
He's got the phone right there.
And even now, I've actually morphed my behavior. What I do now is, like, whenever I even come into the office, typically, I actually put it face down. Because otherwise I feel all these notifications. I'm constantly, my email notifications, stock alerts, etc.
Well, you can turn those off. I don't have those on.
This is a pervasive trend that's...
But I feel it. I remember the other day where I forgot my phone and I was in a line somewhere. And it was a signal from my unconscious just about every 2 minutes that I felt. It was like...
By the way, do you ever feel the panic phantom pain of wherever you keep your phone?
Yep. Or where you feel like maybe a text just... Yeah.
So this is clearly something that's new.
Have you talked to Sean Parker about this? Because he made some comments that were similar just 2 or 3 weeks ago.
Well, this is why I thought, you know, what I said a month ago really, it was me kind of just saying what at the time I was thinking through, and then it was a month later now. This whole thing has kind of gone crazy. It's
so, and it, you know what? It probably is chemically mediated. I mean, in my brain, that, whatever gets me to all of a sudden feel that need to do something is.
It's true for video games. It's true for television. Right. It's true for other forms of. It's true for music. So it's probably true for your phone.
Right. We're going to be spending a lot more time with you, but I do want to just get to one other topic because we talk about it every day. Bitcoin.
It is out of control. Like, look, let's
talk Bitcoin.
Let's talk Bitcoin. 2012, I was introduced to it. I started to accumulate. 2013, I wrote an article. And
so you're, hold on, just so we know and can feel bad about ourselves, you're accumulating it at what price?
Well, my dollar cost average is around 100 and something.
And you've held it, everything you've bought?
Well, at one point, myself and, I was introduced to it by a person. I asked him if I could disclose his name. He said no. But he, myself, and another person, all three of us relatively well known in the Valley, we started, at one point we owned almost 5% of the entire float. In 2013. We've sold, they've sold, et cetera, et cetera. I wish we had kept it all. We didn't. It's fine. But then I wrote an article, and I said, you know what? There's so much asymmetric upside here. This is a thing that either goes to, at the time I said, roughly the value of gold. And at the time, it was about $100 a coin, and so there's very little downside. There's all this asymmetric upside. I said, take 1% of your net worth and buy this schmuck insurance. And it's a schmuck insurance in this kind of very elegant, beautiful way.
I missed the schmuck insurance.
That was at $100, though. What would you, I actually started hearing from people that I know very well who don't often invest, who are now asking me if this is the time to invest.
Buy the schmuck insurance now.
Here's the thing. This is now a confidence game, right? There is no real utility in this. This is a fantastic, fundamental hedge and store of value against autocratic regimes and banking infrastructure that we know is corrosive to how the world needs to work properly. You cannot have central banks infinitely printing currency. You cannot have folks with, misguided and misdirected monetary and fiscal policy.
We've done okay.
You just called it a confidence game, which is a con game.
And we've done okay. The economy's built on central banks and built on fiat currencies, where you said yourself how much better life is in every respect than it's ever been, and that's with that as a infrastructure.
So we've seen the first few chapters of this, and now we have to go through this great unwind, right? When all this liquidity now, what happens?
We'll see what happens.
We'll see what happens. And so all I'm saying is to have the ability to hedge that out in a way that isn't fundamentally correlated to the people and the infrastructure that made those decisions that we were not a part of fundamentally, I think is a smart thing.
But the point is, if you haven't jumped on this bus or train or whatever vehicle you want to describe it as, has it left the station?
No. So here's what I would say. The same way that I said in 2013, put 1% of your net worth into Bitcoin, I will put myself out there today. I think this thing is $100,000 a coin, probably in the next 3 to 4 years. And I think it is, in the next 20 years, $1 million a coin. So there you have it.
You're telling people to put 1% of your net worth.
At the time.
That's for.
It's a lot harder.
But that's for people who have money to play with. I mean, if you're talking to an average retail investor who's looking at this, somebody who's trying to figure out, should I put it in my 401k or should I put it in Bitcoin, you would tell them what?
Well, I don't think that's the actual trade-off. In your 401k, so for example, in your IRA,
I'm saying that there are people who have to make decisions about these things who aren't fully invested in the 401k.
So what I'm saying is I own a lot of Bitcoin in my IRA. It is possible. So I did take a small percentage and I put it in there. All I'm saying is there's a small percentage of everyone's net worth.
In the most tax-advantaged way.
Absolutely.
But you have money to play with.
No, but what I'm saying is you could buy the S&P 500 index, buy 99% of that. So if you have $100 to invest, what I'm saying is
put $1.
Put $1. And the reason that $1 is so valuable is that it is fundamentally not correlated to the other 99. And just on the off chance that all the people that manage the 99 may not totally know what they're doing, the $1 may actually save us all.
Okay. We are going to be spending a lot more time with you and talking to you on so many other topics as well, and I'm sure we'll come back to Bitcoin too, so thank you.
Thank you.
All of your Fed worship, we found out today, has been misplaced because Chamath, our guest host, says you should sell, based on the Fed's and other central bankers' unbelievable missteps, you should sell everything and buy Bitcoin.
Because it's been so bad so far.
That's what I said. That the world
Right?
is.
I mean, the dollar crashed like all the Fed critics thought it was going to happen, and inflation
Well, I might have started something
surged
between you.
like all these
I passed it off now.
If the past was an absolute perfect judge of the future, we'd be all set.
You didn't, Chamath, I set up a straw man. You didn't say sell everything and put it in Bitcoin.
I actually didn't say that.
He didn't say
I
that.
said
But
take
what
1%.
Chamath did say
But
was,
I'm still willing to argue with him, whatever he said.
I know you are. You're always right. But if there's just slightest chance that these guys are somewhat conflicted or clueless or not, or have different irons in the fire for the way they manage currency, you should have something that isn't affected by all that. That's not correlated with what central bankers is. Have I got that right?
I think that's basically right. I think you have to basically have a what if the sky falls strategy in any time.
And the unwind is something you're worried about.
The unwind, let's face it.
We don't know what Bitcoin correlates or doesn't correlate with, right? Let's go back to 2008 when we thought there were differences in correlations in asset values, and what we found out in 2008 was, as Jackson Brown sang, in the fury of the final hour, that it's a great line. It's a great line. It really describes the financial crisis. In any event, when that happened, all correlations went to 1, right? So we don't know what Bitcoin's correlations really are.
When I mean correlation, what I'm talking about is, at the end of the day, this is a string of letters and numbers that was generated on a computer that sits in a secure wallet. It truly is, in the functional utility of the world, uncorrelated to anything. It is an idea, and it is a belief system, and that may scare people.
Here's a question.
But that's really what it is.
Its correlation is determined by those who hold it, though, relative to their other assets.
Do you have any anxiety that its current rise is correlated to a market bubble, meaning that it reflects that there's just too much money sloshing around, and people have so much money that they're looking for these sort of any opportunity in a way that they might not have 2 and 3 and 4 years ago?
I think bubbles happen when there's a scale of importance. And I think it's very unfair to look at a market that's still measured in the few tens of billions of dollars and call it A, a market to begin with, and then B, that there's a speculative bubble. Maybe that can happen from time to time at such small scale. I think what's more likely is that there's just an overwhelming number of people who literally don't even know what Bitcoin is.
Right.
And then there's a very, very small number of people who are at the periphery looky-looing, having opinions, but have never even bothered to read the definitions.
That's a good phrase.
Have never bothered to open in a wallet, have never bothered to even read the Wikipedia article, but they want to correlate it to a framework they understand because it's safe. And what I would say is, I would suspend disbelief, which is what I did in 2012. It took me 18 months to understand. And I'm reasonably technical. And so what I would say is, other people, if they took the time, may come to a very different conclusion than what is the obvious negative Nelly conclusion.
I think it would be really elegant if the bubble itself helped create the answer to what caused the bubble. In other words, the central bank
bubble.
I completely agree with you.
That would be a real, in the way the universe works, that would be interesting.
Because then you'd really see whether the emperor had clothes or did not.
See, there is a bubble from all the money sloshing around.
That's the real bubble.
Bitcoin is the answer to the profligate
Hold on. I thought the market was up on the Trump economy.
I'm not necessarily talking about just...
Hold on. You can't have it both ways. It can't be a bubble if it's the Trump economy with fundamentals underneath it. I'm just giving you a hard time, Joe, because...
Talking more about a bond bubble.
Well, bond bubble, but also, this is an unusual time where all assets seem to be inflated to a higher degree. And the question is whether or not the Fed has inflated this. When you look at what's happened to the money supply, a lot of this extra liquidity in bank or excess reserves has not been converted or created into either loans or money, Joe. So the idea that somehow there is this froth or bubble in the system from the Fed is a little bit negated by the idea that it's not been turned into money.
It's the bond bubble. The stock market, I would say, on a price to earnings basis is not in bubble territory.
Can I just?
Do you think the stock market's in? I don't think.
I don't know. I don't think about the stock market, but let me just.
I don't think so.
It's the underlying earnings that this is based on.
The Fed is reducing its balance sheet, and it has plans to reduce its balance sheet. You would think that in that case, the market would price in the forward plans of the Federal Reserve in that time period. Long paper has declined in yield.
That's because it's a global bond market now. There's central bankers headed the
Or
opposite
maybe there's
direction.
tremendous underlying demand for long-dated risk assets, and it's not a bubble.
I mean, at the yields in which they offer, I just don't think that really is true.
But people are going out every day and buying in this market, not at gunpoint from the government, right? You could almost make an argument that we have a deficit of long-dated paper that the market desires.
That's because in Japan you get 50 cents a year on $1,000.
Whatever the reason, private hands are going in and they're buying this stuff and they're holding on to it.
Okay. Welcome back, everybody. Let's get back to our guest host, Chamath Palihapitiya. He is Social Capital founder, also Golden State Warriors co-owner. And Chamath, the last time you were with us, you said something that got us thinking, that Amazon was a monopoly. Now, I know you didn't mean it the same way, but we just heard last week that Lee Cooperman said he was having dinner with President Trump, and he asked him twice if Amazon was a monopoly.
Yeah, let me talk to you about what I was trying to say there, which is it is what I think about as a natural product monopoly. What does that mean? You build something, and when it starts to work, what happens is the usage tells you what the trail of breadcrumbs is you should follow. So what Amazon has done elegantly is they've built a product that has such fantastic product market fit. They watch how people use it, and then they actually use that to distill what to do next. And what to do next becomes slightly easier and easier every turn and every time they do it. And so what you have, for example, this year, if anybody went to Amazon reInvent, which is your annual developer conference, 50, 60 odd thousand people flooded into Las Vegas. They overflowed multiple casinos, multiple grand ballrooms in order to even so you flew there just to watch it remote. And what you saw were tens upon tens upon tens of critical features that they had done in a year. And when you take a step back and say, wait a minute, the totality of what they did is unbelievable. And then you think they did that in a year? And then they did that at a velocity that you could imagine, at a scale and an impact? And then you think to yourself, well, what is next year going to look like? And by the way, the things that they did probably wiped out about $2 billion of equity value of VCs putting money into ideas that frankly made no sense in the first place.
Because they jumped ahead of all of
They
it.
tried to jump ahead and not really think through the implications of an Amazon. And so that to me is what I think about as a natural product monopoly. It is a thing that now compounds every day slightly a little bit faster than the day before. It's by no means a market monopoly, because there are other alternatives. There's Google, there's Microsoft, in China you have Alibaba and Tencent, etc. But it is a thing now that, in my opinion, just continues to run. And every year gets a little bit cheaper, gets a little bit more complete, and more things are available to you. It's an incredible thing.
The president comes from a place of populism, and his idea on the campaign trail and now even in office has been that sometimes big is just too big, and we can't allow that much power in the hands of a select group of people. And that's not just Amazon, but that's all of Silicon Valley that could be targeted as a result.
I mean, when you think about Amazon, they employ now, I think, more than 500,000 people. They employ, frankly, more vets than some of these companies have employees. They are doing all the right things, I think. They are about to open a second headquarters. I suspect you'll see it in a, red or purple state. Texas, maybe Michigan. And so on every dimension, they are, from a corporate responsibility perspective, acting well.
But again, I'm shifting from just Amazon to saying Facebook, Google, all of the tech darlings that for so long were kind of given carte blanche and we said we need to help them build up because, I remember covering the internet back in 1999, and there was not going to be the internet tax on any of these things because we wanted these companies to flourish.
We made a claim, and I think that it worked for a very long time, that we are different, and as a result, we can self-regulate. Right. And I think people are waking up to a world that is slightly different from that, which is, hey, wait a minute, we shouldn't have special exceptions. We should probably treat all kinds of businesses the same, independent of how you do it. And in that, there is probably more governmental involvement than less over time in all of these industries and in all of these businesses. And I think we should just rationalize it, be prepared for it. And also, we should take a step back and say, what is the other responsible thing? Joe talked about the inequity. Should we not maybe do things in a slightly different way? It may mean 2, 3, 4, 5% impact to earnings. Is that okay? And what I would tell you is, when you have business models that generate 60, 70, 80% profits, yeah, it is okay. It is okay to actually only make 55% versus 60% and have 25,000 more employees. It's okay.
Well, particularly if you're trying to stave off regulation that could strangle some of that anyway.
Or frankly, you actually, if you want to displace the actual inequity that you viscerally feel is a problem in the first place. So tech companies have this mechanism and a capability to do a broad set of things, to employ people fully, to pay them well, to give them benefits, to do that all over the world. It doesn't always have to be cheaper, faster, better.
It's easy to say that, though. Can you imagine trying to deliver that message to shareholders? We've seen it with Walmart.
You know,
they've actually come out and said they were going to pay higher than minimum wage.
You know, when I set up Social Capital, I took a step back and I said, how do I want to define what success looks like? There's progress, there's impact. And one of the things that we said is we want our businesses by 2045 to be employing 10 million people. And the reason we said that was that is the tip of the spear that says, hey, some different kind of full employment is going to be necessary. It's not all about making money. It's not all about doing it in the simplest way and impacting the most people. It's also by pulling through people.
So, okay, but come back to Amazon for just a second. If Jeff Bezos were sitting at this table with us right now, he would say progress is getting the package to you quicker, for cheaper, and frankly, if we could avoid human beings actually having to lift the boxes, go through the street, that those are the kinds of jobs that we actually we'd love to upgrade them to do something else, that is progress. Do you agree with that? And I hope I'm not putting words in his mouth, but he's talked about this idea of what progress looks like, and that you don't necessarily want people doing certain types of jobs that, frankly, would want to get away from.
So I think Warren Buffett has actually had the most clarifying thoughts on this, which is when he contrasts, America in 1917 versus America in 2017, and you think about the agrarian economy we lived in, and then the advent of the tractor and what that did. It wasn't that the inventor of the tractor all of a sudden said, hey, wait a minute, I'm going to basically be your salvation. It was the government, it was the social infrastructure, it was a path to education, it was a path to a GI Bill, it was all of these other things that allowed people to reclaim a sense of self and a sense of identity in doing a different thing. And so I think I agree with the first two things that probably Jeff would say. I'm not sure that he would say the third thing, but I do think that he and CEOs like him who are thoughtful and honorable will go out of their way to be slightly less efficient for the sake of bringing more people along. And I think that is the right thing to do. He employs more people than any other tech company.
Right, but part of what he would say is by doing it cheaper, by doing it faster, since that's the spear. If you do it that way, then you're going to be more successful, so you can employ more people.
In one hand, and on the other hand, you're finding different ways of creating different kinds of jobs that do all of the things that you need to do.
Chamath is our guest host. He'll be with us for the rest.
Die IoT-Eco-Structure-Lösungen sind das Rückgrat des Energiemanagements über ein von Schneider Electric digitalisiertes Micro-Smart Grid. Jedes Jahr knapp 1 Million Kilowattstunden ein.
To the program.
Our guest host this morning, Chamath Palihapitiya, is the founder of Social Capital, never one to hold back, so let's not. You mentioned at the top of this hour that you had some short ideas, some things that maybe you're not going long on, you're betting against.
So I mean, in our public equities business, what we do is we alpha short. So we don't short to hedge because we don't really charge fees. We just make profits on the back end. And so we always look at companies and say, are there companies that are just fundamentally either misguided or misallocating capital? Or have they just gotten over their ski tips, or are they just fundamentally misunderstood? And one of the best spaces where I think you can find some really interesting companies is in sort of this machine learning AI. Now, you have to take a longer term view, but there is just so much activity happening at Facebook, Google, Microsoft, Amazon, amongst what are called, technically, these companies are called hyperscalers. In China, at Baidu and Tencent, where everybody is rolling their own chips.
Right.
Then you have companies like Grok, which we can talk about in a second, which is just an absolute revolutionary approach to chip design, an order of magnitude improvement to all of that stuff. And so what you're seeing is an expansion of a market. You're going into a multi-vendor environment, right? But today there's only one vendor, and that vendor is in NVIDIA, and then that stock is now a $200 stock. It's a $120 billion market cap, a fantastic company. And you have to ask oneself, what has happened to Intel when all of these big monolithic companies get into the game is you crush margin, you crush vendor diversity, and things get very difficult. What happens in the world of machine learning and artificial intelligence? And I suspect that that will happen. And so it's one of these areas that while we, as an organization, are baking some really interesting private companies, we're looking at the public markets and kind of scratching our heads and asking ourselves, this entire ecosystem
so
may be a
let's
little
put
ahead of their
up, can we put up NVIDIA on the screen? I mean, this has been one of the great darlings.
Oh, absolutely.
Of the stock market over the past, say, 24 months. It's just been on a rocket ship of a ride. You're looking at it right there. What do you think it's worth in reality then?
I think you have to ask yourself, in 3 to 4 years, when AI really hits its scale, how are the tasks done and where is the task running in terms of the hardware? And what we know is that it will never be a single vendor environment in 3 to 4 years. We know that conclusively. And we also know that these big companies need to own AI as fully as possible. We've seen it play out at Google. They own their own chips called TPU. They're building these FPGAs. You know, Amazon just released the ability to access that at the raw bare metal level. What do you think these companies are going to do? They're not going to go over and say, hey, just sell it to me at whatever margin you like.
You have the same, how do you think of the other chip makers? And I'm thinking, by the way, Broadcom, Qualcomm,
great
in
question.
the news right now.
Great question. So,
given the merger proposal.
This is all trending to commodity. So in the absence of some fundamental technical innovation and leap, I think what we're going to see is a flattened market. It's going to be thin margins. It's going to be high velocity, high volume. And so you have to sort of plan that into what your business model looks like. And the problem is the existing incumbents, I don't think are well prepared.
So you short the whole space?
What I would do, quite honestly, and this is what I will do, is once we land the next major technical release of our chip, once I know what the performance characteristics look like, which we know is an order of magnitude better than anything else, then I know that that product is going to work.
What do you think about Intel and Brian Krzanich? Because they bought Mobileye. They're trying to pursue sort of a big data strategy of collecting all of this stuff from the cloud. You're smiling and laughing. I think we're going to get a comment like the way you did about Watson at IBM in about a moment.
You know, I have a lot of friends at IBM, and I have a lot of friends at Intel, so I will not say what I said there, but here's what I will say. Intel is going through what I think everybody else will go through, which is you have a processor. It kind of works. It's kind of semi-useful. And then all of a sudden, these big guys get you into a room and say, I'm Amazon. I have this much demand. I have Google. I have this much demand. I have Facebook. I'm Tencent. I'm Baba. Here's the price I'm willing to pay. Choose or don't choose. And if you don't choose, I'm going to go and spin up ARM, or I'm going to go roll my own. And you've seen how that plays out. Massive amounts of capacity, massive amounts of capability that Intel can't actually deploy. They, over time, will become a contract manufacturer for others. They will look like Foxconn for others. That is not a great business from where they are. And so this is a 15 to 20-year trend that is going to play out for them, but they are the canary in the coal mine for how other folks, in the absence of something truly revolutionary technically, that's the path that everyone else will go down.
Why can't they just hire the R&D guys to come up with new things, with new innovations? Are you saying there is no more? Is it Moore's law that there is no more innovation to come?
No, it's that when these innovations get baked now, there are folks like us, a vibrant ecosystem of investors who can get behind them and fund them to completion. You know, I have billions of dollars that I can deploy behind Grok to make sure that they are a vibrant, long-living public business.
So explain to me how Amazon and all these guys aren't monopolies if they can then determine whether an Intel, a Dow component, can actually compete and survive. If you say, I'm so big that you're going to either work with me or I'm going to take my business elsewhere and crush you.
Because it's one of many businesses that Intel is in. My point is, you're taking the most high-value business and you're going to erode margins there, which means that will they be profitable? Sure. Will they be large? Sure. But it's not going to be where they are, and so this company will get re-rated. NVIDIA will get re-rated. It is just a thing that'll happen. So we're debating market cap. I don't think we're debating viability.
Okay, different company, Tesla. Where do you land right now?
We are massively long the convertible bonds. Why the convertible bonds? Again, it's the safest and the surest way to basically bet on Elon Musk, who I just fundamentally think is the most important entrepreneur of our generation.
But you don't like the equity. You don't like the stock.
The equity represents tremendous volatility. I mean, if you put it on the screen, you can see it right there. And for our risk management, for the way that I want my capital and my partner's capital run, what I want is a mechanism to get 95% of the upside, 0 of the downside. And literally the bonds give you that. And so, you know, there's no need for me to sort of step out there, try to be a risk cowboy to prove something that we don't have to prove, because Elon has said to the entire world, hey, listen, you can buy the naked equity or take this other thing, which gives you 95% of it and no downside.
What's a coupon?
When we bought it, it was yielding 5%.
What's it now?
Now it's close to zero.
Well, what's the premium over conversion?
No, we bought it at like 87 cents.
Would you still buy it at close to zero?
Yeah, because you get the downside protection.
Separate question. If he was willing to sell you a piece of the boring company, this is the tunneling company, which may be boring to some people, but I think it's pretty exciting.
I think it's really exciting.
You'd buy it?
Look, here's the
Would
thing.
you buy?
This is what, absolutely. Look, here's the thing with this guy. I've known him for a long time. He is truly putting every single dollar where his mouth is. The guy is trying to make us an interplanetary species, get us off of oil, reduce traffic. And this is where I don't understand when people like Chanos come out and say, you know what, this company is a fraud, I don't understand what he's talking about. There's nothing fraudulent about this guy. There's nothing fraudulent about the technology. This is just like people wanting to dance on failure, and I just don't get it.
Can they call that? Is there a call provision for the converts?
We own the ability to convert at a certain convert price.
Can he call it? He can't. Because there'd be a force. You'd have to.
Yeah.
You could force it. Really? You sure? There's no.
Yeah. No, Joe.
There's no call.
It's an amazing instrument. It's an amazing instrument.
Let me ask you this. We happen to both be in agreement about Elon Musk. However, over time, every time he's put out some type of expectation about sales of those vehicles, they rarely, if ever, hit them. In fact, they seem to disappoint routinely. So I think when part of the Chanos story is he puts out these grand projections, oftentimes raises money on the back of them, and then doesn't hit the number.
Here's what Jim Chanos and everybody else needs to appreciate. Building revolutionary things is hard, okay? You don't just walk in and invent the iPhone. There's complexity there. You don't just come in and invent Facebook. There's tremendous complexity. And so you got to think about this in years, and even though we force companies like that to boil them down to quarters, it doesn't work.
And Chamath, we haven't gotten a chance to talk to you about your role as an NBA owner. Yesterday, Roger Goodell was here on the set talking about the kneeling controversy, what that has meant for football. And as an NBA owner, what's your take? How should teams approach this? How should the league approach it?
Can I before I answer that as an owner, can I answer it as a colored man?
Sure.
I've gotten pulled over by the police, just driving. I don't think it's their fault. I think it's sort of just the part of the milieu we live in. I've gotten on planes where I know that people feel uncomfortable because their initial reaction is, oh, there's a kind of brown bearded guy on the plane. I felt that. And so what I think that is worth realizing is that all different kinds of people can feel different versions of those things in the natural course of life. And when some of those people want to reflect that and then have a dialogue about it, I think the first thing you have to do is, quite honestly, take a step back and say, where are they coming from? And then, is this the right place, and how should it happen? What I can tell you is that I think as an owner, I think Adam Silver has done an unbelievable job. I think the players in the NBA are incredible because they have a point of view. They believe, and I agree with them, they've earned the right to be able to start a conversation, see what LeBron does, Chris Paul does, Steph. And I just wish that the NFL kind of embraced it in a little bit of a different way. The reality is, you know, you're putting 52 men on the field, wrapped in metal to bang each other up, and then to monetize that in a 50-odd, 100-odd, whatever billion-dollar enterprise. Those are a key part of the system, and if they want to reflect some frustrations that exist, these are true things that exist in the world, you have to enable a discussion, and that frustrates me just as a man. And as an owner, I would just say that I'm just really glad that I'm part of an organization that has enabled a very different kind of conversation.
To be fair, the NBA has the benefit of going second. They got to see what the NFL kind of stumbled through along the way.
I also think Adam as a person, though, is just a really empathetic, smart guy.
The way of doing it, where you say the players have earned a right to express their feelings and let their voice be heard, is there a way to do that and not politicize it, to have it in a position where you're going to potentially alienate some of your fan base, too, to say maybe not during the national anthem?
Yeah, there probably is. And I think like if they had kind of like gotten everybody together much sooner, then it wouldn't have become such a divisive, polarizing issue. Because then everybody then, again, in the modern world we live in, is forced to go to their corner, and now there is just absolutely no backtracking. Nobody can backtrack. The owners can't backtrack in the NFL, the players can't backtrack in the NFL. Then you have these weird mixture of like, oh, well, let's compromise by only doing it in the, in the...
Or not showing up, staying in the locker room in between.
So this is all part and parcel of even how we started talking in the morning. It's just, this is the kind of stuff where in a different era, we would have just figured it out in a different way. And we don't, it's not set up well for that right now.
We asked Roger Goodell yesterday about Colin Kaepernick, someone who used to play on a team where you
in San Francisco,
exactly. Yeah. And we asked him straight up, do you think he's being blackballed by the owners? What do you think? Yeah.
I mean, isn't it obvious? I mean, the guy went from a very, very legitimate player to probably a pretty legitimate backup to he cannot get a job.
Although, is that necessarily blackballing, or is it every owner saying, wait a second, I don't want to bring the controversy into my house?
Yeah, you're right. It may not be as organized. There may not be a WhatsApp group where they're organizing how to do this. I get that. But the outcome is the same, which is a legitimate human being who has credible athletic ability, who at one point was probably a top 3 or 4 QB at some point in the league, who probably has a functional role to play, can never get that job again. It's pretty clear. And so it's an unfortunate
Do you think there's
situation.
an owner, potentially even next season, who would take a chance on him right now?
I'm not sure. I don't know. And to be quite honest with you, like, football, quite honestly, I haven't watched it in 4 years. It's just so past the, I just can't look at these guys beating themselves up. It really, the sport frustrates me. It's slow, quite honestly. I love basketball. It's incredible. The teams are amazing. The people are amazing. They're well run. Long live the NBA.
All right, Chamath is our guest host. He's going to be with us for the rest of the hour.
He lives in San Francisco. It's been tough year to watch the 49ers, too.
I mean, oh my gosh.
I'm from Cincinnati.
Chad is trying his best, but oh my
I'm from Cincinnati, so, I mean.
Oh my gosh.
Feel the pain?
Wow.
There's a lot of oh my goshing.
Apple. What'd you say about Apple? You said Apple is no longer a tech company, but then you changed that a little bit?
Well, I mean, I think what it is sort of like it's in this migration to being a really interesting software business and a luxury good business. And it's trying to figure out how to navigate that and how to manage the brand and how to manage, how to sell $1,000 devices that have certain capabilities. But when you take a step back and actually like look at that phone and compare it to a Pixel or the next generation Samsung, what you see is frankly the same product. And so what it has is brand. It has a sense of differentiation. And that's no different than Louis Vuitton or any other luxury good that you're willing to pay a premium for that may not really bear the cost of it if you look at the actual raw materials that go into it. And so they're going to have to make a really interesting transition because they're going to have to figure out how to land more of these iPhone 10s where, people like us are willing to pay $1,000, but what does that leave behind? And I think what it leaves behind is a market that's going to get consolidated even more by folks like Xiaomi or Samsung on the low end.
So it's a $1 trillion company, probably.
It definitely bleeds into that category because now you're just talking about, another 12 or 15% accretion from where they are. But, the question has always been like, what do you do with all this money? What do you do with this scale? And especially
leave it in Ireland, I think, too.
Unfortunately, so far that's all they've done. And if you repatriate it, what should they be buying, if anything? I mean, I still think Tesla, Netflix, these are the businesses that Apple should be in the business of owning, just because it has so much operational leverage for them.
Do you think they will? Meaning once the tax policy shifts?
No. I think that they have funded, look, I mean, they've spent more on their building, quite honestly, than they have in any sort of major feature or product launch. So this is
talking that it's something between $1 billion and $5 billion.
I think it was a $10 billion campus or something. I mean, look, the point, they probably spent more to figure out how to curve the glass than, So they're at a point in time where I think they're being stewards. They need a generational transition where now people that are a little bit further divorced from the Steve Jobs legacy can take over those businesses. And then you'll either see it flounder or just completely go nuclear in a rocket ship. And we need that moment to come at some point.
How do you judge Tim Cook's leadership then?
Oh, I think he's been a great steward. But I think he's operated, like I said, again, as an outsider just looking at it, as not wanting to push the envelope too much by accidentally denigrating Steve's legacy.
But what do you
Probably the right thing to do in that situation.
Yeah, and frankly, like, you look at Microsoft, it's roughly the same thing where Ballmer tried the best he could. Now, slightly different circumstances, obviously, and then you needed a transition to someone like Satya.
I think that Tim
Look
Cook
at the
would
business.
say, look at the stock price, look at the market share, look at the revenue produced over the last.
None of those things I take away. What I'm saying is, has there been visionary product leadership? And I think what instead they've done is they've managed a business well that has been given to them.
Chamath, love having you here. Thank you.
Thanks,
very
guys.
much.
Did you know Geico could save you hundreds on car insurance and more? So what are you waiting for? Captain Ahab to help you find a parking spot?
There she blows! Whoop! Loading zone, darn it. To the northern lots where there be spaces as big as whales!
Geico.
Great to see you.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.
Chamath, Balhapatiya, thanks for sitting down for Fort Knox and Squawk Alley and all the various things that we do.
I'm like a CNBC brand aficionado.
Yeah, we just got more brands every day. So a lot of people, certainly the CNBC viewer, is familiar with what you do, but explain it for the average run-of-the-mill person who's interested in business and companies.
I think the way that I think about it is there are really two kinds of companies now in the world. There are the disruptors, and then there are the disrupted. And increasingly, it's really crucial to be able to understand who the disruptors are, and then also the implications of what they're building so that you understand how to fix the disrupted. And the reason why I think that's important is that, too often now we go to the lowest common denominator of this like dystopian world where the robots and the cyborgs all have jobs and the rest of us are kind of, trundling from one random task to another. And it doesn't have to be that way. And so for me, what I'm trying to build is an organization that invests in some of these disruptive technologies, but channels them in productive ways, that creates new classes of jobs, that allows people to be trained in those jobs, that allows us to have an economically vibrant fabric, but at the same time learns from those companies that would otherwise be considered part of the disrupted class, and to help them, frankly, be more sustainable.
How's it going?
I would say that it's early days. When I left Facebook in 2011 to start Social Capital, I actually drew myself a 50-year plan. And
50 years.
50 years. I was kind of, I was in my mid-30s at the time, and I said, well, knock on wood, with good health care and good health, I'll be productive into my 80s and 90s, hopefully.
Had you ever drawn yourself like a 15-year plan when you got out of college that took you through 30? Because
to be honest with you,
Facebook didn't exist.
No,
I don't see how you
I didn't even have a 15-minute plan. But I had the benefit of the ability to sort of really map out what I wanted to do with my life on my own terms. And that's the first time I'd really ever had that. The way that I grew up, it was not that. I was very much chasing and living very day to day, frankly. And so I thought I just wanted to be around things that I thought were so secular in nature that when you look back on them decades from now, they would seem obvious. And then I wanted to be around those things. And so when I drew this plan up for myself, I said the first step is building the capability of creating a lot of these disruptive technologies or identifying them or being around them. And to me, that was probably going to take the first 15 years of this 50-year plan.
Just to be able to identify them?
Just to get good at it, to become repeatable at it. It's like anything else, right? It's like if you take professional sports, like the people that are the best are the ones that practice at it and divorce the result from the practice and the act. Because the actual product of scoring happens in all kinds of random ways, but the act of purposeful practice and preparation is what gets you to that moment.
You say that like a partial owner of the Garden State Warriors.
Exactly. I do say that way. And
how is that? I mean, is that something that you knew before watching how Steph Curry and others practice, or something, knowledge that has deepened by being up close to that organization?
Yeah, it's a great question. I think it's very much the latter. It's, people want very crisp, clean narratives to describe really grandiose things that happen in the world, whether it's winning championships or whether it's starting and building great companies. And the actual facts underneath are much more complicated and nuanced. There's all kinds of tension, physical, emotional, mental, that go into creating something excellent. And so, like I said, the first goal was be good at one thing, which is to identify and incubate and nurture disruptive technologies. What I would say is actually, I gave myself a 15-year target, and I think that in the first 7 years, we've come to a place where I have high confidence that we know how to do that. And so now, in many ways, the next chapter starts. And in chapter 2...
Does that mean you did it in twice the time you expected?
In half the time, yeah. I thought it would be like a 15-year thing, and I think, by year 7, I think we have a good handle on how to do that part of the business. And so in many ways now chapter 2 has started. And in chapter 2, what it's about is now being able to take those technologies and apply them constructively to change markets for the better, but at the same time, take all the knowledge that you learn from them and apply it to some of the legacy businesses and see if you can't improve those as well. And the reason why that's important is I think like true knowledge will come from understanding both sets of companies. Meaning, sometimes people want to be very dismissive of how things have been done. And in other cases, people want to be very dismissive of new ways of doing things. Mm-hmm. Neither are the way that you have maximal impact and success. So what I mean by that is there are many things that, when I was at Facebook that we did that were pioneering. But frankly, there were many things that we did that were just copies of things that were tried, tested, and true. And so acknowledging the fact that the nuances of doing anything great will rely on both sets of information and knowledge. And so for me, now what I'm trying to do is say, okay, on the one hand, can we build the next great chip for machine learning? Yes. But on the other hand, can we actually help a company that employs hundreds of thousands of people in the world how to leverage that technology to keep those employees fully employed? That's a great challenge. And I think the answer to those questions will allow us to both profit from being at the seat of creating these disruptive technologies, but frankly also making sure that they're allocated in humane and ethical ways.
It sounds like you're saying you've isolated the genetic code, the DNA for disruption, in a sense. And is that what gave you, correct me where I'm oversimplifying, and is that what gave you the confidence to take social capital public, in essence, and say, okay, we can now do this at scale for lots of different types of companies?
Yeah, in many ways, yes. I mean, look, a lot of this, frankly, is a rehash of the things that we did at Facebook. And what my team and I did there, at its very simplest essence, was collect lots of data. We were able to invalidate a lot of lore and anecdote and replace it with fact-based decision-making. Mm-hmm. Unemotional, nominally, reasonably sounding decisions.
Sounds simple, but Twitter can't seem to do it.
And to your point, it's a very hard thing to do because emotions and ego can be a really destructive force inside of companies, especially when the social capital of an organization is built up on gut-level decision-making. This idea that you went off someplace and you had a vision. People always talk about these visions. People are described as visionaries. And in reality, what the best people, at least that I've seen that have changed the world, have done is just quietly iterated. But that's not, again, an elegant narrative that society likes. Society wants to hear about a pithy antidote or one very precise intuition on something that turned out to be massively right.
It reminds me of that scene in The Princess Bride with the iocane powder, right? Like, when not to spoil, I don't know if it's a spoiler at this point, but basically building up an immunity over time to iocane is what really allows you to win.
Yeah. So I just think that we're in these situations where, particularly in technology, because so few people really understand it, they want to believe in this idea of divine intervention, and it's just not true. And so a lot of our success at Facebook was about the diligence of working every day. Again, back to the process, the practice, not the outcome. And so when I started this organization, a lot of it was about rebuilding that kind of infrastructure and that capability to have very unemotional, fact-based decision-making. And so how that manifests is that whenever we invest in a company or we have an idea about starting a company, we try to implement tools and systems that allow us to understand what's really happening on the ground, meaning the actual atomic level data that the business is generating while it's trying to do whatever it's trying to do. So for example, my family's riddled with diabetes. And so myself and 2 other people started a diabetes business 7 years ago that helps large populations manage the disease. And how we think about its success is actually the data from the glucometers themselves. And when you have it, what it allows us to do is realize that you can predict when somebody's about to have a hypo or hyperglycemic event. And with those insights, then you can now have a nurse, a diabetes educator, an endocrinologist, an entire support system within a hospital intervene on behalf of the patient and make sure that they don't suffer from the debilitating effects of diabetes. That wasn't divine intervention. That's just being able to collect ground truth data, being able to apply, in that case, all kinds of interesting machine learning, then being able to take that and productize it and then sell it into an organization who desperately wanted a solution, and just keep chipping away and chipping away and chipping away. And that took 7 years, and that company almost went out of business, but now, it manages 1.2 million patients' lives. And I saw that in a board deck just this past week, and I thought to myself, my dad died of the disease. So I started it in large part in reaction to a helplessness that I felt around my whole family. 11 of my 17 aunts and uncles have it. Amputations, glaucoma, the whole thing. And so, my dad isn't here, but I think to myself, is there a kid like me who has a dad like him who maybe now at the edges is probably closer to living than dying? That feels really great. And how we got to that point was not, going to the top of a mountain and coming up with some, idea that just came to us. It was just chipping away, chipping away, chipping away in an uncelebrated manner. But having the discipline and the commitment to keep doing it.
You immigrated to Canada at age 6, was it?
6, yeah.
From Sri Lanka.
Yeah.
Tell me about your family of origin and the story. How did you guys end up moving to Canada?
My father came from a pretty intellectual class of writers and thinkers, but economically not successful. And Sri Lanka is a predominantly Buddhist country, 90-some-odd% Buddhist, but very much like India in every other way. A very deeply entrenched caste-based system, a lot of hierarchy. My mom came from a much more commercially successful family, and they met late in life in their mid-30s, which doesn't sound late in life, but you can imagine in the 60s in Southeast Asia, that's not what people do. They got married in their early 20s, quite honestly. In any event, they got married. My mom was a nurse. My dad was a civil servant, and my mom's brother helped get my dad relocated to work at the High Commission in Canada.
Was that controversial at all, their relationship at that age and being from different backgrounds?
Yeah, it's so funny. I've never actually told anyone this, but I found out subsequently after my father died, he had been married once before, all this stuff that I'd never known. So I don't know the complexity of his life, quite honestly. Again, in that culture, it's not those aren't things were never shared with you.
Right.
So what little I knew of him was, preceding getting married to my mom was just a very headstrong, willful person who largely sacrificed his education and his path in favor of his brother, who went to college, became a lawyer, who then they became quite estranged. In any event, so my dad was
younger brother?
Older brother.
Older brother.
Yeah, and my dad was whip smart guy. But in any event, he, through the benefit of a relationship with my mom's brother, got stationed in Ottawa, Ontario, Canada, working for the High Commission there. And we all went over, myself and my sister, and then we had another sister born in Canada. And then we were there for the full duration of his tenure. But in that, the civil war between the Buddhist majority, us, and the Tamil Hindu minority really, really escalated. And during that period, we filed for refugee status to stay in Canada because we just didn't feel like it was safe for my father particularly to return.
Right.
And part of the reason was in this really weird kind of twist of fate, not only was the Sinhalese majority fighting the Tamil Hindu minority, they were also fighting an extreme nationalist wing of the Buddhists who also felt like there should be zero tolerance of this insurrection. And so if you were caught in the middle, you were being attacked by both sides.
Wow.
And so Canada accepted us as refugees, and and then it's a kind of a pretty typical hardscrabble story at that. I mean, I'm sure many others. So by no means did I have the worst of it, but you do what you need to do. My mom became a housekeeper. She never really became a nurse. She became a nurse's aide eventually. My dad kind of stumbled from job to job, worked at a photocopy store, sold encyclopedias, sold vacuum cleaners, just did whatever they tried to kind of survive, and then basically told me and my two sisters, like, hey, you better, get your shit together because there's no soft landing here.
Did you internalize that at the time? I mean, so many children of immigrant families do, and absolutely focus in on studies and saying, hey, my parents sacrificed all this for me. I can see it up close.
Well, I mean, like it wasn't the words, it's the actions, and it's not just the good actions, but it's the negative actions. My dad became pretty dependent on alcohol. It became a way to kind of like deaden the pain, I think lessen his frustration, but that also created really turbulent life inside the house, and so you had to be really vigilant and aware of what was happening at all times. Those are the negative things. The positive things were that, they would find money for music lessons, and it's like, how did they do that in hindsight? I don't know, but like I learned to play the piano, I learned to play the violin. They exposed us to art and to culture. But to do that when you're sort of like, living on welfare, it's like, that takes a unique personality. It takes a unique kind of vision. So I felt that, I didn't have a bedroom. I didn't have a bed. I had a mattress, and we used to keep it in the closet of the kind of like the hallway, and I used to take it out, sleep in the living room, put it back, And it comes in stark contrast to where I went to school, because like by high school, I was going to the best high school that was a public school called Lisgar Collegiate in Ottawa. And everybody that went there was, quote unquote rich in Canadian standards, successful, stable families. And so I was hyper aware.
Was it in a way that made you uncomfortable, or had you internalized so much your uniqueness and what you had set out to do that it didn't matter?
Yeah, less about how maybe special I was, but I wanted what they had, not in a zero-sum way where I wasn't. I didn't begrudge them the lives that they were living, but I just wanted it as well. Like we never went on vacations. We never learned to do some of the things that cost money, skiing or whatever. And that was fine with me, but I wanted to understand what that was like, and I wanted to be around it if I could, and mostly because you kind of want what you don't have.
Sure.
But I never put that back on my parents. I mean, because I knew that it was visible, like they were grinding, and they had their own sets of issues, and so I was like, you know what, like I'll just try to take care of this for myself when I have a chance.
What was your escape? What your favorite subject, favorite activity that you really threw yourself into?
No, I mean, to be honest, like, I ran a little casino during the lunch hour because all these little rich kids, wanted to play blackjack. It was pretty obvious that you made more money being the house, and so I was the house. You could bet anywhere from 25 cents or 50 cents to $1. So I'd take that money during the week, and I would kind of go to these charity casinos and play blackjack. And I was a card counter back then, and so I'd be spinning up my money. I was working at Burger King at the time too. And I mean, listen, like, I mean, I'd love to tell you I was a good kid, but I was kind of like, I was a little shady. Like, Burger King, I'd figured out what everything on the menu cost with tax. And you'd have at least 10% of the population, most people don't know this, who live an extremely precise life where when they come and they're like, I'd like a Whopper combo, and you say $5.12. They literally take out $5.12. And so all you need to do is be in cahoots with the guy in the back for him to make the Whopper. And you don't put it in the till. So like we would come up with all these little things because like at the edges, it would just make us feel a little bit more like empowered, like an extra $5 made a difference for us back then. So that's kind of like the kid I was. I was kind of like, not that great in school, reasonably clever when it came to like risk and, things like card counting. Math, I was quite good. And just kind of trundling along. And then the riots in Los Angeles happened, and that was a huge moment in my life.
1991, 1990.
Yeah, it would have been 91.
Yeah.
Rodney King riots, and this is why it's so great to be Canadian. You know, nothing happened in California. Nothing happened in America, you know. But in Canada, we took notice, and in Ontario, the government said, any minority kid who can get a job, we will subsidize and pay for. Let's get these kids working. And so I applied for a job through this program. It was called Jobs Ontario Youth, JOY, Joy. And you know, typically what would happen is they would place you at like a Kmart or Sears or something, and I said no. And my dad had been applying for jobs his whole life, and he had literally like a huge binder of like hundreds of rejection letters, and just started at the first one. I started calling them and I said, listen, there's this thing called Jobs Ontario Youth, and you know, it helps minority kids get jobs, and you know, you don't have to pay anything, and I'm a hardworking kid, and I'm smart. And someone said, okay. And so I got a job at a place called Newbridge Networks, which is a high-flying telecommunications company. Mm-hmm. And you know, it was kind of like a test of my will because it was across town, and it literally, I mean, now I sound like a cliche. It took an hour and a half by bus to get there. But it really did. I mean, it really did take an hour and a half. And so I was just grinding this job. And
did that grow you up?
Getting paid $10 an hour.
Yeah.
And it grew me up because, you know, I met this guy who lived maybe about 2 miles away, but in a much nicer part of town, who was the controller of Newbridge. And he could see that I was struggling to take the bus every day, and he stopped one day, and he was like, "Here, come on, I'll give you a ride." He drove me for like that whole summer, and so like I would just listen to this guy, and it's like, wow, this guy was amazing. His name was Sam Lake. I was like, man, this guy is like, this is a real person. And then when you're around the success of that place, because it was a kind of high-flying telco stock back in the 90s, and you'd see all of this wealth being created and people driving around and BMWs and stuff, and you're like, oh my God, what is all of this about? And so that's when I kind of got clued into, you know, there's an escape here in technology that could be really profound. And so I should be paying attention. And so I took a couple computer science classes as a result in high school. Never really stuck. Like, I was just not that low level. Like, I tried to get in the weeds and write code, and I was okay. I wasn't great by any means. And frankly, I didn't have a passion for it. But I had a passion then for what it meant to build companies like that, because it sounded quite interesting to me.
You're studying the science of disruption now, but it's interesting to me. You come from the land of the disrupted in a way, right around where BlackBerry, you know, grew big. And then you went to work for AOL early in your career, running Instant Messenger, which is now dying. Yeah. I mean, it's like officially being end of life, right? At the end of this year.
Yeah.
Did you learn anything in particular from being in those places that, you know, in retrospect?
Yeah, everything. I mean, everything that I think I apply in success, I learned in failure or hardship. You know, the problem with like success is that it's so easy to conflate luck and skill. You don't really know whether it was you, whether it was timing, whether it's the moment. And then unfortunately, that stuff is really corrosive because it gets into your mind, it drives your ego, and it defines, you know, your sense of self-worth in a way that's just not sustainable or accurate. Whereas in failure, what happens is you just like, you're basically like at zero. And you have to really unpack what was you, what was the moment, and then you have a really, if you decide to do it, have these moments of clarity where you can really figure out what your powers are and what you're really good at and where you can affect change in an otherwise difficult circumstance. And when you internalize that, you become really powerful.
When did you do that for Chamath, and how did you end up at Facebook?
Well, you know, that period, so, I mean, after I graduated from college, I actually took a very traditional job. I was a derivatives trader. I had kind of, even though I went through electrical engineering, I had kind of, you know, managed to get that job. And the reason I liked that job, again, it kind of like, it played on my desire to take risk and, you know, quote unquote, gamble. Although I realized later on that this, you know, calculated decision making and gambling look really similar. on the outside in, even though they're not the same thing. But I had to leave that job because I just felt like I was going to get trapped by money.
Trapped by money.
Trapped by money. Because I was poor and I needed the job and I needed the money. And then I needed their perspective on what making a lot of money meant and all of the encumbrances that it came with respect to your behavior, your personality, with respect to sort of like the things you can do and can't do. I would have just become a slave in a gilded cage. And I didn't want that. I wanted to be emancipated. I wanted to like find my own path to like be able to like not have to be a subject of the man. And working at a bank just didn't seem that path for me. So I moved to Silicon Valley and I worked for a small company that AOL had bought called Winamp.
I remember Winamp.
And that was like, it was crazy because it was at a moment in time where it was part of the AOL Music Group. AOL was trying to get a very complicated merger with Time Warner done. There was all this antitrust scrutiny around the music space, and so we were handcuffed. There was many things we couldn't do. Then separately, there were all these things that we tried to do. So nobody knows this, but like we created the first 99-cent download store, and we were able to do it because we had all these credit cards on file from all of the customers of AOL, and it performed beautifully. But then when you try to go to the powers that be within the AOL infrastructure and convince them to launch a 99-cent download store, they all said no for political reasons. So you deal with this failure. None of it made any sense, but then you become really resilient, and then you figure out how to get great ideas to win and how to get great ideas to market because you wanted them to win.
I thought for a moment you were going to say you become really resentful, but you said resilient.
No, honestly, like I'm pretty much like, I'm not a bitter person. Like, there's like, it's just like, we all have like 90 years. Okay, let's just say, plus or minus, God bless us that we all live 90 years. But take 90 years and divide it by, that's the numerator. The denominator is the length of the universe, which is what? Some odd trillion years? So like, this is us. So I just don't have time to be bitter. I like life is just too short to be like glass half full. Or glass half empty, whatever it is. I'm kind
half
of
a glass of anything. It's too short.
Like I'm just like, hey man, there's water in that glass. I'm going to drink it. And so I just want to do it and go for it. And I just like I'm blessed by not having that mental baggage. So yeah, I didn't get resentful. I got more resilient. I got more creative. I tried to figure out different ways of telling my story. I became a great communicator. Because I needed to divorce myself from the emotion, from the politics. I tried to present facts. I became great at the time of like, telling narratives, understanding true sort of like consumer desire. Because
how do you practice that?
Well, in the moment, I was able to practice it because I was looking at the data of what the product we were trying to build and then trying to articulate it to the powers that be and, kind of chip away at all kinds of reasons to say no. And it's never happened. And then, I remember getting this call in 2000, and I think it was 3 or 4, where somebody said, Steve Jobs just launched a 99-cent download store. And I was like,
well, there you go.
That's just brutal. But it was in that process that I just got really good at just trying to figure out what mattered and then try to tell people the truth.
So in retrospect, this experience of failure, you never did get them to run with what was a great idea.
Yeah.
You've internalized as a learning exercise that taught you to be a much better communicator.
Communicator, motivator, how to sort of like lead versus do, how to manage through adversity. Yeah, it was a great training ground. AOL was an amazing training ground. The other thing that I had, which is much more practical, is I had a mentor. And a person who took me under his wing. His name is Kevin Conroy. He runs a big swath of MGM now. And he kicked my ass. I mean, up and down every day. That was when I was so afraid of him. I used to keep my phone by my bedside. And he'd just call at 6 in the morning, 9 a.m. Eastern, but it's 6 a.m. Pacific. And I just like trained myself. And I could pick up that phone at 6 in the morning, deep in sleep, and I was so coherent. Or at least I thought I was. But he taught me how to think, how to be disciplined, how to market. And then, in return for my loyalty, I think, and reasonable work done, he gave me a shot. And that's what a lot of people need, is just a shot. And I got a shot, and that's when he promoted me to run AIM and ICQ. And, I was in my late 20s.
27.
And 26, 27. And he's like, go. And, for the 18 months that I had control of that thing, I tried to do the best I can before I left for Facebook.
I was going to say, meanwhile, in a dorm room at Harvard. So how did you end up at Facebook?
I had known a guy who was at the time the founding president, Sean Parker. And Parker and I had known each other in the kind of that 2000 to 2005 or 6 timeframe.
When you got to Silicon Valley?
Yeah. He was running a business called Napster when I was at Winamp. We were all in the same circles. None of us had made it, right? And he brought Mark and himself to Washington, D.C., where AOL was headquartered, Dulles, Virginia, actually, just outside Washington, D.C. Had a meeting with them. And I went and I told Jim Bankoff, I remember this, who now runs Vox Media, but at the time ran AOL's audience business. I said, we should really try to buy this company. And, Bankoff said, there's just, no chance in hell we can buy this business.
Because?
Just the capitalization structure of AOL Time Warner at the time, and, just the downward pressure on the stock. And it was a very turbulent time. People were getting fired all the time. There was a lot of management churn. And so in that moment, he and then Kevin said, look, see if there's an operating deal to be done. And we did a deal where we integrated Facebook and AIM together. And then very quickly thereafter, Sean exited Facebook, and Mark called me to unwind the deal. And at the end of that process, he said, you should really think about working here. And then I kind of met the other senior guys, and I said, yeah, let's take a shot. And,
why? Because you hadn't ever worked for a really small outfit before. I mean, you went into this prestigious technology company in Canada and cut your teeth there. I mean, yet you were doing derivatives trading for a bank, decided, it was going to eat your soul, so you wouldn't continue to work there, but it was big. You ended up at AOL, which was huge at the time. What gave you the guts to go with this little company run by this I mean, maybe he wasn't a teenager anymore, but just barely.
I think he was 19.
Yeah.
I don't know.
Gut decision? One of the few that works out?
No, actually, it was about risk management. I remember thinking to myself, I had left AOL at the time, and I'd been recruited to work at a venture firm, Mayfield. And I was getting paid what felt to me like all the money in the world at the time. I'm happy to tell you, $250,000 a year, huge amount of money for me. This was like line of sight to, getting completely out of student debt, getting my parents completely sort of like into a situation where they could afford a house, help subsidizing some of my sisters. And I had been, half my paycheck every year until that every year was going back to my family. So it's not like I even was able to celebrate any of the trappings of anything, because take my salary, divide it by 2 for taxes, then divide it by 2 again, and that was my effective salary. So in any event, I remember thinking to myself, okay, well, here's what my expected value is at Mayfield over the next 5 years. And I said, what is the distribution of outcomes at Facebook? And I basically, most of the scenarios were less than it. But there were a few scenarios where I could make a case that it could be equivalent to what I would make at Mayfield over a 4-year period, and in a very, very small number of cases where it would be in excess. And I said, okay, the mathematical answer is that it's probably easier to just stay where I am. And then I said to myself, but if I can go there, and if this thing does fail, so meaning the outcome is in one of those kind of like equivalent or worse situations, what will I still have? And what I said to myself was, I will have met some of the smartest people in the world, and I'll be in the game. And I will have learned something about myself, of whether I can do something at a really early stage scale, and whether can I do this on my own? Am I sort of like, have I been trained now, and am I ready to execute? And so I took the shot for most of those reasons. And what was funny at the time was I actually had an offer, or somebody was recruiting me to be CEO of a business.
What kind of business?
It's like some internet business. I can't even quite honestly remember. I just remember like getting called, thinking to myself, wow, maybe I could be like, the chief versus the Indian. And but when I spent time with the team at Facebook, I was like, wow, this is kind of like fun, and nobody knows what they're doing. And I thought that's probably a place where like I can
learn something. And so
even if it fails.
Even if
so
it
maybe
fails.
the lesson from the whole Winamp.
In collaboration with USF Health, Tampa General Medical Group, and private practice physicians, Tampa General Hospital was one.
Elon Musk has been talking about it. We'll tell you what's going on with Musk and Bitcoin. Plus, a major winter storm pounding the Northeast, and that's the true word to use. 100 million people in its path. We've got a live report. You could see 2 feet of snow in New York City. And as we go to break...
Please don't demonetize me for that song.
You'd have to look to see if there's manipulation. And manipulation is really a term of art that the Supreme Court defined 40 or 50 years ago. And it really means rigged trades. So in other words, you'd have to have coordinated trading where the back and forth results in no risk to the people who are driving up the price. And at least from what I've seen in the news, there does not yet appear to be evidence of that. The other convention.
Thank you for saying this. I miss rushing this tweet. I mistyped Tesla. How could I mistype the Tesla symbol? Folks, I'm sorry to keep asking you to go to Twitter. I gotta ask for new retweets. Maybe delete the other thing. Well, I deleted thing. Maybe you could delete too. I am so sorry. I had a typo on the ticker. That's so horrible. God, I feel like an idiot. How do I screw that? How do I screw up the ticker symbol? So I can't even blame anything. I'm just the idiot. So I'm retweeting them right now. I am such a freaking moron. Thank you to whoever pointed that out. I am so sorry. I made you to retweet something with the wrong ticker. I didn't put the $sign in, but now it is correct. So embarrassing. So embarrassing.
Issue and sell more shares as quickly. Is that something that the SEC should consider making?
Yeah, I need a beer after that one. That's like you're applying for a job and you misspell the company you're applying for. Foot and mouth, man.
The volatility.
Yeah, but you've always got to be careful about issuing emergency orders. Back in the last financial crisis, there was
I'm getting beat up today, man. The options getting burned, the misspelling tweets. God, what? Freaking Monday. You know what? That's what it is, Monday.
There are going to be a lot of unintended consequences. And so while proposals along those lines may well be something worth looking at, I think they need to be given both careful consideration.
Okay, GME bounce, guys. GME bounce. Look at this. We got a little bounce here off 212. We're coming back for the tendies. Come on. Bring the money back. Bring it back. Let's go. Let's see how this pushes. Volume, by the way. Let's look at volume. Higher than usual. Usually we're an average of, I would say, 60 to 120 in vol. And right now, right here during the sell, I mean, we had volume at 400, 300, 387,000, 200,000. I mean, the volume right here, massive volume right here. Very, very, very big volume here. Wow, Paul Norden drops $100 to say, been watching you and learning from the entire for the entire pandemic. Thanks for all the incredible content. Thank you. Unbelievable. Okay, so a little bit of a push down again here. Thank you again, Paul. That's very, very generous. Okay, so what else do we have here? Cost 39%. Fizz, another shorted stock. Let's go ahead and pull that up on the Bloom really quick here. Where's Citrix? I'm sorry, S3 Partners. Let's go ahead and pull. Oops. Come on. Here we go. Let's go ahead and pull up. What was the ticker I was just talking about? Kevin, what's my problem? I need another cup of coffee. Fizz. Let's look at Fizz's short. FIZZ short on Fizz, flat at 62%. So I'm not sure if that just means they haven't updated it, but they do seem to be pretty up to date with their research here. So what's winning right now? Who's winning? Who's the jerk winning right now? So silver's still pushing up. GoPro. Look at GoPro move. GoPro was up on Friday as well. Look at that. Social Capital, IPOE up again, 9.5%. Here's that Property Solutions acquisition. This is the another EV SPAC, Churchill, Workhorse, all these guys up today. Redfin up 3%, down from its highs around the 80s. Tesla at 814. Glad we bought that option at when we bought it at 800. Let's go ahead and see if I'm making any money on that option. Okay. The Tesla calls right now are up a bit. I'll show you here. Hold on one sec. Let's hop on over. Let me show you the Tesla attendees. Okay, here's the Tesla option. I'm making up for the diamond hands on GameStop. Making up for the diamond hands right now. With the Tesla calls up about 11K. I will go ahead and hide that for a second. Let's go ahead and see what we've got. If we've got anything at Fox Business. We haven't checked into Bloomberg TV in a bit either. We'll go ahead and do that in just a moment.
And it's recouped almost all of Friday's loss. So a nice bounce there for Microsoft. Yes, I do own a thin sliver thereof. All right. Now let's get to the weather, and specifically the snowstorm, which is absolutely pummeling.
We not now. We need to know about the attendees. Man, I feel beat up right now, honestly. Let's listen to Bloomberg. Okay. I don't hear anything. You know, oh, that would help. Oh, here we go. That's a problem. Oh, of course. Duh. Hold on. Sorry. On the phone. Trying to darn input.
Is reporting earnings on the 11th, so we're going to avoid is reporting earnings on the 11th, so we're going to avoid any questions about supply and demand and the reopening outlook. So, Lynn, the reopening outlook. So, and it's great to get you on the program. Thank you, Alex. Congratulations on a deal that surprised many people as a different way of getting money and not going to the equity market.
So, folks, look at this. GameStop sinks as short interest drops. Retail looks elsewhere. Folks, we broke that. We broke that together on this channel. Nobody was talking about that until we pointed it out. I feel like, I don't know, maybe other people saw it. I'm sure other people saw it. But I feel like we broke that. Oh, thank you, Agent Adam. That is a really nice thing for you to say. I appreciate you. Very nice. If you guys are new to this channel, Meet Kevin genuinely wants you to succeed. I want all of y'all to succeed. That's really what I want. I don't trust S3. They were saying over the weekend short interest doubled without having their calculations done. Can you get a citation for that? I want to hear that. Nano Dimension, 63%, even though, okay, let's see, it's all FUD stuff. Well, I mean, Ian, maybe it is. I was just looking at the data, right? Look at this. Shout out to another Bloomberg terminal user here, Mateo. Thank you. Appreciate you. Thank you. All right, let's go to the short interest on Nano Dimension. Let's find it. Let's see here. Nano Dimension. Nano Dimension. NNDM. Okay. So short interest on Nano Dimension, 7.66% based on S3. So a little bit, it does always make me curious why they sometimes have different data coming up. It is definitely interesting. Okay, let's listen into this talk here on silver for a moment.
Of gains. David, back to you.
Thank you, Mike. Mike Santoli. Well, after the break, don't miss it. We're going to have an exclusive with the CEO of Charter Communications, Tom Rutledge. We'll be right back.
Charter? I don't care about that. Do we care about that? I don't know.
Changes in the latest iPhone operating system update that now will ask users for permission to allow apps like Facebook.
This is big, okay?
On the internet.
Listen to what I'm about to say. It's really important. Last time we did these live streams, there was literally not a channel that wasn't covering what GameStop was doing. They're still covering it, but there's a lot of other talk going on right now. Keep that in mind. Peak media. Very, 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 very important for the GameStop run. Right now, we are down 27% on the GameStop. The market is down 27%. We've got the candle slightly moving back down. Does this mean, oh, here we go. Varney's back.
Director Larry Kudlow.
Oh, no.
He's with us these days, and he's on the show shortly. And again, I'm sorry to do this to you folks. And all you
yes, dude, I keep muting you every time you talk about the snow. It's beautiful. I mean, honestly, like, I'd like a little bit of a change of weather. But anyway, let's go to the sticks. Going to the sticks. Folks, I want to know this. Where is support? Where is the support? We don't have it today. We don't have it today. There's no support today. It's just down. And it sucks. Yeah, we had a bounce off 212, but you can't tell me that's support. That's not support. That's a bounce. But we had the same crap here, which is where we decided it'd be a brilliant idea to buy an option in the dip. Look at what that did for us. 28%. All right, what else we got? We got First Majestic. Look at this. Folks, the money right now, it's moving into IPOE. We've been watching this happen all morning on. It's moving. Yeah, wrong dip. Thanks. Thank you. I realize that now. Pay attention to this, though. It would not look if people start selling out of GameStop stock, they could be going back to the SPACs. Hashtag back to the SPAC. That's tweetable. Is that tweetable? I think that's tweetable. What's Bloomberg saying? Jick. Oh, this is actually this is an energy play. This is a SPAC play. Let's listen to this for a second.
Pursuing that vision.
Let's listen to this.
Lynn, what are you expecting from the Biden administration? What are you expecting from the EPA?
This is big.
You know Michael Regan pretty
all
well.
You traders.
What are you expecting from him?
As I look at the new administration and certainly the actions and conversation that's been going on, the president cares deeply about climate. We care deeply about climate. And I believe we come to this conversation with a strong vision, a lot of alignment on what is going to be necessary over this decade and beyond. And I see in some of the president's remarks his understanding of the magnitude of this transition, his commitment to a just transition, his commitment to research and development. And so we're anxious to work with the new administration and with Secretary Regan in his new role.
I guess the question then becomes how. You might be a but maybe not how we get there. I'm thinking about things like carbon taxes.
All right, folks, new poll. If the GME play slows, will we go back to the SPAC? I want to hear your thoughts on this, okay? At RealMeatKevin on Twitter. Thank you for the 290 of you who retweeted the ARC tweet. Freaking idiot Kevin here can't even spell check, moron. Is the squeeze being squoze? 42% of you going to Webull. And 33% of you actually going to TD or Fidelity. That's a big move over to TD or Fidelity. You know what this is a sign of? This is a sign of a lot of people being frustrated about the commission-free model that potentially means substantially poorer order flow, right? That's not good. That's not good for Robinhood. Certainly, I have a referral link if you do want to try to or sign up for Webull. You go to metkevin.com/Webull or metkevin.com/M1. You'll get at least $21 at Webull and at least $30 at M1 Finance if you deposit $100. This trust level has actually declined. I think we're down to 9.5% of you can say that Robinhood can be trusted again. And look at this. Are the days of the 40 to 50% swings over for GME? 41% of you saying yes, 58% of you saying no. However, could we see 40% down today? We will see. Social Capital, steady around 10 to 11% up, a little closer to 11%. GameStop, 28% down. Trying to bounce here. Trying to pick up off these little bounces here. But we're seeing pain. Here's a SPAC, folks. Here's QuantumScape selling off. Nano Dimension, 3%. Beyond Meat. Well, Beyond Meat had a nice run here. They a little sell-off there is healthy. Neo, a little sell-off there is good. Enphase, selling off again. It's a really good company to buy. Shift Technology. One of those days, that'll be a breakout stock. One of these days. I'll say that until I'm like 50. It was like Lemonade. I'm telling you, Lemonade was like 4 months of one day it's going to go up. And people are like, Kevin, you've lost your mind. I pitched that stock like every day in the course at $49. I'm like, you just got to keep buying it. It's at $149 now. So I did well, but still, sometimes it's painful holding in the meantime. Silver steady. Let's go ahead and I want to say something about Acorns here. Let's listen to this, though.
Have you doubled the number in the last couple of days, something like that?
Yeah, we're at almost 9 million accounts. So from Tuesday to Wednesday, we doubled, and from Wednesday to Thursday, we doubled. But the thing to know about Acorns is that you cannot trade on Acorns. And I asked the question, why short a stock if you can invest in the entire American economy, which is what Acorns helps you do. Like, we invest your money into diversified portfolios of thousands of stocks and bonds automatically for you.
Okay. So let's get that real clear. You don't go to Acorn to trade on a daily basis. You don't trade GameStop and all the rest of them. You come to Acorn to put spare change, small amounts of money, into your pre-selected portfolios. Have I got that right?
You got that exactly right. And the thinking is go long on America, invest in America, invest in your future, do it across the entire American economy in diversified portfolios, and invest small amounts of money over time so you build a much better life for yourself and your family.
You think the other guys, the guys who are day trading on these other platforms, are they going to lose their shirts eventually?
Well, I think about it like this. Like, if you talk to your money manager, right, and you say, I'm going to buy this stock or this option or do this exotic bet, your money manager will say to you every time, that's fine, but do it with less than 10% of your money. With the rest, the 90% of your money, put it long-term, go long, diversify, invest in ETFs. And that's what we help you do. And that's really how you should think about your money. It's okay to make risky short-term bets, but when you're thinking about your life, your future, and your family, go long.
All right. How do you make money?
We charge a simple subscription price. So it's either $1 a month, $3 a month, or $5 a month. It's totally transparent. It's clear. Obviously, we believe that if you're not charging a price, the customer is the product.
Oh, slam on Robinhood. Slam on Robinhood.
And that gets me a free choice of which portfolio within Acorns that I want to invest in. And there's no further charge. I don't pay to get into that particular fund. It's just $1, $2, $3, $5, $10 a month. That's it, right?
That's right. That's right. For $5 a month, you get an investment account with a diversified.
I'm going to say, folks, I want to say this about Acorns. Actually, I'll tell you in a second my opinion on Acorns, okay? It's very important. Very important.
Bank account that helps you save and invest more when you spend. And everything with Acorns comes back to helping you save and invest for the long term.
Got it. No wonder you're doing well. We appreciate you being with us, Noah. Good stuff.
Okay. Listen, this is my take on Acorns. I was one of the, and I'm not trying to like take credit for this, or maybe I am. I was one of the first. I'm pretty sure I was the first person on YouTube to bag on Acorns for this, and it's very, very important. What Acorns does. Hold on, let me order some coffee. Hi, Lauren. Could I burden you for a cup of coffee? So, listen to this on Acorns, okay? Then we're going to go back to the sticks here. Acorns takes your purchases. Let's say you spend $5.10. They take the 90 cents, they round up, and they invest it into, these long funds. Obviously, you can invest your money into those long funds as well. The individual who was just speaking is entirely correct. You should always invest in Train America. Invest in the future by hodling long, right? Abso-freaking-lutely. But you know what's bad? When you associate investing with spending. It is the stupidest, dumbest, worst thing you can do. The last thing I want to train my brain to do is every time I go to the store. Look at that. Hold on. You ever seen this one? Hold on. Is it going to focus? Come on. Focus. Focus. Look at that. Palladium card. JP Morgan Reserve card. It makes nice sounds. I like that. Compare Palladium Robinhood card. Pathetic. I had to do that. Okay. No, but seriously, when you associate investing with spending money, you will spend yourself to oblivion subconsciously. It's a terrible idea. Horrible idea. Psychologically, it pisses me off so much. It is the last thing I can encourage. I'm sorry. Let's get back to GameStop. Okay, so Tesla at 812. Let's look at the sticks here. Okay, we are at 28% down on GameStop. We're okay. Are we getting a shelf here? Technical analysis, folks. Somebody please tell me, are we getting support here? Or what are we doing here? What still going diamond hands here. I have a 1K order that isn't being initiated at lower prices. Frustrating. Do I sleep? Sometimes. No, I do, but I need to sleep more. E-Trade not putting orders in and putting users into limbo when they canceled. I canceled the trade only to find out it went through a peak today. Ay. Jeez. Silver is a diversion. I believe that silver is, I agree with that. I think there is a little bit of diversion going on with the silver squeeze. Silver is also a lot harder to squeeze. Absolutely agree with you. Bad Instincts says that Shift is Kevin's personal pump and dump. Well, I always respect criticism. I disagree with you because it is not a company that I have any intentions of selling. It's a company that I plan to continue nibbling into, and when my position 4 to 5x's, I will hold that thing because I do not want to pay the taxes that I will have to pay. But in my opinion, undervalued. So look, I'll gladly give airtime to people who are mad at me too. Fundamentally, Shift undervalued. Wade Nolan, I don't know why, but YouTube hid you saying that. Thoughts on Peter Schiff? I think he's a great guy. He obviously has substantially different opinions on a few things from me. There are many things I agree with him and many things I disagree with him on. If you want a little bit more of my perspective on what I think about what Peter Schiff says, look up Meet Kevin, Joe Rogan, Peter Schiff. That's a good one. Obviously, because in my podcast interview with him, I didn't add too much of my own opinions because when you're interviewing a guest, I can ask pointed questions, but I can't come from an angle of burning somebody from ever wanting to come back on a show, right? So what else do we got? Cost down almost 40%. Look at this. Palantir sell-off has continued, by the way. Trying to push back up in the day here, but the sell-off continues on Palantir. If we get sub 30 again on Palantir, that could be very interesting. DocuSign 226. I really like DocuSign under $200 a share. Let's see. All right, what other news do we have here? Let's go look at Bloomberg. Let's see what they're saying. What do they got over here?
Last week, we're up by around 1.2% on the stock 600, but silver.
Silver's up. Okay. You're just going to freeze on saying that. All right, whatever. Unresponsive. Joke. All right. Anyway, I'll just reload that really quick. So Bloomberg TV. Okay, let's look at the polls really quick. I want to see this last poll that we did. So we just did a poll, and a lot of you voted on this last poll. Let's go ahead and scroll up. I'm going to refresh here. Let's see what we got. Let's see what the latest insight is. So the latest poll. Wow, look at this. 59.2% of you saying diamond hands. Diamond handing it.
9%. So we're not seeing quite, but GameStop was halted. Now it's back trading again. We're going to keep you up to speed on all of this. That's volatility, folks. Left-hand side of the screen. That's what's happening right now. We'll update it throughout the rest of the show. And now this.
What is it? What?
The big story is still GameStop and the short squeeze. The state of play, here it is. GameStop is down. The other short squeeze stocks are volatile, perhaps not quite as volatile last week, but we're really seeing some big-time price movements just in the last few minutes. Robinhood restricted trading in 8 stocks. It only allows the purchase of 1 GameStop stock through Robinhood. That appears to have calmed the volatility, at least for now, but I tell you, that volatility is beginning to pick up again. It may have calmed the contagion early in the trading session. That is the spillover effect from investors selling assets to make good the losses in the short squeeze. But right now we see the Dow only with a gain of, 50-odd points. That's all we've got for the Dow. The S&P has narrowed its gain to just 22 points, but we're still seeing a solid move up for the NASDAQ, which is a better than 1% gain as we speak, right about 1% up. Now look at silver, spiking close to $30 an ounce, $28.65. It was almost $29.90 in the last hour. This precious metal is now part of the short squeeze action. There is political action this morning. President Biden meets 10 Republican senators at the White House. The Republicans
Thanks for the follow,
have
Evan.
scaled down
Appreciate
COVID
it.
rescue plan worth what? $600 billion, way below President's demand for $1.9 trillion. I'll call this a test of unity and compromise, which I think is highly unlikely when the Republican plan calls for smaller checks and less help for the schools. Bernie Sanders on the left will have none of that. The third hour of Varney and Company continues.
All right, let's go ahead and get back to the sticks here. Let's see what we've got going on at the sticks. So I want to say that was a really good summary, by the way, from Varney there. He's right. The volatility is insane on a GME right now. Oh, wait. Listen to this. Larry Kudlow's on.
The Fox family, Larry Kudlow.
What's up, Larry?
Thank
Larry?
you, Stu. Appreciate it very much. Great opportunity. Very exciting for me.
I could say what took you so long, but I know. All right, Larry, let's get straight at it, shall we? The White House will look into GameStop, the buying and selling craze around GameStop. Do you think the government should intervene?
I do not. I absolutely do not. I don't mind looking into it, whatever that means, but I don't really see what the issues are. I don't want to see more federal government regulations of these markets. I mean, it just seems to me, if I try to look at this whole story from beginning to now, I guess the issue is a lot of people are angry at Robinhood for ending or stopping trading in a lot of these penny stocks or limiting. But, you know, it's hard to blame Robinhood. They have capital calls to worry about. I mean, the volume and the price increases were so large. This is not about selling. This is about buying. And the clearinghouses demanded that Robinhood put up more good collateral, I think $3 billion. So they had to stop because they couldn't clear. They couldn't settle, whether it's one-day settlement or three-day settlement. Now, that's not so unusual. You get some volatility in the short run. Other brokerage firms are doing it and have done it in the past. So I'm not sure what the issue is. As you know very well, they needed more capital. Sequoia Capital, I think, put in $1 billion. Others may have put in money to help Robinhood. Robinhood, I think, looked to me like prudently. If there are issues here, let the exchanges deal with the issues, okay? Let the private exchanges deal with the issues. I don't want the federal government mucking around with a lot of crazy class warfare. And by the way, Stu, consider this. I'll ask you this question. Is it possible that these stimulus checks have been used to invest in penny stocks? A lot of rumors about that. I've heard it from my pals on Wall Street. That is not what was intended. I mean, it's a free country. You want to buy a penny stock, but do we really want more stimulus to go into more penny stocks? I have my doubts. But in any event, I'm not sure what the problem is here. It may be a solution in search of a problem as far as the government goes.
Well, it could be a new factor in the market, which is the organized retail investor with a phone and access to social media, organizing, coordinating an attack, if you like, or maybe the promotion of something. But this may be a new factor in the market. I don't think it's going away, Larry.
No, not going away.
Well, look, I welcome more and more people owning shares. I mean, personally, Stu, I'm a believer in buying the indexes and holding them forever. Okay, that's my view. A lot of people disagree with that. But the investor class can grow. It's about 51% of Americans. Over 100 million people own stocks. If you've got millennials and others coming in for the first time, I say fine. I have my doubts about this organized business. I just have my doubts about that. Maybe I'm wrong. I don't mind the social media. I mean, my problem with the social media is censoring conservative opinions. That's my problem. And I think there has to be some federal changes there, particularly the liability shield 230 on the FCC Act. But putting all that aside, different topic. So fine, more people come into the market. By the way, you learn from the school of hard knocks, prices go up and they go down.
Yeah. Yeah, the University of Hard Knocks. We all go through it at some point, and that's a fact. Back to this
yes.
1.9 trillion stimulus, $600 billion stimulus. I suspect that the market would love 1.9 trillion, all that money flowing into the economy, but I don't think you like it at all. Would you have any stimulus of any kind?
Huge shout out, Freddie. Thank you.
I don't like it at all. I don't know, by the way, if the market loves this stuff. I think that you had the $900 billion package in late December, okay, which gave assistance to unemployment, which I favored, gave assistance to small businesses, the PPP, which I favored, and gave assistance to schools and, health and security and vaccines and therapies and so forth, which I favor. So targeted assistance sounds very good to me. The Democratic package is neither targeted nor real assistance. I mean, you've got things like a federal minimum wage, which is crazy. It would hurt the poorest. It would hurt African Americans and other minority groups. That just makes no sense whatsoever. Do you need a new package now? I don't know. Remember this, though. In macroeconomic terms, as a supply sider, I would say this. Number one, more and more government spending is a tax on the economy. And those taxes may reappear before the end of this year. After all, President Biden campaigned on, taxing rich people, taxing corporations, taxing businesses. That is not healthy for the economy or stocks or capital formation or investors. And secondly, more spending means more regulation. We're already seeing an outburst of regulatory actions by the new administration. I think those are going to damage growth and hurt the whole business climate. So I would say to Wall Street folks, or so-called investor folks, I'm not so sure you really want. You may think you want it, but you may not really want it when you see the fine print and the ultimate consequences of higher taxes and regulation. This economy, Stu, is in pretty good shape. Let's go there, right?
Is.
I mean, everyone tells me there's an economic crisis. There is not an economic crisis.
Larry's the stock pumper. We don't need stimulus.
A lockdown in California and New York. The rest of the economy basically is a V-shaped recovery. Sorry, I know it's your show. I'm sorry.
No.
Always the V with him.
No. Guess what, Larry? You're not in the White House any longer. You're back in the world of hard breaks where we have to go to a commercial or we don't make any money. So I've got to cut you off. I can't believe I am cutting off Larry Kudlow, but we're going to see a lot of you on this network and we're going to love it. I know it. Welcome back. Good to see you, man. See you later.
Thank you, Stu.
Wow.
My great pleasure.
I have to say, Larry Kudlow, he's often got the rose-colored glasses on. I think it was throughout the entire pandemic. He's like, nope, V-shape recovery. Don't need stimulus. Targeted's okay, but don't need stimulus. Sometimes I wonder if he's just totally disconnected from the everyday American who's waiting for just some relief. Not even stimulus. It's relief. Absolutely, frustrating, but that's the nature of what's going on. Okay, so what I'm going to do now is I'm going to bring on a guest. I'm going to bring on George Gammon, brilliant, like one of the most brilliant minds that I've seen on YouTube. Does the Rebel Capitalist show where he interviews folks. Got really great perspectives. I want to get his opinion on this GME sell-off. Now, I have not tried ever having I'm using this new platform here to bring someone on, so hopefully it works. Forgive me if we have technical difficulties for a moment. Let's give this a shot. But welcome, George. Great guy. Here we go. Add to stream. Did I do it? You here?
I think so. I think we're ready
That's
to
what
rock.
I was worried about. I
buddy.
can't hear you. Hold on one sec. Darn it. I see you. I can't hear you. Can you all hear him? If you guys can hear him, I might have a solution. Hold on, let's see here. Or is your mic muted? No, it says your mic's on. Let me know if you guys can hear him. Oh, okay. I can fix that. Then I can hear you, George. One sec. I'll pull you up. One sec. I've never done this. Wait, if I pull you up here, it'll echo. So I gotta pull you up here. One sec.
And just FYI, I totally agree with Kevin. Larry Kudlow is completely lost. He's clueless when it comes to the,
all right, folks,
the real
one sec.
economy.
I want to be able to hear George. You talk to him.
Yeah, I am. I'll take the show from here, Kevin. But yeah, he's right. Larry Kudlow and a lot of these politicians and a lot of these economists, they just don't understand that. How often has Larry Kudlow been to Cleveland, Ohio, or Kansas City, Missouri, or someplace in the Midwest where people are really struggling? And it's quite apparent that the real economy is not doing well. It's not a V-shaped recovery. In fact, I'm here in Phoenix, Arizona. I spend most of my time outside the United States, but I've been here for the last 6 months. And I'm very familiar with the area where I'm currently staying. And just when you go down the street, I mean, it was a very, very nice area. It still is to a certain degree, but you see 10 times more homeless people. You don't see that, or you didn't see that when I lived here last. That was like 2007 to 2010. And a lot of the businesses on this main road is called Camelback Road. You guys are familiar with Phoenix. And between like Central and 24th Street, but you go down the road and a lot of the businesses are shut down. They're boarded up. There's homeless people living in the parking lot, and then the only businesses that you see that are booming are the liquor stores and the weed dispensaries. So, and not that I'm all for I'm libertarian, so legalize drugs, but it just goes to show you kind of what's happening right now with the real economy. I think Larry Kudlow's got his head in the clouds, and he's never been to hasn't been to a grocery store in 10 years. He hasn't been to, the Midwest or any of these other areas. He goes from his probably penthouse condominium in Washington, D.C. to where his office is in his limousine, and then hops in his private jet. I mean, when's the last time you went to Smith's or a Circle K or so? It's just it's a total disconnect.
No kidding.
It's like
well, welcome on, George. I'm echoing for myself. Okay, I'm not echoing for you guys, right? I'll be fine.
You sound good.
Welcome on. It's super nice to have you. You can hear me good, George?
Yeah, you sound good.
Oh, perfect. Thank you so much for coming on. I love the hat and the Fed. So tell me a little bit. I want to know. On one hand, you've got an end the Fed hat on. On the other hand, we think Larry Kudlow's got to support the people who need relief. Where do you stand on not only the stimulus, but also the stimulus of the market right now? Getting into some of the GME price action. What's your take on what's going on? And yeah, I mean, we've got a bounce right now. I'm going to pull that up on at least my screen here just for a second. Got a little bit of a bounce. We're now just down 19% on GME. Let's hear what your thoughts are.
Well, you don't see this type of activity at the bottom of a market. I remember in 2009 when the market crashed, there wasn't this enthusiasm, let's say, for short squeezes or day trading or anything like that. So I think I was actually watching your live stream a couple minutes ago when you went in there and you went in with 12 grand or something like that on buying a call option.
That's right.
But no,
you threw me into a frying pan, man.
But it's a great message, though, and this is something that I've been talking about on my channel. It's fun to watch. It's exciting. I think there's a good argument to why you should go out there and battle with the hedge funds in Wall Street. I totally get it, but I think people really need to be careful because you're playing a game of musical chairs, and at some point the music stops, and you don't want to be holding the bag. And I get the whole, well, I'm going to hold to the bottom just to prove a point, but you're really not. In reality, although it may make you feel good, you're really not doing anything to combat Wall Street because most of the hedge funds and the pros, like the guys at the trading desk, JP Morgan and Goldman Sachs, they're playing the volatility. You think they're not just making a killing on this? So it's, I'm all for the movement, but I think it's good that we place it with reality And then we also understand that there's a lot of risk involved when you're trying to just make money on a short squeeze instead of buying the underlying asset for the fundamentals. I think the silver squeeze is a little bit different than GameStop because, well, I think that if you're buying silver, the underlying asset is a little bit more sound than GameStop, especially long term, because the Fed is creating so much money into money supply by monetizing
like an inflation play.
debt. I'm sorry.
Almost like a anti-inflation play for silver.
Yeah, when you've got, I mean, if you've pulled up charts, I'm sure you have because you're awesome with the data and awesome with the charts. But if you look at M2 money supply on like the Fred website, it's just gone parabolic. I mean, there's like 20% more dollar currency units in the domestic economy than there was at the beginning of 2020 before we went into these lockdowns. I mean, just think about that. Through the whole history and all the money, all the dollars that have been created over time. There you go. And the reason that happens is because now the Treasury is selling the debt. They're selling the treasuries at auction to pay for the $4-5 trillion deficits. And in order to do that, to keep the interest rates low, the Fed is basically buying them directly from the Treasury. It's a little bit of a shell game with primary dealer banks, but just to keep it simple, basically the Fed is creating new bank reserves or currency units, what we'll call them, just to buy these directly from the government. So therefore, the government isn't extracting the dollars first before they spend them. So generally with bonds, if the private sector is buying them, they're taking existing dollars, giving them to the government, and the government is just spending those somewhere else, but they're kind of the same dollars, right? Where if the Fed monetizes the debt, those are new dollars that are going out. And personally, I think that's why you see the Fed's balance sheet kind of going vertical, and then you see M2 money supply going vertical as well. So as far as going back to your original question with stimulus, that you got to do a cost benefit analysis. And what's difficult is a lot of times the benefits, they're very apparent. People need money. They're out of jobs. That we talked about that with Larry Kudlow being clueless. But sometimes the costs aren't seen at the beginning, and you really got to think through, okay, what are the costs when it comes to distorting the economy, possibly a misallocation of resources and malinvestment. If you see a lot of people that are maybe speculating and they may lose money, or you could go down there's a list of things that could happen that may negatively impact the economy long term.
Is that kind of like when you say malinvestment, would you say that's sort of like when you see hedge funds getting PPP loans, and it's like the companies who shouldn't be getting this money, getting,
Absolutely.
I mean, millions and millions of dollars?
Yeah, absolutely. And as far as malinvestment directly, let's go back to 2006. Okay, the GFC. We all know about the housing bubble. It's a little easier to understand than what's going on right now. So I just had a comment on one of my videos the other day where someone was talking about wanting to get back at the hedge funds for what they did in the housing bubble. And the example, actually, I think I saw this on Zero Hedge. And the example they're using is this young person was very frustrated because he saw his father set up a concrete business back in like 2005, 2006 to handle all this demand from the housing boom. And then when it crashed, he lost everything. He lost his business, and he had, he's gave the story of having to go through the couch to try to find change just to put gas in the car, put food on the table. It's a really sad story. Terrible. But that's an example of the Fed and the government creating a housing boom. And yes, the hedge funds played a part in there, but they couldn't have done it without the Fed keeping interest rates artificially low and without the government trying to push the Community Reinvestment Act. It all goes back to that, with Barney Frank and Chris Dodd. So this gentleman set up his business, took his life savings and invested. And if there wouldn't have been a housing boom, he would never have done that, right? So that's an example of the Fed creating distortions in the market and malinvestment.
That's interesting. Yeah, so he basically set up shop around a business that was set up on essentially the premise of this housing bubble, and
Exactly.
so here he is thinking he's doing the right thing, lucrative entrepreneur, but he's really getting screwed by the Fed in that case. Now, what do you take? You were the one, at least where I got it from, who called Chamath Chomspak. And, I'm wondering, I ran a little poll on Twitter. Yeah, I ran a little poll on Twitter wondering, are we going to see the comeback of the SPAC? Is the SPAC coming back after the maybe the GME, the GameStop sort of leaves the attention of the markets a little bit? Right now we've got Chamath's IPOE's up 8% right now. Churchill, the rumored Lucid partnership, up 8% today. What's your take on these?
I think it's just like trying to get into a short squeeze. You got to be real careful about what you're doing. And you have to understand that the majority of those SPACs don't do well. And they're incentivized to, let's say, quote unquote, invest that money quickly, because if they don't do it within 2 years, the money's gone. And most of these people, I'm not going to mention any names specifically, but in my opinion, most of them are just all about AUM. They're really not about ROI. And AUM is asset under management, because the more assets under management they can get, they're charging a 2% on that, a 2 and 20, let's say. So they're getting the 2%. So if they raise $1 billion, they're getting 20 million regardless of what happens. And then if they invest in something that's like a high flying tech stock, let's say, then you're getting paid $20 million on a call option, and instead of having a premium. And most people don't realize.
In other words, these SPACs are really just massive profit centers for the organizers, the Bill Ackmans. Yeah. So like, oh yeah, sure, we'll SPAC that.
And the regulation around, Kevin, you can promote them a lot more than you can promote an IPO for actually taking a company public. So it behooves people who are, let's say, a little bit better at sales than they are at investing.
Oh, wow. That's interesting. Yeah. I mean, they say, what is it? Securities are sold, not bought, AKA marketed.
Yeah.
What's your
right.
take on
so
that?
You just got to be careful. It's not to say that all SPACs are bad. It's just to say you got to be real careful. And, I invest, as you know, I invest in real estate outside of the United States extensively. And it's the same thing there. I always say you got to be a local expert. In fact, we were talking about this the other day on my channel. Even in Los Angeles, you got to be a local expert. If you think that you're just going to go in, fly into LA for 2 weeks and buy something off the MLS and make a killing, you're going to get your butt handed to you. And, I think it's the same thing with short squeezes and with SPACs.
So what do you say to somebody who right now is, do me a favor, folks, whoever is in the chat, let's hear some of your thoughts on what kind of gains you have on GameStop right now. GameStop, AMC, maybe post ticker symbol and gains. And George, my question for you is, what's your recommendation to folks who are holding right now? Diamond hands holding, looking for the bigger tendies coming in. What are you saying to folks who've got these big gains, and now all of a sudden we see this massive reduction in the short float, or the short interest float on GME down to 55% from the 113% it was on Friday, at least that last data reading we had. What are you saying? Are you saying be careful? Are you saying maybe just take your initial investment out? Do you take half out? What are you thinking?
I'd say do whatever you need to do to where you sleep well at night and you're not thinking about it every 5 minutes. It's all about portfolio construction. And that I think you were talking about this earlier. If you're doing this with the speculative portion of your portfolio, which in my opinion should be about 10%. And so if you're doing this with 1% of your portfolio or 0.5% of your portfolio, if you're doing it with a percentage of your portfolio, like you did with 12 grand, I mean, that's a great example. You're not going to lose sleep over losing 12 grand. It might suck. It might hurt a bit, but you're not going to be pissed off when you're playing with your kids tonight at dinner because you lost 12 grand, or you're not going to be checking your phone every 2 seconds. I understand you're doing a live stream, but if you weren't doing a live stream, you wouldn't be checking your phone every 30 seconds, taking time away from your kids or your wife just because you have this. So if you find yourself doing that, regardless of whether it's Bitcoin or this or Tesla or coal or oil or anything. I think you got to look yourself in the mirror and say, okay, I may have too big of a position here. And so it's all about portfolio construction. And I think that's the best advice that I can give to people.
That's actually, I mean, that's great. I haven't even thought about that before, but you're right. I mean, there were some times during May. No, it was June. It was June when the recovery stocks started their sort of summer sell-off. There were some stocks that I was in that I'm trying to fall asleep, and all I'm thinking about is how that damn thing's going to open tomorrow.
Yeah, right.
And it can sometimes consume you.
Yeah, and then that is telling you that okay, you may need to have a little more cash because cash reduces volatility. And I understand cash is tough right now because it goes back to the Fed and the government creating a lot of currency units. So you don't want to hold something that they're creating trillions of additional units per year. But you know, you got to kind of weigh the pros and the cons, and that's one way to reduce the volatility. You know, one of my favorite investors is Jim Rogers, and a lot of the young people might not know who he is, but he's just an absolute legend in the business. And one thing I love about Jim is he grew up in Alabama, and this little town, teeny weeny town. It was so small that his phone number was 5. That's it. 5.
That's amazing. I didn't even know that was a thing. I mean, I guess it makes sense. 5.
Yeah,
oh,
well,
wow.
I think he may have grown up in, maybe in the 1940s. He's probably 70, almost 80 now. So maybe in the 1930s or something like that, you know, where they had like the operator so that you're 5. But anyway, the one, and you know, little town in Alabama, he's got a bit of a southern draw. He used to be on CNBC all the time before he moved to Singapore. But my point is he always has a way of keeping things very, very simple. And it's fantastic because he's such a complex thinker and he's such an intelligent guy, but he has a way of just saying things, keeping it very simple. I remember one time he was on with Maria Bartiromo.
Yes, Fox Biz.
Remember when she was on CNBC?
Yeah.
And she was talking about, you know, she had just had like, you know, Kyle Bass on or something. Some of these guys, it's just very, very high level where you're just trying to follow what he's saying. And she's like, okay, Jim, well, what do you think about Kyle's thesis on blah, 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 you know, like dollar swaps against the yen? He's like,
right.
Well, Maria, I think you got to just buy low and sell high. You know, didn't your mom ever tell you to buy? You know, it's very, very simple. So anyway, in one of his most famous interviews in a book called Market Wizards, that the guy was trying to pin him down on how he invests, like what's his strategy, what's his magic sauce, right?
Right.
He says, all I do is I sit and I do nothing, just do nothing. He goes, most people try to do stuff all the time. And I sit, do nothing, and I wait until there's a big pile of money sitting in the corner. And when I see it, I just go pick it up.
Wow.
That's it. And it was so, but if you think about that, there's so many lessons in that people, they try to always be doing stuff where sometimes if they just sit and do nothing and just wait for a perfect opportunity where the fundamentals match up with their personality and their portfolio construction, and then that's the way over the long run, they're going to have a mathematical edge.
Now, do you like the idea of diamond hands in general? You know, buying a position and holding it, or how does that sort of?
I absolutely do. I absolutely do, Kevin. If you're buying something that's cheap, so I'll use an easy example. So oil, if you look at a long-term chart going back, you know, decades, adjusted for inflation, you see that when it gets below $30 a barrel, it's pretty darn cheap. You know, usually it's going up. And then when it gets above $80 a barrel, it's usually pretty expensive, historically speaking. So back in March, you know, oil dipped down to negative $40 a barrel. That's pretty darn cheap.
Right?
No, it's true. That's just futures market and stuff. But it got down, I think, even the physical market was what, $10, $12 a barrel? That is cheap. So if you can buy an oil producer, as an example, you know, when oil is at $15, $10 a barrel, that's paying, it's 6, 7, 8% dividend yield, and you just hold it for 10 years, I think you're gonna be all right. And if you do that, and if you keep that same mentality throughout your entire portfolio to where you're diversified in doing that, I think you're going to do well. What an interesting story. Back in 2000, I think it was 13. I don't know if you recall when they had the bail-in in Cyprus.
No.
Okay, so the banks basically collapsed, and they bailed in, what they called it, their customers. So let's say you had $1 million with XYZ Bank, they froze your account, and then when they opened back up a week later, you had $100,000. They took your 900,000. Yeah, they took their clients, their customers' money. They called it a bail-in, up to the $100,000 was the limit, something like that. So anyway, their stock market went down by 99%.
Yeah,
it was absolutely crazy. To where these decent Cyprus is a big tourist destination. So
I think they do conventions there and stuff too for businesses and that, huh?
Yeah, and it's great weather. And so they've got a lot of these hotels. And back then I was just getting into real estate, and I didn't know about the bread company or the beer company, but I understood hotels. So I looked at the balance sheet. I said, these guys are pretty good, and people probably still go to Cyprus. And I remember their shares dropped down to 10 cents a share, and they were paying a 10% dividend at that point. So I'm like, man, okay. So I went in, I didn't buy, but I did the same thing you did. I put in a good chunk of change, but not something that I'm going to lose sleep over, not something that's going to change my life. And honestly, I watched it for maybe a couple weeks, and I totally forgot about it. Didn't even check it until I did a video on it like a year ago. So I hadn't checked my account literally in years. It could have been zero. Just no clue. And I looked at it just for this video. I even had to email my broker to get my password, I remember. Yeah. And the 10 cents now is trading at 88 cents. But they had raised the dividend to where on my cost basis, I was getting like a 30% dividend yield.
Oh my goodness.
You see my point. If you can buy things when they're that cheap, and if you organize your portfolio in a way to where you're not really losing sleep over it, you're diversified, I think you can just hold things for the long term and just sit there and get paid. That's why I love dividend stocks. You get paid to wait for your investment thesis to play out, and you wait for it to go from being cheap to usually expensive, because markets are cyclical, especially when you're dealing with commodities. And I think that's a prudent way to have a mathematical edge long term. And then for a very small portion of your portfolio, if you want to get involved with a short squeeze, silver, GameStop, go for it.
Well, so here's a question that came up. Somebody says, do you think silver is undervalued? And they say, we look at all the Green Deal plans and EV companies that need it.
Yeah, I'm looking at your question. Yeah, I think this is an interesting take, and I like the way this person is thinking. I'd also suggest copper and nickel, because a lot of people are very bullish on electric vehicles, but a lot of the electric vehicle car companies are trading at a huge valuation, as you know. Not to say that I'm not going to give an opinion on that, but I think maybe a cheaper way to play electric vehicles is to buy copper or nickel, something like that they have to have. If you look at, one of my good buddies, a hedge fund manager, Chris McIntosh, who I partner with on a couple deals, he points out that if you had a certain percentage of cars transferred to EV, let's say that in the United States, we had 20% of the vehicles now electric. He did the math on how much copper would be needed, and it's like it was some crazy number, like 10 times more than exists right now would have to be mined.
Oh my gosh.
So that could be, and see, my point there is maybe nickel as an example is, or copper, although copper's had a big run, so be very, very careful there. But if you could have bought copper back in March or April, you could have bought it at a point where it's historically very, very cheap, while at the same time you get all the upside benefits of investing in an electric car company.
That's interesting. What do you think about and I appreciate you sharing that. What do you think about the miners? On that note, would you is it better to buy a miner like the lithium miners or maybe the graphene miners or
Yeah.
just the material?
Yeah, especially with copper or something like that, because you can find a producer that's going to pay a dividend most likely. So there again, and instead of buying an electric car company that might not be paying a dividend, and it's just your decision. This isn't investment advice. This is just kind of the way I think through things. I would rather buy a producer that electric car company is going to need. And so while I'm waiting, I can get a 4 or 5% dividend. I can be paid to wait. I can be paid to own the asset. And that's one reason why you and I both love rental properties and we love real estate, because you can just get paid to watch your debt go down in dollar terms to where you're making money in the debt. We had this conversation the other day. And then, if you get some appreciation on it, or forced appreciation, which is what I prefer, then you're going to make out like a bandit.
That's amazing. I got another question for you. Have you ever heard of this? I'm going to pull this up here. What is this? Voyager is some kind of a company that lets you, I guess, invest into crypto interest rates, basically, where they give you a stable coin called USDC, and then they pay you 8.5% on that. If you basically you tokenize your dollar here. I've never heard. Have you heard of any of this?
I've heard of it. I'd be a little hesitant because whenever I see something like that, the first thing that comes to my mind is, okay, how are they making the 9.5%?
Well, they got to make more than that. Exactly. Yeah.
Exactly. Right. And what type of risk, what type of counterparty risk do I have? Most people buy Bitcoin. Well, maybe not most, but a lot of people buy Bitcoin because there is no counterparty risk other than electricity and the internet. And so, it's like gold. It is payment. It's not.
Well, so define that a little bit. What you mean by counterparty risk? You mean like the risk of default at Voyager? If they take your money, they lend it out, whatever they lent it to goes bankrupt, then they're like, oh, sorry, we lost your coin. That's a risk. Whereas with Bitcoin, you're just holding it, kind of like a commodity, huh?
Yeah, it's like owning physical silver as an example. You don't. There's no counterparty risk in a silver coin or a gold coin. But with when you're getting into financial markets, there's counterparty risk. So I think that may defeat the purpose. And I'd ask myself, who are they investing to? What's what's the risk profile? It looks like hard money loans, but yet in Bitcoin, what's the collateral that's backing this up? I'd have a lot of questions about that.
Yeah, no, that's really insightful. I appreciate that. So what okay, so we've got kind of your ideas here on GameStop and the markets, the Fed, inflation. I want to know there are a lot of people saying that Citadel owns a portion of their portfolio in silver, and because of that, maybe silver shouldn't be a buy because it's counter movement. What's your take on that? How much involvement do you think Citadel's got?
I mean, the same thing with JP Morgan. I mean, the paper silver market, the derivatives market. I mean, the derivatives market is over $1 quadrillion. So there's a lot more paper silver or futures and gold and oil going back and forth that they could never deliver on. So it's a very interesting question when you kind of go down the rabbit hole. But I guess it depends on why someone is buying silver. I mean, if you're buying silver to stick it to the man and stick it to Citadel or whomever's the target, you may have something there. I think you'd have to look at their balance sheet and try to figure out exactly how much pain they would go through if silver goes up 20, 30, 40, 50, 100%, something like that. And I think a lot of people are doing these things, not that they shouldn't do them. It's the individual decision. But I think a lot of these actions that are being taken, the net result is going to be more about them feeling good than about the damage that's being done to the individual entity. And then I would also encourage people to think through, is your frustration really at Citadel and the hedge funds? And I'm not letting them off the hook by any means, don't get me wrong, or should your frustration be directed toward the Fed. Because here's the thought experiment I always go through, right? Because we know the Fed tries to, or for the most part, control short-term interest rates, which affects the entire yield curve to a certain degree. Just historically, the Fed funds rate, the overnight rate, is about 6%. So think about that.
And so now it's like 0 to 0.5 or 0.25.
Exactly,
So huge.
Exactly. So if we had, let's just say since 2000, prior to the GFC, that interest
could
rates.
you hold on just 1 second? Look at this.
Yeah, sure,
What's
sure,
this? Ford and Google team up for an wrong. Let me get the correct. There we go. Look at this. What is
America? Dr. Siegel is with it.
Oh no, they went onto the screen. I just saw that a headline there that popped up really quickly. Sorry about that, but it said that Ford and Google partnering on a car partnership. That might be something to ask you about as well. That seems interesting. But go ahead and finish your thought first. Sorry about that.
Yeah, no, it's okay. I was just going to say since 2000, prior to the GFC, and then the let's call it the ZERP that we've had for the last almost decade. If interest rates would have stayed at, let's say, 6%, and mortgages would have stayed at 8%, 9%, something like that, and if pension funds would have been able to get that 7% return that they need just by buying a 10-year treasury, would we have had the GFC? Would we have had the stock? Would all of these hedge funds be doing what they're doing? And I think the answer is no, because the Fed, what they do by keeping interest rates artificially low is they force people to take more and more and more risk to get the same return. And so people or entities, think about what they're doing to the pension fund. The pension funds, their liabilities, they have to have a 7% annual return, and that's obviously compounded, right? So now what they're having to do is they're having to invest in companies or funds like a SoftBank, like WeWork, and they're having to do that on leverage just to try to get back all of those gains that they didn't have because the Fed dropped rates down to 0 to where they couldn't get it just by buying a treasury. You see, so you've got, and so again, a lot of people say, well, these hedge funds are so greedy. And listen, I'm not letting them off the hook. I totally agree. But you got to ask yourself, is greed a new phenomenon? Is it something that just the people on Wall Street over the last 2 decades are just that much more greedy than they were in the 1970s or in the 1870s for that matter? Now, greed, we're all human beings. Greed has been with us for a long, long time, and it's not increasing exponentially. What's happening is the incentive structure has changed, and that incentive structure is what we have due to the Fed and the government coming in and manipulating what would be free markets, and really taking power away from the SEC as well. Kind of the watchdog. And so again, you got to kind of go down the rabbit hole and look at the layers to determine if you're pissed off about the GFC, who should you be pissed off at? And yes, sure, the hedge funds, but you should also be pissed off at the Fed and the government. And I think right now, if you're looking at Citadel and what they're doing, or JP Morgan, you've got to be pissed at them, but you also have to be pissed off at the incentive structure that has been implemented by the Fed, trying to micromanage the economy and interest rates.
Wow, that's big. Yeah, wow. So I mean, as an investor now, do you stay a little more cash heavy to wait for that opportunity to diamond hand into, or are you still thinking, no, it's just when you find the opportunities, get in?
Yeah, well, I think it's both. I mean, personally, what I do is I keep some dry powder to take advantage of opportunities like we had back in March, for sure.
Your percentage?
As a percentage, it fluctuates depending on, see, this goes back to the second part of your question. It fluctuates based on how good of a deal I can find in other areas. So as an example, I make the returns I make in Colombia, Medellin. I have a lot of real estate in Medellin, Colombia. And the returns I can get there, because I'm a local expert, are significant. We're talking probably 80% annual returns. so you've got to say, okay, if you've got a pile of cash, do I have a deal that I can invest in Medellin where I can get that type of return? If the answer is no, well, okay, maybe I want to hold on to some cash in case we see a market correction or we see oil go back to $30 a barrel, or something gets cheap, right? But if there's a great opportunity in Medellin where I know that there's a 90% chance that I get that type of return because I've got a team there and I've been doing it since 2015, well, it's probably a little smarter for me to take that cash and allocate it there. So it really depends on the market. I was talking to some people. I'm selling some of my real estate in the United States that I've had since 2012.
Oh, wow.
And people say, well, what are you going to do with the money when you sell in 3 or 4 months? And I don't know. It depends what the market looks like. I mean, who knows where we're going to be in
'cause you're
3
going to
or
pay
4
some
months.
fat gains.
I'm sorry?
You're going to pay some big capital gains taxes.
You might pay some cap gains, but I think I try not to have the tax ramifications impact my decision-making process too much. And that could be right or wrong. I don't know. Just even going back to my days as an entrepreneur, I first and foremost would try to set up a profitable business model. And I try to make money. And then, okay, you're going to have to pay your taxes for sure. But let's just kind of deal with that. Let's let the accountants deal with that. And as long as I'm bringing in a lot of money on the front end, you go ahead and pay your taxes and let the accountants deal with it. And hopefully, maybe over the long term, you're trying to execute on strategies that might lower your tax burden a little bit.
Right. Take advantage of those opportunities as they come up. So how can people get in touch with you, George? We've got this question here that I popped up with the apple tree, it looks like, as a logo here. Somebody's looking for more information on maybe getting in touch with you on Colombian real estate or where can people follow you on social media? I appreciate you so much coming on here.
Yeah, well, I appreciate you inviting me on. It's just George Gammon everywhere at Twitter, Instagram, or YouTube.
Oh, you lucky.
Yeah, I did get lucky there for sure. Yeah, it is GAMMON. Most people would probably find a lot of value in my whiteboard videos that I do on the George Gammon channel a couple times a week, where I, what we were talking about with the Fed and interest rates and quantitative easing and money supply. I outline how that actually works, the nitty gritty on the whiteboard videos. In fact, I did a whiteboard video on GameStop Thursday night where I had an options expert. I did a whiteboard, but I did these inserts where Patrick Ceresna came on and explained exactly how the market makers have to buy the underlying share when someone buys a call option, which creates this feedback loop where the stock's going up and therefore it squeezes the shorts even more. Because, you hear that on CNBC, oh, well, the market makers have to hedge, and it creates this self-fulfilling prophecy type thing. But it's like, what? Okay, I kind of get it. But we walk through it step by step, so the viewer can really understand the dynamics behind the scene that is creating all these just insane price moves, historic price moves that we may never see again, and all this volatility.
Wow, that's amazing. Well, thank you so much. I definitely go check out George's whiteboard video, especially on GameStop. Your whiteboard videos are so good, and then you have your editor like pop things out of the whiteboard, and I'm like, oh man, it's so good. I appreciate you so much for coming on. Thank you so much, George, and we'll have you on again.
Thanks for having me, buddy.
Thanks. Bye. All right, folks, welcome. So let's go ahead and see what we've got with the sticks, folks. We've got some movements here in the last few minutes. So let's quickly first start by listening to what do we got here on CNBC for a second. What do we got here?
And I'm pretty sure what Robinhood did is within the guidelines of what's in that, fine print. But nonetheless, people are mad. People are angry. You've heard Elon Musk talk about it. You've heard, Mark Cuban talk about it. Even the AOC talking about it. So it's an issue. It's a problem, and people are mad. People are angry, and they should be. Because this is the app that claims this is about free trade, and they took that power away from people. So
yeah.
It's Deirdre. Good morning. Since you waded into the GameStop fray on Thursday when that stock actually hit its highest level so far, I just wonder, what do you think GameStop will be worth 3 years from now? Is it going to be worth more or less than it's at currently?
It's funny because, the reason why these stocks were being shorted in the first place is because these companies were doing bad. GameStop, AMC, the brick and mortar stores that are not able to open up because of the pandemic. So, these big hedge fund guys started shorting these companies. So I don't know, where they'll be in the next couple of years. I think the pandemic and stuff like that is gonna, let us know how those companies are gonna survive.
Your tweet was very confident, though, Ja. You said hold the line on a day when GameStop went above $400. So here you're saying your advice is to be careful, but just a few days ago you said hold the line when the stock was above $400.
Listen, here's the thing. Here's the thing. When I was talking about holding the line, that was actually for that day of what was going on. I felt like, this was like a war being waged against the little guy from the hedge fund guys. And these guys, I didn't actually get in on the GameStop stock. I wish I did, because a lot of people got rich on that movement. But like I said, the company is actually not doing well at the moment. So do I think the stock will stay there? I don't think so. But the way the stock was being played with, it felt like if we hold, these guys would have to get on our side of it and buy the stock, to save their money, that, so they don't lose money on the short. That was my thinking of it, not so much of hold it forever and this is going to be a stock that kind of grows in time. No, I wouldn't advise that.
This is interesting. It's almost like people, now that it's a red day, people are starting to justify more that, I never said you should hold it forever. Pay attention to that change in tune. I've been very consistent on this channel. Every time I have mentioned GME, I have said, do not be bashful to take some profits. Nobody should make you feel bad for that.
I wonder how that's going to get figured out by these traders. But I want to ask you about further your involvement in tech, in apps. You've been a Robinhood user for a while, but you've got interests beyond that. What's the role for somebody with a long-standing brand like you have, a creative mind like you have? What are you working on?
Oh, man. Well, right now I'm working on my tech company as we speak. It's called Icon. Shameless plug. But it's a live streaming platform that allows content creators to monetize their content. So really, really cool concept. It's growing right now.
Okay, we're gonna jump off this. Mostly, we're interested in commenting on thoughts, obviously, on GME. Very interesting. Pay attention. Listen. This is so important. Okay, this is another clue here. Okay. And again, I've been consistent on this. I will maintain my consistent position. It is okay to diamond hand as long as you are not hurting your family wealth that you could have today. Keep this in mind. When Dogecoin, when I was up, I was up $52,000 on the $25,000 YOLO on Dogecoin. It was like $75,000. It was insane, in a matter of 10 hours. Then it dropped to 48. And it crossed my mind. I'm like, I want to sell because I don't want to hold this. That was, it was like a day buy and then sell. But now I feel like I want to wait until it goes back to 52. A 52K profit. I'm like, no, Kevin, don't. Who cares? Take a profit. That doesn't mean you have to sell completely out, but it's okay to go, I made money on that. But this is something very important to consider for what's going on with GME here, okay? Very, very important. Realize that what's pushing this up is Wall Street Bet user registration. More media. Wall Street Bet user registration. More media. Wall Street Bet user registration. More media, right? And everybody along the way. Bull, right? Everybody really, really excited. When we start getting media go down, then naturally you could still have growth, right? But once the media coverage goes down, and once not just the media coverage, but the Wall Street Bet user registrations go down, what happens? You start the down. But what's also happening? People change their tune because they want to be on the right side of history. They're not consistent. We've been consistent on this channel with what I've said. But once you start hearing, this guy just got slammed on it, one day you're like, hold the line but take some profits, if you're up on some game-changing wealth. Now he's going, well, I never said you should hold it forever anyway. Be careful when you start hearing about these justifications, folks. What kind of down pressures do we have right now? Peak media could have been Friday. Peak bullishness, is that potentially behind us? I don't know. What about, we know the short squeeze is down to 53% or something like that. Jen Psaki's doing her press. Do we care? She takes very long to answer questions. And I don't think they've had the meeting yet either at the Fed. I will check really quick. We'll see what she's saying. I don't mind going back and forth on her, but we'll see. Is her briefing live yet? Or you're just saying that it's coming up? Because I don't see it live yet. But anyway, let's go ahead. In the meantime, let's go look at Peak Media will be the next few days. Maybe, her live stream isn't for another probably 30 minutes. So, okay, that's fine. So we can always check on that then. Let's quickly go back to CNBC. Let's see what they're saying over there. Squawk Alley. All right. What you guys got? TV commercial. Y'all suck. You don't get TV commercials over here. By the way, make sure to check out that coupon code, and the course is linked up. Oh, I'm kidding. All right, let's go look at the sticks, folks. Let's look at the sticks. Let's look at Bloomberg's terminal. Oh, it closed again on me. That's all right. I'll pull up the terminal again. We'll log into the Bloomberg terminal again, and let's go ahead and look at the sticks quickly. Then we'll pull up the Bloomberg terminal. If you have a ticker symbol you want me to check the outstanding short percentage on, I will be more than happy to do that for you. Please provide me the ticker symbol in the chat. If you would like to join the polls, make sure to check out the polls that are going on right now at Real Meet Kevin on Twitter. You will see multiple polls. Are we going back to the SPACs? Along with many other polls over here that I encourage you to join. And make sure to get your 4 free stocks with Webull when you deposit $100 with Webull. Okay, let's jump on over now. Let's go to the sticks. Get me to come back over. All right, going back to the sticks here. What do we got? So we are down 19.9% at GME. Look at this now. See, now we're getting support. Now we're getting support. Not here. Loser. Idiot. Stupid mistake. You made a stupid mistake, Kevin. Okay. You can learn from that. Look at that. Lower low, lower low. What do we got here? Is this maybe a shelf? Somebody said this earlier. 255 is the support. Are they right? Is 255 the support? Are we going to keep bouncing up over here? It'll be interesting. Be interesting to see. Is it a head and shoulders? Is it what do y'all think? I don't know. We'll see. Down 20.9% right now. We are down about 38% on costs. Blink lows, Neo down a little bit in the day. Let's go to gainers. We've got 21% at First Majestic. So it's still down from the highs of the day. Notice again, it was that pre-market that really had the highs here, that pre-market trading. Really always a good idea to be careful on the pre-market. It's a V, Kevin. It's a V. It's a V, we say. Larry will tell you it's a V. Come on. It's a V-shaped recovery. All right, we got, look at this, up 6.49% on Lucid Motors, folks. This is getting a little expensive for Lucid Motors. I get a little nervous when these things move too much, these SPACs. 25 gets a little pricey over here. On the other hand, look at this, folks. Printing tendies on the $150,000 option we put in today, and the $150,000 option that we put in on Friday. Take a look, folks. Let's go ahead and get an update on the Tesla call options. These are Tesla long calls. Oops, wrong button. There we go. Look at them Tesla long calls. They have made up for the GameStop losses. The Tesla long calls at $900 that we were able to pick up there. Some of these that we picked up this morning at $800 a share. They're doing decently right now. So happy to see that. Let's go ahead and listen into CNBC for a moment. Let's see what we've got over here.
To be discerning. Let's put aside GameStop and AMC and what kind of happened there for just a second. And you look at names that are outperforming in this market. You look at the names that came back when they were beat down last week, and you're actually seeing strong companies come back to the positioning in which they belong. And so I don't think there is a correction right now by any means. You see kind of what's happening with the virus. How long have we been waiting for some good news? How long have we been waiting for the death tolls to pause and the hospitalizations to come down? I mean, I could go on and on. I won't, but you know, I think there's some good opportunities here.
Yeah, forgive me for interrupting you. I do want to get to Kate Rooney, who has more breaking news on Robinhood, as Carl was just talking about at the end of the prior show. More capital raise. Kate, what can you tell us?
Hey, Scott, Robinhood has raised an additional $2.4 billion. That is on top of $1 billion it raised just last week. So total, in just a few days since last Thursday, Robinhood has brought in $3.4 billion from existing investors. So the names on this list, in terms of the backers giving Robinhood some capital here: Ribbit Capital, Iconic, Andreessen Horowitz, Sequoia, Index Ventures, and NEA. All again from existing investors here. And it's in addition to $600 million in credit that they got from their bankers last week. So all of this, of course, to meet those record capital requirements in order to keep these stocks online. And again, $3.4 billion just since last Thursday. Scott, back to you.
That does kind of imply that they might remove restrictions here soon. That's a big capital raise.
Picking up off the current environment, yes, Robinhood's a big story within that. And Courtney, you know, we did hear from you. All right, so Kevin O'Leary, maybe a correction's here, maybe it's not. Maybe it's going to get worse, as Mike Wilson said, and maybe it's not. But what I see from you is buying more. And buying a lot more, buying more Microsoft, buying more Facebook, buying J&J and Apple and Tencent and Baba, which I said reports this week, and Pfizer. That's a lot. What does that say about your view of the market?
I can't find anywhere else to put money that's competitive. I'm not going to put it in fixed income, even though I believe the 10-year will be at 2% by the end of this year, just because of inflationary pressures, whatever stimulus package we get. As far as this correction goes and why I continue to buy, we're in a pause that refreshes, mostly driven by the fact there's some concerns about how fast this virus gets squashed. It doesn't look like it's going to be as easy as we planned. Logistics issues. Now that Biden's fully in control, he owns the issue. And every day we hear the update on where we can get vaccines, where we can't. In addition, there's a big spread in the stimulus package. You know, I love kumbaya politics, and you get it for one day when you hear the inaugural speech. And after that, it's back to business as usual. So we're going to fight about minimum wage. We're going to fight about states. We're going to fight about this, fight about that. In the end, it's not going to be 1.9 trillion. It'll be whatever it is. And then we'll have to look at the stimulus package. But all of that liquidity speaks to owning equities. And you go back to what works. Microsoft's really working. J&J, I want to be in the middle of healthcare. Anything to do with the consumer, I absolutely love. Facebook, it's a gift to get a pullback of 8%. It's firing in every cylinder. Yes, I know we have to shut it down. It's evil. But you can't do that right now because it's running small business in America, period. Got to wait till we have something else. So that yin and yang's been going on forever. I just see it as a buying opportunity. I'm going to continue with the names that have really served me well and load up the full weightings on them.
Yeah, Pete, I mean, others do too. Even if you think that there's going to be more, you know, deleveraging or de-risking from hedge funds, which may go on for, you know, some period of time. Mike Novogratz tweets today. I'll read this because it's important. I think it really represents the view that's widely out there. Most people I know, he says, in the equity markets are waiting to buy as soon as they think the deleveraging is over. The macro backdrop is still stocks higher, assets higher, tons of cash around, and an economy that will explode in a good way once enough of us get jabbed. Speaking of the vaccine, that seems to be the prevailing view, Pete, that even if you think stocks may be in a period of turbulence or heightened volatility and they do pull back, there's a lot of buyers waiting to pounce in this market.
Yeah, it's true. Every dip gets bought.
I totally agree with that.
Kevin O'Leary is not wrong. I pinned up his comment here on the screen. The pause that refreshes. That has been true for almost a year now. 11 months. It's literally been, you see a short pause. It's literally buy it and it's gone. Like, you got to buy the dip and then it's gone. It gets bought up so fast. Kevin O'Leary's right about this.
For me, how do I do this in a way that still makes some sense? I could take advantage of volatility. So when we talk about the VIX all the time, you look at those implied volatilities within the VIX. So the VIX was just trading in the 22s not that terribly long ago. Yesterday, we were 33. This morning, we were 33. That gives you an opportunity to use that volatility that has come back into the market and the implied volatilities of most of the stocks that I'm trading right now. It gives me a chance to sell right on top. So in other words, if normally in Apple, I would sell about a 10% out of the money call a month out, let's just say, I'm not doing that. I am selling options against my long stock positions that are right on top of where we are. Now, that's going to make it a lot more difficult if we go straight up, but it also gives me a lot more cushion to the downside, and I'm taking advantage of the implied volatility in a lot of these various names that has risen by 5, 10, 15, 20%.
It's not a terrible idea. Basically, sorry. I want to go to this. Wait, I'm trying to get to. Oh, it's because I'm on my phone. Hold on. Sorry, I'll keep it playing.
If you're waiting a correction, don't wait because it's already here. And it's likely to get painful, at least feel bad. But there's no reason to think that you're in sort of bigger moment.
Here we go. Folks, look at these runs, okay? Look at what's running right now. This is incredible. Social Capital pulled back a little bit. So we had a little bit of a pullback on social. But look at this. Tesla, folks, literally straight up from where we bought that option. And we bought that option together. We nailed that one. Crushed it. Thank you all. Appreciate all of your support as always. But this is a company that you just cannot count out on these dips. That was nice. But keep an eye on this one. EXPI, $111. Wow. Where GoPro moving. Look at that. Straight up today. A little flat over here, but pretty dang straight up today. People are wondering, are the GameStop shorts getting covered? Take a look at this. We already read this earlier about the GameStop short interest plummeting, but take a look at this. Bloomberg reporting. After absorbing a $20 billion hit, bears appear to have started covering their GameStop core position in earnest as the stock plunges. Short interest in the video game retailer plummeted to 39%. That's even lower than what S3 Partners reports, by the way. S3 reports somewhere around 53%. 39%, that's even worse. That's even worse. From 114%, not mid-January, even last week. They're using IHS Market Limited here. Data from S3 Partners, another market intelligence firm, showed a similar pattern. Yes, they did decline substantially, with GameStop short sales having fallen to about 50% of its total available stock to trade. Yeah, that is what we reported. Down from a high of roughly 140% reached this year. Look at that. The squeeze getting squoze. Squeeze getting squoze. All right. What else we got? Let's see here. Let's listen in.
Some big winners there, like a Skyworks. Skyworks sells at a
than you think, and that's one person's call. You do have a cohort, and a rather large one, that is engaged and involved in buying stocks like they haven't done in years.
I think we've been here all along. We just haven't been as coordinated. I don't know if we've even been born or reborn. I just think now we're more coordinated with Wall Street Bets, YouTube. We're a real community now.
I've seen a lot of it, but what hasn't been in the headlines, for example, in Apple. You've seen so much retail buying in Apple and other names. So yes, you have another investor class that's coming in on the margin. Yeah. Additional buyers are very, very positive. But in my view, they're also weak-handed. So, the sword, it cuts both
ways. He's saying we're paper hands.
We're benefiting from it. We may not benefit from it if the market hits a rough spot. But clearly, having, as I said, that marginal buyer is a positive for the market, but in a limited group of stocks. And I wouldn't give them more credit and say that they're all sophisticated. A lot of them aren't. Some are. As a matter of fact, the person who started this whole thing with GameStop was looking for a value play. He wasn't looking for a short squeeze. That happened after.
No,
So
but
let's
of course,
call that
come on.
what it is.
I get it. I get it. But hedge funds have blown up too by making stupid bets on the wrong side too. I mean, regardless of the size of your wallet, everybody's made dumb moves in the market over a period of time. I think that's an important point to make out. We're learning that over the last couple of weeks. People make dumb bets, whether you have all the money in the world or not that much money. If you're engaged in the market, chances are over a period of time, you're going to be on the wrong side of a trade or two. Courtney, go ahead.
Huh. I mean, it's some interesting points of view here. You know, I personally, sometimes I feel like there are quite a few people on here that want to like slam the little guy. I don't know. You know, I think we've got diamond hands. When we need diamond hands, we've got diamond hands. Okay, folks, let's go ahead and see what the sticks are doing really quick. So we've got GameStop down 24% now. We've got a little bit of a sell-off again. Are we going to? Ooh, we broke resistance, right? Or potentially not resistance. The support level that we were thinking we would have of around that 255, right? Here was that shelf. We were thinking like, is it going to be a shelf or not? What's going to happen? We broke right through that. So we'll see. You know, where is it? It's struggling to find its support level. All right, let's see here. We've got, where's AMC today? What's AMC doing today? AMC today, where's it? Is it suspended? No, here it is. Whoa, folks. Woo, it's getting cold in here now. AMC. Oh, man, what did I do? It's freezing in here now. I think the temperature went down to like 63. This is nuts. Down. Sorry. I'm cold. Okay, so what happened here to AMC? Look at this pain. Oh, what the hell? Holy crap. That's a big move down. Right? I mean, like the gains that AMC had today just got evaporated. And again, it was the pre-market pump. It was a pump. As soon as the pre-market opened, boom. And now we're going right back to where we were before the pre-market. The pre-market is risky, it can be dangerous, because that's oftentimes when you're getting a lot more of the retail buyer trades, which the retail buyer trades are diamond hand buying. You know, then the funds come in during the day and things start selling down. Fizz down 19%. GameStop down 23%. Are we finding any support? We'll know soon. Virgin Galactic, check this out. Virgin Galactic, ticker symbol SPCE. Oops. Moving up substantially right now. We are up 17%. Let's see here. Okay. So what else do we have here? We are let's listen to Kevin O'Leary. I like him.
They trade or they don't. They affect the markets for the first time. So the little guy has power. For this weekend, I've never seen anything like this because I try and monitor social media versus what I own. Is anybody starting to track or saying anything out there on any big position I have? And this weekend on Instagram, I have an account there, Kevin O'Leary TV. It exploded with this whole vibe of sticking it to the big man. And I'm thinking to myself, yikes, what am I short right now? And I'm not the only guy thinking that. Who ever worried about 25-year-olds taking you out behind the barn and shooting you? That's basically what the market has to deal with now. I don't care if it's silver or if it's GameStop or AMC. That's a new product out there, Scott.
No, you make a good point. And there's a lot of commentary out there today, including on Twitter, that in general, if nothing else, this is going to change the hedge fund risk model. They're going to have to sort of rethink the way they're engaged in the market and also the way that they're publicly engaged in the market and the way they talk about different positions that they have. But Weiss, you're right in the center of the mix this week. You own Alphabet, you've got Qualcomm, you've got Amazon, you've got Qorvo, and you've made some moves, I believe, around Qorvo too. So just give us your sort of lay of the land in big tech. Are these stocks at risk of doing what Apple and Facebook did and trading lower on the print, a sell on the news, so to speak?
You know, if I don't think so, because as I said, I put a bull spread on Qorvo and Qualcomm, which means that I'm betting on it to go up, in addition to my equity positions. We look at Skyworks. Skyworks was moving nicely, although it came down right before the quarter, market related, not stock related. And look at it.
All right.
On
What
Friday.
we got to do now
look at it today.
Is if you guys, you might not have seen this yet. Okay, this is a good thing to look at. Hold on, because it has to do with what Kevin O'Leary says, and I respect Kevin O'Leary's opinion a lot. I disagree with him on quite a few things, but that's healthy. It's healthy to disagree with people in a respectful manner, obviously. So what I'm going to do is based on, I mean, Kevin O'Leary is right. He's like, oh crap, what am I short on? I mean, he's got exchange traded funds, right? He's like, oh man, we're getting spanked out here. But take a look at this. Where is it? Here. This is what I think, pretty sure this is what blew up for him. And I watched this as it was posted. Got a lot of good views and a lot of good reception. I'm going to play this for you. This is a Kevin O'Leary post. By the way, in case you're wondering, this is Miami Beach. Pretty sure it is, at least. Really beautiful area. I'm like 99% sure this is Miami Beach. Honestly, you could probably find him out there every day. Here we go. Okay, Pinwheel, really? Dude, the quality's already crap on Twitter. Like, now you're gonna pinwheel me? You jerks! You can't do this to me. Okay, well, we'll come back. We might go to the sticks here. We're not gonna have... Here we go.
So what's really going on is the democratization of the entire global stock market. You know, and the way to really make this fair for everybody, big or small, is total transparency. If you're short the stock and maybe make the rule 5% of the float, you got to post it, and then everybody that's cruising around looking for you is going to find you. It'll make you think twice before doing that. Good or bad, it's transparent. That's what matters. But the power of the little guy now has been proven. And the way you prove power on Wall Street is money. When you force a firm to lose billions of dollars, you've got power, baby. That's exactly what you've got. And that's exactly what happened. Millions of small guys ganged up on the big guys and wiped them out. I still get a kick out of it. I think it's just fantastic. This is really the power of social media and why we should protect it. It just shows you. It gives power to everybody. It's democracy. It's a voice. It's a chance to shine, even if you're a single candle. That's what the whole deal is about. And together, it's a bright light. That's the whole deal right there. Yeah, I'm getting a workout here, I got to tell you.
Oh, you gotta love it. I mean, I think it's awesome. What a great way to do that. You know, it might be nice if he put a mic on and got rid of that wind noise, but hey, you know what? We got the message. Okay, so let's go ahead and jump on over to the Bloomberg really quick. Let's see what kind of news we've got popping up. Anybody need me to check short interest on a company? I can do that for you. Just put the ticker symbol in the chat here, and we'll pull up. I got to go to apps again right here. Deutsche Bank debt trading revenue rose about 20% in the last quarters. All right. Apps. CCIV finally jumping. No, you know, I was wondering that too. Oh, SNDL. Okay, I will check their debt. Apps. Yeah, no, I haven't heard any CCIL news, but I will look for that right now. I can do that. Hold on. All right. Run. So let's get this running. And then while we run this, why don't we quickly look to see if we can get any CCIV news? CCIV is the Lucid partnership. Let's see if we've got individual company news happening here. So, nothing, dude. Nothing. Huh. I mean, look, I've got over $500,000 in Lucid. You know, I think I got in a little late at 19. I should have pulled the trigger a little earlier in that one. Yeah, that's at 650K right now. But you know, I think it's a little rich right now for not having an announcement here. Who knows? Maybe it's coming. Okay, let's SDL, something like that. I don't know. Oh, the sundial. That's the sundial thing, isn't it? SNDL. Yeah, that one's running. Let's see if there's a short interest on that. Let's look at this. So sundial's been a stock that's been getting a good amount of attention here lately. Sundial growers. What is it? SNDL. SNDL. Actually, one of my course, I think a pretty course member who plays Rust, he talks about this all the time. 7.9% short, so not like mega short here, but I'll tell you, the company, it's on a tear. I think it went from 50 cents to like the moon, basically. Sundial Growers. Where is it? Let's see. Where's the moon? Okay, Sundial Growers. Here it is, 29% today. Jeez, man, it's at $1. It's at $1. Look at that. Oh my gosh, what a push. What a push. It's at 80. Oh my gosh, it's like, oh, it's been at $1 before. Oh man, it's been at $1 a few times before. So, but that's a nice pattern there. Jeez. Look at that Tesla, man. Oh my gosh, stabilizing at 833. Wow. Let's see, PSAC up 6.6%. We got some money being made here today. Silver Trust down from its highs of about 10%, up about 6% now. We've got Bitcoin kind of down, honestly, a little down at what is it at 33.5? Yeah, it could be doing better. Enphase flat, Shift Technology flat. All stocks. Let's see here. What are the losers right now? GameStop still 23%. Are we getting support again here? What is this bounce? 241. We've got QuantumScape selling off throughout the day here, down 6%. Wow. Even after bullish commentary by Elon Musk, down 8% on Moderna today. Folks, once the vaccine trade is over, the mRNA vaccine stocks are money. Those are money investment. My take. We'll see. I don't think we're ready yet. I'm not ready to go heavy in those yet. Let's listen to this for a sec.
Probably 6-7 months, and I think I could continue to own this for quite a long time unless they stumble. And so far, Jack has done a great job, I think. Even after all of the situations, he didn't feel the pain when it came to some of the decisions that they made about the president and others that they decided that they were going to restrict. So because of that, they were able to get through that. I think the stock goes higher.
You got that highs of the day on Twitter as well. That's 3 3/4%. That brings me now to a battle. We like to have battles and debates on this show. ExxonMobil, okay?
No. Twitter's a company you got to be careful about for that user growth. A lot of people think they might lose users because of the Donald Trump ban. That's not going to do bad. That's going to be bad for the stock. Okay, so Tesla Sundial Growers. What was the stock? BNGO, is that right? That's what you wanted me to look at? BNGO. Declining short interest also went from about 13-14% in the middle of the month here down to about 7%. I thought we did Virgin Galactic already. Isn't that SPCE? It is. Yeah, 17% short. IDEX. Happy to get that for you. Like an order taker. Sure, coming right up. 10.76% short. Also, a lot of short. By the way, this is a consistent pattern we're seeing. We are consistently seeing stocks basically reduce their short interest. Oh my gosh, look at that drop on Fubo TV. Wow. I mean, this thing went from 68% short, 70% short to 39% short. The shorts have halved on that one. That's a big move down. Moderna shorts. That's a good question. Moderna shorts about 7%. Not much movement here. The spread here is very small. So pretty consistent. I mean, this is right along the lines of Tesla. Well, they're somewhere around here too at 7% or something like that. Moderna 7.56. Tesla at, where's Tesla? Tesla at 7.38. Yeah. Okay, declining though. Definitely declining. All right, let's go. Let's pop on over. I want to see what Bloomberg TV is up to, actually. And anybody hearing any popping or any issues with the audio? Always want to make sure the audio quality is good for you. I think sometimes when I raise my voice too much, I get a problem. Let's listen in here. Just music. Come on. It's boring. Let's get some interviews. White House press secretary is going to speak shortly, so we'll be able to check in on that. if there's any kind of entertainment happening there. Let's listen to this. Let's see what they got. They got a commercial too. Interactive Brokers commercial. All right, everybody's on commercial. Let's go ahead and hop on over to the sticks then. Oh, wait, we could also look at, I want to look at news. Here's what we could do. Let's look at the top stories right now. Top stories. So, top stories right now is quants scrape Reddit to help hedge funds dodge more retail pain. That's interesting. I kind of wonder what they mean by this. A list of the hottest stocks on Reddit and Robinhood may seem like a recipe for riches for now, but at Wolf's research, it's quite the opposite. A list of shares to avoid. After scraping Reddit boards and Robinhood data, Wolf's team of quants is telling institutional clients to avoid fighting this band of newbie day traders. Oh, who says we're newbies? Who says we are newbies? At least they didn't say NOOB, but still. They say retail and army. They say the retail army is emerging as a disruptive show of force that makes both betting on and against their favorite stocks a dangerous game for Wall Street players. By using so-called natural language processing tools, the systematic shop mapped out the investing preferences of day traders who inflicted a historic hedge fund short squeeze last week. All right, interesting. All right, what else we have here? Deadliest month in New York. Robinhood raises $2.4 billion. NASDAQ climbs after the sell-off that we had at the end of last week. We got the stimulus plan, posted an update on that about 45 minutes ago, so you know the latest in terms of what's in the stimulus bill, including smaller stimulus checks, $1,000 instead of $1,400. If you haven't watched that video, go watch that video and come back. That video, again, was posted about 45 minutes ago. I get some details for you. Apple ramps up the pace of bond sales. Okay, nothing jumping up and down exciting here. Let's go ahead and get the news hub. We'll get that all news hub. And we've got the White House press secretary speaking momentarily. So we'll see if there's any particular news on there. They can't handle the diamond hands. No kidding. They can't handle it. Crush them. Crush them. All right, let's see what we got here. Holy crap. No way. What? Dude. What? No, hold on. Yo, check this out. Dude. No. It can't be. Gaming. Holy crap. Look. I'm on trending. Dude, what? Elon Musk on Clubhouse, full interview. I got trending for sucking and gaming? What? No freaking way. Look at this. Because yesterday I was playing Rust while streaming the Clubhouse interview and playing the CODs. Look at the double kill here, boys and girls. Check it out with the bullpup. Here we go. Bah, Felicia, missed your throw. Oh, go to the shotgun. Gone. Oh, hell yeah. Oh, man, that is so cool. I gotta take a screenshot of this. Dude, and honestly, shout out to Graham Stephan. He texted it to me. Maybe he'll come in the chat. Dude, thank you. That is so fun. I can't believe I went trending in gaming. Dude, I was like half paying attention too because I was listening to Elon on Clubhouse. Daryl says I'm bad. I am bad. I agree. I suck. Oh man, I got like tears in my eyes. That is fun. Wow. Okay, that is something else. Okay. All right, let's jump back on over here and get to work.
20 years ago when we first met, were at that time really shaking up the landscape for the retail investor then. Now we're in the midst of what I truly believe is a renaissance. What do you think about as you're watching all of this unfold?
Yeah, look, it's exciting to watch. I know there's a lot of vested interest here and a lot of hyperbole, and I think the net opinion that I have is, number one, it's very good for more participants to be in the market than less. I think sort of like the on-ramp to participation and sort of all the talk about Robinhood in particular and whether that's good or bad. I think what may be lost in the conversation, and this is where my work at Senate Hill is a lot more relevant, is there's been enormous progress the last 5, 6, 7 years in terms of engaging with retail investors through financial technology. There are a lot of apps, savings apps, investing apps out there that are not specifically about encouraging day trading, if you will. I know that's sort of my pedigree and my past from the 90s. When I think about the companies that are out there right now, you could be 18, 19, 20 years old. You could start investing with $5 or $10 or $20 through companies like Stash Invest and Acorns.
Oh, did we just pump Sundial? Did we just pump Sundial? Is that really what just happened? Did Meet Kevin? Oh my God. Right here, boys. Boys and girls. Oh, wait. Here we go. Put my face right there, please. Right. Wait. Hold on. We can do this. This is very, very important. Dun, dun. Da, da, da. Here we go. Right here. There we go. That's how we roll. All right, that's hilarious. Be careful, okay? After that kind of stuff, it tends to sell off, okay? So be careful. I did not mean to pump that stock. I know nothing about that stock. Be careful. The traders are coming in, waiting for that.
You allude to this as well. It's just never been easier or cheaper for the regular person trader to get involved in the stock market. It's really as simple as Ja Rule put it within the last hour.
So I got a question here on Intel. Ryan, I like Intel because of Mobileye, but Mobileye only makes up about 1% of their business, which is very low. And so for me on Intel, I'm actually out. That's crazy. Okay, let's keep going.
I think people should be allowed to speculate if they want. They should be allowed to buy stocks and sell it a few moments later for a profit. They can have any sort of perspective they want to participate. I just don't think that necessarily Robinhood should be the top of mind as the only mechanism, that they're the trailblazer that did something like this. I think encouraging people to invest for the first time is probably more important than encouraging people to trade for the first time. And look, I made my money.
That is not a bad statement. It is better to encourage people to invest for the first time than it is to trade for the first time. That is not a bad statement. I agree with that. Like if you're gonna start, that's not a horrible thing. Somebody's asking about Jivo. So me, Kevin, Jivo. I have a video on Jivo. I'm pretty sure it's this one here, and I encourage you to watch it because it's important for you to know. So if you're looking at Jivo, I'm pretty sure it's top 5 stocks to buy or sell now, episode 1. Oh man, I gotta label the other ones. Man, I missed my purple lights. I gotta get the purple back. Yeah, here, Jivo, right here. See, it's even marked on the bar right here for you. Jivo stock trade. Go check that out. Okay, so that's on Jivo. So I have that covered there for you. Oh, press secretary, let's go. What do we got? Bloomberg?
The extension of the
they're just talking over her. Okay, hold on. We got this. Let's go. 2, 2, 4. Let's go, Jen. Come on. What you got for us? What you got today?
From an overall security standpoint. So we're working closely with them on that. And they are, of course, would be in the lead on that front. And the last piece I just wanted to give a quick update on was there was a question about the White House's support for FEMA's request of troops. We, of course, support a whole of government pandemic response.
Talk about the stimulus. Just a heads up, okay? What happens is we get the most juice out of these political conferences, not in the prepared remarks usually, but on the in the questions.
In some cases, for this unprecedented pandemic response effort, I expect we'll have more on this as the days continue this week on how they will be utilized. With that, let's go. Darlene, welcome to the briefing room. I know you've been here many times before, but it's our first engagement here. Go ahead.
On the president's meeting this evening with the senators, can you give us a sense of how he views that meeting? Is it going to be
stimulus
negotiating? Is he going to be prepared to counter anything the Republicans might offer? Or is it just a session where, they asked to meet with the president and he's simply giving them an opportunity to voice their concerns?
Well, the president has been clear since long before he came into office that he's open to engaging with both Democrats and Republicans in Congress about their ideas. And this is an example of doing exactly that. So as we said in our statement last night, it's an exchange of ideas, an opportunity to do that. This group obviously sent a letter with some outlines, some top lines of their concerns and their priorities, and he's happy to have a conversation with them. What this meeting is not is a forum for the president to make or accept an offer. So I think that's important to convey to all of you. And his view, it remains what was stated in the statement last night, but also what he said on Friday, which is that the risk is not that it is too big, this package, the risk is that it is too small. And that remains his view, and it's one he'll certainly express today. Go ahead, Darlene.
So what would you say is more important to the president at this point on this first legislative test? Is it going big or going bipartisan? It seems like you can't have both.
Well, I think the president believes we can, and there is historic evidence that it is possible to take a number of paths, including through reconciliation, if that's the path that is pursued, and for the vote to be bipartisan. But it's important to him that he hears this group out on their concerns, on their ideas. He's always open to making this package stronger. And he also, as was noted in our statement last night, remains in close touch with Speaker Pelosi, with Leader Schumer, and he will continue that engagement throughout the day and in the days ahead.
Go ahead. You mentioned that President Biden's proposed COVID relief package is designed to be commensurate with the crises. This group of 10 Senate Republicans, what they're offering, as you know, is more than a third less. The top line number, the $600 billion, is more than a third less of that $1.9 trillion that President Biden says he wants. Given that, do you see that as a serious attempt at compromise on their part?
Well, I appreciate the opportunity to give more comment on their proposal. I think they put their ideas forward. That's how the president sees it. He felt it was, an effort to engage on a bipartisan basis, and that's why he invited them to the White House today. But his view is that the size of the package needs to be commensurate with the crises we're facing, the dual crises we're facing. Hence, why he proposed a package that's $1.9 trillion.
Does the president plan to invite Democrats into the Oval to have these similar conversations?
Well, I can promise you we're less than 2 weeks in. There will be many Democrats in the Oval Office, and I'm sure this is just part of our ongoing effort to engage directly.
Well, asking that again in a slightly different way, there are Democrats who see that the first meeting the president is having face-to-face with lawmakers is with Republicans and not Democrats. I guess why is the White House doing that?
Are there any specific Democrats you want to call out?
No, but it's been talked about. There's concern.
Just people talking about it in hallways? Okay.
Sure.
Well, I can assure you that Speaker Pelosi and Leader Schumer.
Just people talking about it in hallways or what?
With the president directly and members of the senior team. He has been in touch, but also members of our senior team have been in touch with Democrats.
All right, this is going in circles. They don't have answers for us. Yo, check it out. CCIV 11% today. Holy smokes. Why? What's pumping this? Please, somebody tell me what is pumping CCIV. Yeah, started talking stonks in the hallway. Baller freaking nailed it. Oh, man. Always wondered who they are. Yeah, no kidding. No freaking kidding. Wow. Wow, wow, wee, wow. Okay, Tesla up 5%. A little softening there, not breaking out above that. Bitcoin 2%. Let's go to GameStop. GameStop 22%. That short interest move is a problem. That's a problem. Oh, man. So what else we got? The Tattooed Chef down again. Down 3%. We've got DocuSign down a little bit. Shift Tech. Let's see. Somebody asked about NIO. NIO's a great company. I highly encourage you to watch my 2 Tesla